Let's begin CMA Inter exclusive marathons for June 24 or December 24 exams. This video, this introduction of mine is going to be a common intro for all the CMA marathons. So here I just want to give a couple of instructions. Please kindly watch these instructions and then only start watching from the respective timestamp. Don't hurry up. I know you are thinking to skip this introduction and want to directly go and watch. Please have patience. If you want to succeed in life, you have to follow certain instructions. That instructions I'm going to give you. The first and foremost instruction, kindly watch these marathons at standard speed. Don't increase the playback speed. Please, when you are listening to the class, your purpose is not to finish the class. The purpose is to absorb something, to get something, to connect with the subject, to absorb something. Absorption is important. When you listen to the class at standard speed, you require very, very, very less time for revision. When you listen to the class at higher playback speed, you require lots of time for revision. Getting it? And when you listen the class at higher standards, higher playback speed, generally you will not get that command on the subject. Getting it? That's it. Now we are going to upload for all the CMA Inter, all the 8 subjects related marathons. So we will be uploading it from 11th of May onwards. Will be uploading for June exams. Even for December students also can absolutely use these marathons. So until May end, we will be keep on uploading whenever one marathon is completed, we'll be keep on regularly uploading. So P5, our faculty Subramaniam sir will take this marathon, law, and Radhika Gelot from Pune. So she'll be handling industrial and commercial laws. Company law and ethics, Subramaniam sir will handle. And P6, financial accounting will be by Sai Babu sir. By the way, you can just open our YouTube channel, caramharsha. Inside that playlist you open, you see the playlist, first playlist, CMA Inter June 24 marathons or strategies. So CMA Inter playlist you will find like this. So inside this preparation strategies, 3/4 preparation strategies. What is 3/4? Very simple. A student need not study 100% of the entire syllabus to qualify. In order to get 50, 55 plus, if you are very good at 3/4 of the syllabus, that's more than enough. So for every subject, the faculty has given guidance on which 3/4 syllabus you must be very strong at. So you watch that, you will understand. So, and coming to, by the way, in this marathon, we have used materials, right? These materials that we used in this marathon can be downloaded from Open Srestha CMA website. Inside the CMA Inter, you open PDF resources. Just click on the PDF resources, open CMA Inter. So below group 1, you just see here. So law, taxation related, accounts related, tax related, and cost accounting, everything, even marathon notes and all also. If at all we have a marathon notes, that also we will insert here. You will find it here. Getting it? So there you can download the materials. Financial accounting by Sai Babu sir, direct taxes by Bhaskar sir, IDT by Pavan sir, cost accounting by Ganesh Bharadwaj sir, and the same Ganesh Bharadwaj sir will handle management accounting as well. Paper 11 part A, financial management by Funny sir, analytics by Mahmood sir, P10 auditing by Mahmood sir, corporate accounting by Sai Babu sir of our Srestha faculty, and operational management by Subramaniam sir, who is actually handling corporate law, and strategic management by Harish Krishnan sir. We will be uploading all these marathons as and when completed, and we try our level best to upload all these marathons, within this May month itself. Getting it? So make use of it. And even RTP videos also we will be uploading very soon for each subject. So just make use of these resources and do well in the exams. And while you're listening, just post your appreciation, whatever. After watching the marathon, please post your appreciation, whatever, as a comments, and like this video, especially importantly, because it will recommend to other CMS students as well. All the very best. Thank you. Continue watching, by the way.
So chapter number 1, in chapter number 1, sir, we have actually 7 areas. Out of these 7 areas, the first area is accounting principles, concepts and conventions. And examination point of view, this is very, very important. Last time also they have asked one question. So simple basic principles. First of all, what is accounting principle? See, what are the basic rules we follow in accounting when we are recording business transactions, or when you are preparing financial statements? Generally, what kind of rules you follow, and what is the foundation for this accounting subject, the base? Those are called accounting principles. Now these accounting principles will ensure uniformity and understandability, because everybody will follow the same principles, right? So therefore they will ensure uniformity and understandability. See here, first of all, what is the accounting principles? These are the basic rules which acts as the base for recording transactions and maintaining books of accounts, and they ensure uniformity and understandability. Because see, if I see financial statements of A Limited and B Limited, I will understand them in an equal manner. Why? Because they are following same principles mostly. There is a uniformity in the financial statements prepared by different enterprises because of these accounting principles, because accounting principles are same for everybody. Na? So that's why these are the base for the subject. Now these accounting principles, basically they have divided into two parts. Important. They are split into two. One is accounting concepts, another one is accounting conventions. Convention means the good practice, what is the custom, what is the tradition we follow in accounts. Concept means what? The assumptions we make and which will provide the scope of the subject. For example, see, within what parameters and within what conditions I need to do the accounting. So that will be provided by the accounting concept. That will be provided by the accounting concept. So this is accounting concept. Concept and conventions are both are principles only. The principles are split into the concepts and conventions. So first we discuss what is accounting concept. See, accounting concepts are like, for example, what we follow: matching concept, periodicity concept, cost concept, realization concept. All these concepts we are following now. They are nothing but what? The assumptions. So when you are doing accounting or when you are recording transactions, we assume these are the things we need to follow. So these are the assumptions and conditions that define the parameters and constraints within which the accounting operates. See, within which the accounting operates. What are the boundaries of accounting? For example, in accounts we follow matching concept. That means the revenues and the corresponding expenses we will try to match. Dual aspect concept. For every transactions we record debit as well as credit. So within these parameters, within these conditions or restrictions, we will operate the accounting. So those are called accounting concepts. So accounting concepts are what? The assumptions and conditions that define the parameters and constraints within which the accounting operates. And these are the foundation for accounting principles. And generally, what are the common accounting concepts we follow? Business entity concept, going concern concept, periodicity concept, money measurement concept, accrual concept, dual aspect concept, matching concept, realization concept, cost concept. You tell me now, all these concepts we apply in accounting or not? Yes. And indirectly, these concepts are providing what? These concepts are providing us the parameters, the constraints within which the accounting operates. When I want to record any business transactions or when I want to prepare financial statements, now I need to keep these concepts in my mind, and within these concepts I need to record the transactions, I need to prepare the financial statements. So of course, accounting concepts are also part of accounting principles only. Principles itself is split into two parts: concepts and conventions. Now next, what is convention? See, for accounts, convention is also very, very important. Convention means what is the tradition, customs, what is the best practice we are following. For example, prudence concept or prudence, conservatism concept we follow. Conservatism concept, consistency concept, materiality concept, disclosure concept, full disclosure concept. Like that, there are some good practices are there. For example, concept of materiality. The financial statement should provide all material information. All items relating to, all material items must be presented in the financial statements. Now, this is the concept of materiality. And concept of, see here, there are different conventions. First one is convention of conservatism, convention of consistency, Convention of materiality, convention of full disclosure. See, in examination they will ask you, explain about accounting conventions. Then you need to explain these 4 things. So, or MCQ is also possible. So, between the lines, you have to be very careful. See, accounting convention means what? The customs, the methods, the procedures, the guidelines associated with practical application of accounting principles. Whatever the principles are there, we need to apply them practically, right? So, what are the good practices we are following over the period? And these are everybody accepted things, see, widely accepted. These are the common practices which are used as a guideline when recording transactions. See, when you record transactions, you should keep in mind the prudence concept, conservatism concept. You should keep in mind the consistency concept. Consistency means, see, last year what principles you followed, this year also you follow the same principles. So there is a consistency. And materiality you follow. So what is the difference between accounting concept and convention? See, accounting concepts will provide you the boundaries within which the accounting operates. Accounting conventions are over the period widely accepted practices. We say customs, the procedure, the guidelines which we follow in the preparation of financial statements, or maintaining books of accounts. Both together is accounting principles. So accounting principles are accounting concepts plus accounting conventions. Both together we call it as accounting principles. And accounting concepts are the assumptions. They will provide the scope within which the accounting will operate. Accounting conventions are the good tradition over the years, what practices we are following, widely accepted. Now let us discuss one by one. First, entity concept. Sir, what is entity concept? Business entity concept. The business entity concept means the business is different from its owners. So always in accounts we have to see the owners and the business as separate categories, separate distinct persons. That's why any transaction done by the proprietor with the business, so we will record it separately. So we won't see the business and the proprietor as one and the same. That is called business entity concept. So as far as the accounting is concerned, you should always treat the business organization and the owner separately. See here, entity concept says an organization is treated as distinct and separate. Distinct and separate from the persons who own or manage it. In other words, organization and business owners are two independent entities. So that means company and shareholders both are separate. They are not one and the same. That is what the business entity concept says. Now see, what is the impact of this concept, sir? See, simple. Whenever any transaction done by the owner with the business or any transaction done by the business with the owner, they have to be treated separately and they have to be recorded separately. This is the prime example. But you cannot say, so business and owner both are same. Whatever the transactions done by the business with the owner and owner with the business, we won't record. It is like transaction is done by the business to itself, so we won't record it. No, that is what not the, business entity concept is trying to say, that you both are different for the purpose of accounting. Next, going concern concept says, see, organization will continue for future, infinite period. We assume that this organization will continue for foreseeable future. It neither have the intention nor have the necessity to curtail its operations. Now, based on this assumption, we will prepare financial statements. Suppose if this principle is not holding good, that means if the organization is not going to continue in future, then the basis of preparation of financial statements must be changed, na? Because see, there is a concept called historical cost concept. As long as organization is continuing, going concern, we don't bother about the value of the assets, the value of the liabilities. But the moment you say this organization is no more going to continue, then the way you look at the assets value, liabilities value will change. That's why the basis for preparation of financial statements will depend upon going concern assumption. So this going concern assumption, we assume that this organization is going concern. This will continue for foreseeable future unless there is an evidence that this is no more a going concern. So going concern concept says organization is assumed to continue to exist for indefinite period of time. And the going concern concept forms the basis for preparation of balance sheet of the company. I mean, financial statements of the organization. For example, see, if the going concern assumption failed, then you need to prepare financial statements based on NRV basis, net realizable value. Cost concept will not hold good. So the going concern concept forms the basis for preparation of balance sheet of the organization. So this is concept number 2. Next, accounting period concept. Sir, even though organization will continue for indeterminate period of time, but for the purpose of measuring the performance and financial position, we will split the organization period into 1 year, quarterly, half yearly to measure the performance, to know the financial position. So that is called accounting period concept. See here, the infinite life and organization can be split into smaller periods of equal duration. Example, quarter, half yearly, yearly, like that we will split. So smaller periods of equal duration to measure the financial performance and position of the entity. So we want to know the financial position. How can you measure the financial position for a particular year? Or for a particular year, what will be the financial performance of the entity? Or for a particular quarter or for a half year, like that. So even though organization is having indefinite period of time, infinite life, that is what you assume in going concern assumption. But for the purpose of preparing financial statements, we will split into smaller periods. This concept is called accounting period concept. Next, money measurement concept. Sir, you know, in accounts, we record only those things which are measured in terms of money. Suppose if you are unable to measure it, how can you record it in the books? That is what money measurement concept says. Everything must be converted into money and then record it. So any event or transaction which can be expressed in terms of money is always recorded in the books of accounts. For example, a business may own 3 lakhs cash, 1500 kg of raw material, 10 vehicles, 3 computers, etc. Unless each of these expressed in terms of money, the assets owned by the business cannot be ascertained. For example, you have 10 vehicles. So what is the value of these 10 vehicles? We need to write in the books. For that, we should know the value in terms of money. And you have, suppose for example, 3 computers. What is the value in terms of money? And 15 kgs of raw material, 1500 kgs of raw material. What is the value in terms of money? So this money measurement concept says whatever the assets you have, you should able to convert them into money. Then only you can determine the value of the assets. And one limitation of this money measurement concept is it will not take into consideration the real value of the asset. See here, absolute value of money only considered. Real value is ignored. Like for example, inflation, any exchange rate changes, we will ignore. See, in accounts, suppose you purchased a fixed asset. At the time of purchase, the value is 10 lakhs. You will record it 10 lakhs only. Right? You don't bother about inflation. You don't bother about exchange rate changes. Because money measurement concept says you have to measure absolutely in terms of money. You should not consider any other consideration, any other thing. If you can able to convert into money and convert it and record it in the books. So this is the limitation of this money measurement concept. This may be asked as an MCQ. So for example, money measurement concept measures the value of items absolutely in terms of money. So dash is ignored, or what is the thing it is ignoring? Real value of money is ignored. Okay. Then accrual concept, sir. Sir, accrual concept is what, sir? Incomes and expenses will be recognized as and when they accrued and earned. For example, expenses is recognized when they are accrued, when they are incurred. Whether paid or not, that's a secondary matter. Incomes, when will you recognize incomes? Only when they are earned. Whether received or not, that's a secondary matter. So the expenditure and incomes we will recognize on accrual concept. So accrual concept says this concept is based on recognition of both cash and credit transactions. Cash transaction, for example, you done cash sales, you record it. Cash purchases, you record it. Say at the same time, credit purchases, credit sales also we will record. Because the expenses incurred, we will record. Whether paid or not, that's a secondary matter. Similarly, any income earned, we will record it. So irrespective whether cash is received or not. So therefore, always in accounts we follow accrual concept. That means when expenses incurred, when incomes earned, we will recognize in the books by following accrual concept. Next, dual aspect concept. I think this concept everybody knows. Every transaction has two aspects, debit, credit. We will record both. That's why in accounts there is a accounting equation concept, because every transaction will affect two accounts. See, the dual aspect concept assumes that every transaction recorded in the books of account is based on two aspects. Technically, we call them as debit or credit. And such duality of the transaction is commonly expressed in terms of equation. That is, assets is equal to liabilities plus capital. So I think this is the correct principle. Na? Assets is equal to liabilities plus capital. So this accounting equation, whenever any transaction happened, this accounting equation will be affected. Okay, either an asset may be affected, corresponding liability may be affected, or capital may be affected. So any one of the two aspects can be affected. So in accounts, we know that we will follow double entry system, dual aspect concept for recording the transactions. So that is dual aspect concept. And matching concept. You know matching concept. See, the revenues and expenses. So the revenues and expenses, they must be recorded in the same year in which they incurred. For example, I earned a revenue. To earn this revenue, what expenses I incurred, both will be recorded in the same year. So the revenue and expenses must be recorded at the same time at which they are incurred. The revenues earned should be matched with expenses incurred during the accounting period. For example, there is a revenue, sales 10 lakhs. Now, to earn the sales of 10 lakhs, we purchase raw material. Suppose, for example, to purchase this, suppose 6 lakhs. Now, see, that means this is income, this is expenses. We are matching the revenue with expenses. So, matching concept says, see, in a particular year, so the revenues and expenses, so whatever you incurred, they will be recorded at the same time. So, in the period in which they are incurred. The revenues earned should be matched with expenses incurred during the accounting period. We should try to match the revenue with expenses. See, expenses incurred, not expenses paid. For example, you purchased raw material on credit basis. That means it is incurred. So we have to record in this year only. And whatever the revenue earned, to corresponding to this revenue, what are the expenses you incurred? So you try to match these two. So that is called matching concept. So this is also one of the accounting principle. Realization concept says, so realization concept says revenue should be recognized only to the tune which it is certainly realizable. So when you are able to realize it, you recognize it. For example, if you are unable to realize, or there is uncertainty regarding realization, don't recognize it. So mere getting an order from the customer won't make it eligible to be recognized as revenue. For example, you got an order from customer. Will you recognize it as a revenue? No. Only when you deliver the goods, when customer accepts it, then you will recognize the revenue. So the reasonable certainty of realizing the money will come only when the goods ordered are actually supplied to the customer and he is billed. So that is realization concept. So realization concept is very simple. It is not when you actually received the order, but it is actually when you deliver the goods, that event, that certainty in collection arises now. Certainty in realization, that is the point where you need to recognize the revenue. Cost concept says, see, the assets must be recognized at their cost. Initially, when you purchase any asset, that must be recognized at cost. That is cost concept. All the business assets so should be recognized at the cost incurred for their acquisition, including any cost related to it. For example, transportation cost, insurance cost, loading cost, installation cost, assembly cost. Relating to fixed asset, what we will do? We will add to the corresponding fixed asset, na? That is cost concept. So these are the different concepts of accounting concepts, and these are part of accounting principles. And next, accounting conventions. See, I told you that conventions means the good traditions, the customs what we are following. So these are also very essential for accounting. First, convention of conservatism. See, you know conservatism. When we are doing accounting, sir, we should anticipate all possible losses but not gains. So providing for all possible losses but never for possible future gains. Always provide for possible losses, whatever the losses you are going to incur. So provide a provision. But sir, suppose for example, I am going to incur some I am going to get some gain, sir. Can I recognize? No. For example, I am going to win the case in the court, sir. If I win, I am going to receive 25 lakhs, sir. So can I recognize this 25 lakhs? No. Only losses will be anticipated as per the concept of conservatism. Therefore, conservatism concept always ensures what? There is a understatement of incomes and profits, thus resources. Fair enough. Resources, I mean, incomes must be understated, assets must be understated, profits must be understated, no problem. But expenses, liabilities, losses always must be correctly stated. That's why you should anticipate and recognize. This is the convention of conservatism. Next, convention of consistency. See, in accounts, one of the best practices is consistency. What principles you are following, same you should follow next year also. What policies you are following, try to follow the same. Consistency. Suppose if there is no consistency, your accounting information is, not reliable always. Okay. So continuous observation and application of the rules and practices of accounting. See, continuous observation and application of the rules and practices of accounting. Uniformity and consistency of the accounting rule is vital. See, uniformity and consistency. Suppose if you are making frequent changes in the treatment of accounts, would result in inconsistency and make the accounting information less reliable. For example, last year SLM method, this year WDV method, again next year SLM method, again WDV method. What is this? Inconsistency. This kind of inconsistency will lead to making that accounting information is less reliable. So this is the concept of conservatism. Convention of consistency. Next, convention of materiality. Sir, always when you are doing accounting, sir, your accounting information should contain material information. So the recording and reflection of all material facts in the accounting records is very, very important. What is material fact? Material information means the information which will influence the decisions of users. So always make sure that the material fact should be part of your accounting records. And elimination of insignificant information. Try to eliminate insignificant information, but predominantly material significant information should be part of your financial statements. And this materiality concept will varies from entity to entity and period to period. So they are not same for everybody. They will change from entity to entity, period to period. And last one, convention of full disclosure. Convention of full disclosure. Full disclosure of all material information, whether favorable or otherwise unfavorable. So in the accounting statement of business enterprises, try to disclose everything. Okay. So to conclude, in summary, what is this chapter? See, this is chapter number 1. So in chapter number 1, there is a concept called accounting principles. Okay. These accounting principles are split into two. One is accounting concepts. Accounting concepts. Another one is accounting conventions. Conventions. Okay. Concepts, conventions. So first of all, principles means basic rules we follow in accounts. And these rules are nothing but provided by concepts and conventions. What is concept? Concept is nothing but the assumptions, the conditions, which will provide the parameters, the boundaries within which the accounting operates. Like for example, matching concept, dual aspect concept, periodicity concept, money measurement concept, cost concept, realization concept, like that there are certain concepts. So these are assumptions when we follow, going concern assumption, all these things, assumptions or conditions. They will provide the parameters and scope within which the accounting operates. And then come to accounting convention. What is accounting convention? See, conventions are nothing but the traditions, the customs. So in business, what methods, what customs, what guidelines, traditions we follow. So those are called accounting convention. For example, convention of conservatism, convention of consistency, convention of materiality, convention of full disclosure. So this is what this chapter is all about. So in chapter number 1, sir, we have one more important concept, capital and revenue expenses, capital and revenue transactions, sir. Definitely from this also you can expect a question, and MCQ or a direct question also expected. See, in chapter number 1, in case of capital and revenue transactions, there are 4 topics you need to learn. One is capital expenditure, revenue expenditure. Second one is capital receipt, revenue receipt. Third, capital profit, revenue profit. Fourth, capital loss, revenue loss. See here, expenditures first, then receipts, then profits, then losses. What expenditures? Capital expenditures, revenue expenditures, capital receipts, revenue receipts, capital profits, revenue profits, capital losses, revenue losses. Like this, there are 4 topics is there. You should understand. See, this basic distinction is very, very important when you prepare accounts. What is capital expenditure? What is revenue expenditure? What is capital receipt? What is revenue receipt? What is capital profit? What is revenue profit? What is capital loss? What is revenue loss? So all these things you should understand. Now first, capital and revenue expenditure. So first of all, what is capital expenditure? See, any expenditure which will give benefits for more number of years, more than 1 year. So benefit over number of accounting periods, and which is non-recurring in nature. That means one-time expenditure. Like for example, purchase of machinery, construction of building, development of website, heavy repairs on machinery, etc. These are non-recurring expenses, and the benefit of this expenditure is there for over a period of time. For example, if I purchase a machinery, then that machinery life is 5 years. That means it is useful for me for 5 years. So that expenditure is capital expenditure. Now, if it is a capital expenditure, what I need to do? I need to accounting treatment. It is capitalized as an asset and shown in the balance sheet. Suppose if I purchase any asset, I will show it in the balance sheet as my asset. If I develop any software, it is my asset. It is, for example, development of website. We developed one website. That is our asset. Intangible asset. Suppose heavy repairs on machinery. Normal repairs, revenue expenditure. Heavy repairs on machinery. Now, generally this capital expenditure takes place when the asset or service is acquired or improvement of fixed asset is affected. So generally when you acquire any asset or when you acquire any service or when you are doing improvement to the existing fixed asset, generally this kind of capital expenditures are incurred. So tell me, what is capital expenditure? Any expenditure which gives benefit for more than one accounting period, and it is non-recurring in nature. Generally this capital expenditure takes place when the asset or service is acquired or when you are doing improvements to the existing machinery. Can you tell me some examples? Purchase of machinery, heavy repairs to machinery, or development of website. So all these, construction of building, all these are examples of what? Capital expenditure. And what is accounting treatment? If it is a capital expenditure, we will show it in the balance sheet as an asset. Now come to revenue expenditure. See, the revenue expenditure is the benefit of that expenditure is consumed within the same year. So benefit in the current accounting period only. It will not give benefit beyond 1 year. And they are generally recurring in nature. That means continuously you need to incur these expenses. Whereas capital expenditures are non-recurring in nature. Once in a while we need to incur. Will you purchase assets every day? Will you purchase plant and machinery? Will you construct building every day? No, it's a non-recurring expenditure. So for example, purchase of raw material you done on regular basis and the benefit is restricted within the year. For example, you pay salaries to the employees. Suppose for example, January month salary you paid. That means the benefit is consumed that year only, that month only. Next month again he will provide the service, you need to pay the salary. So recurring in nature, and they are incurred to carry the regular course of operations of the enterprise. See, to carry the regular course of the operations, like for example, you pay salaries to employees, wages to the workers, rent you pay, depreciation expenses, conveyance charges, monthly internet charges. These are all what? Revenue expenditures, because the benefit is restricted to that year only and they are recurring in nature. For example, every month we need to pay rent, every month we need to pay internet bill, every month we need to pay salaries and wages. So that's why these are recurring in nature. And what is the accounting treatment? Simple, debit to P&L account. So charged as an expenses against the profit. So tell me, what is capital expenditure? What is revenue expenditure? Capital expenditure, the benefit is over a number of years and they are non-recurring in nature. And when they are incurred, generally when you acquire any asset or when you do improvements to the existing asset, this capital expenditure is incurred. And what is the accounting treatment of capital expenditure? You will show it as an asset in the balance sheet. Come to revenue expenditure. What is revenue expenditure? The revenue expenditure is the benefit is consumed within the current year only. And they are recurring in nature. That means regularly they will be incurred. Like for example, salaries, wages, rent, administration cost, and any conveyance charges, monthly internet charges. These are all regular expenses we incurred. And what is the accounting treatment? We charge to P&L account as an expense. And see, there are certain rules for identification of capital expenditure. See, this material or whatever explanation I am giving, absolutely strictly I am adhering to the CMA study material. So therefore, this is exclusively for CMA. I am not teaching any other source, exclusively for CMA. Keeping in view the CMA inter students, keeping in view the CMA exams, I have prepared this. And if you want, you can check it with CMA material also. You open the material, you see the capital expenditure, revenue expenditure topic. So look at what is there in the CMA material, what SAR is teaching. Absolutely, they will match. Okay. So therefore, once you listen to this, you are completing the study material. No need to look study material again. Just you complete this. So it will be more than sufficient. And you could able to answer a lot of MCQs and questions also. But you have to listen with utmost care. And you should not miss single point also. Okay. Now, there are certain rules which is given relating to identification of capital expenditure. First one is, an expenditure can be recognized as capital if it is incurred for the following purposes. First thing is, any expenditure incurred for acquiring long-term assets. See, any expenditure you incurred for acquiring long-term assets. What is long-term assets? Tangible fixed assets, building, plant and machinery, equipment, furniture, vehicles. So these are all long-term fixed assets. So when you spend any amount on this, that will be capital expenditure. We discussed already. Next, when an expenditure is incurred to improve the present condition of the machine or putting an old asset into working condition. For example, sir, there is an existing machinery. Now in that existing machinery, the engine you replaced it. Now because of this replacement of the engine with the new engine, the capacity of the machine increased. The working condition of the machine increased. So the asset is performing better. The asset is performing than previously assessed levels of performance. Now that is also capital expenditure. Sir, not just simple replacement is a capital expenditure. See, when an expenditure is incurred to improve, see the word is improve the present condition of a machine. Suppose the present condition of the machine is, it is producing 2000 units per day. 2000 units. Now see, you have done some additions. Now it is capable of generating 3000 units. That means you have improved the present condition. Now, whatever the additions you made to improve the existing condition, that is a capital expenditure. That you have to add to the asset and you would show it in the balance sheet. So, any expenditure we incurred to improve the present condition is a capital expenditure. Or putting an old asset into working condition. For example, a old asset is there which is not in working condition. Now we have made a lot of replacements, a lot of changes, a lot of expenditure we incurred to bring into the working condition. Previously it is not working, now it is working. So therefore, it is definitely a capital expenditure. Similarly, an expenditure incurred for improving the earning capacity of an organization. See, any expenditure you incurred to improve the earning capacity of an organization. If that expenditure is increasing the earning capacity of the organization, that will be treated as what? Capital expenditure. I have given example. For example, see, expenditure incurred for shifting the factory for easy supply of raw materials will be capital expenditure. For example, your factory is there in one place. So this is the place. Now your raw material supplier is there in some other place. For example, the distance between the factory and the raw material supplier is, for example, approximately 500 kilometers. 500 kilometers. Now, whenever you order raw material from supplier's premises, it will reach to the factory. So it will 500 kilometers is the distance. Now there will be heavy transportation cost to travel this much distance. So therefore our company decided that why can't we shift so within the limits of the supplier. For example, we shifted the factory within the vicinity of, for example, 20 kilometers. Our supplier and our factory is within the gap of 20 kilometers. Now you tell me, because of this there will be cost savings or not? Earning capacity of the organization will increase or not? Why? How earning capacity will increase? See, whenever we want raw material, supplier can produce it, and we will receive the raw material within the time, in very short span of time. Therefore, whenever any new order came, we can honor it quickly. See, suppose for example your factory is here 500 kilometers. Now you receive the raw material, and after that you start producing. It will take a lot of time now. So in that time, so maybe you miss some of the orders. Now you can honor so many orders, and the cost of transportation is also saved now. That will increase the earning capacity. See, transportation cost, fuel cost, insurance cost, loading cost, unloading cost, everything will be reduced because I am shifted my factory to the vicinity, within the vicinity of the supplier. So that could be also be a capital expenditure. Now the shifting expenses, see, expenditure incurred for shifting the factory for easy supply of raw materials will be capital expenditure. Definitely it will be a capital expenditure. Now the shifting from this place to this place, suppose a company incurred 100 lakhs. Now this 100 lakhs will be my capital expenditure, because this 100 lakhs is increasing my earning capacity. So therefore that will be my capital expenditure. So in examination they will ask, for example, a company is shifting from one place to another place so that the earning capacity is increasing. What is the nature of the expenditure? Capital expenditure. And last one, here one more point is there, this preliminary expenses incurred before the commencement of business. See, before commencement of business, whatever the expenses you incurred, for example, drafting of memorandum of association, articles of association, any documents preparation, all these expenses you incurred, that is also capital expenditure. See here, legal charges incurred by the company for drafting the memorandum of association, articles of association, or brokerage paid to brokers, or commission paid to underwriters for raising capital before commencement. Whatever the preliminary expenses you incurred before the commencement of the business, that is also capital expenditure. So these points are there in the study material. So tell me, 4 points we covered here, and these 4 situations, the expenditure incurred is which expenditure? Capital expenditure. What are the 4 points? First, any expenditure we incurred on long-term assets is a capital expenditure. Remember. Second thing is, when any expenditure is incurred to improve the present condition of the machine, so and also putting the old asset into the working condition is a capital expenditure. Third, any expenditure incurred for improving the earning capacity of the organization. This is very, very important. If any expenditure is incurred by the organization which will increase the earning capacity of the organization, that will also be considered as what? Capital expenditure. And any preliminary expenses incurred before commencement of business is also capital expenditure. So this is revenue expenditure, capital expenditure. So we discussed capital expenditure and revenue expenditure. Now there is one more small concept called deferred revenue expenditure. See, what is this deferred revenue expenditure? See, it is a combination of both capital plus revenue expenditure. Capital plus revenue. Suppose any expenditure you incurred, the expenditure benefit is over a period of time. Generally, when an expenditure gives you benefit for more number of years, we will treat it as capital expenditure. But this expenditure is deferred revenue expenditure, means expenditure which is already incurred or the liability is already incurred, but we presume that the benefit is for subsequent period of time. The benefit is for a certain period of time. Whether it will give benefit or not, we don't know, but we presume that it will give benefit for a certain period of time. For example, best example is heavy expenditure on advertisement. Suppose a company spend 10 crore rupees on advertisement promotion. Now company may assume that this 10 crores not only give benefit of this year, it is also going to give benefits in the coming years also. How many years? For example, the effect of this advertisement could be for next 4 years. Now that means this is called deferred revenue expenditure. Sir, why can't you treat it as a capital expenditure? See, one of the important characteristics of capital expenditure is it must give benefit over a period of time. But here there is no absolute guarantee that you are going to get the benefit. It is only the presumption that it is going to give the benefit. Can I say advertisement is my capital expenditure? Considering that definitely this advertisement gives me benefit? No, you can't say with certainty. Because you have given an advertisement, there is no guarantee that customer will come and again purchase the goods. Advertisement may be one of the factor. It is not the only factor why your sales will increase. So you need to provide other things also. For example, your product should be qualitative product, so price should be within the reach. So the product should be within the reach of the customer. There are so many after sale services. So there are so many other parameters which will play important role. So therefore, deferred revenue expenditure is not a capital expenditure by nature, but we presume that this expenditure is going to give us benefit over a period of time. So now the thing is that what we do with this deferred revenue expenditure, see, we will treat this deferred revenue expenditure as, we will amortize it over the period of time. Over the period, what we believe that this is going to give the benefits, for that period we will amortize, we will charge to P&L account. So see here, the expenditure for which payment has been made or liability has been incurred, but which is carry forward on the presumption that that will be benefit over a subsequent period or periods. So we presume that there will be a benefit for over a period or periods. And it is a combination of both capital and revenue expenses. It's a combination of both capital as well as revenue expenditure. It is not that only it is a capital expenditure or revenue expenditure. It is a combination of both. Because the benefit is for this year and the benefit is for future also. We presuming. Example, heavy advertisement expenditure incurred prior to launching a new product or development expenses of a product. For example, heavy advertisement expenditure we incurred prior to launching of the product. We may thought that this advertisement will give us benefit over a period of time. So we treat it as deferred revenue expenditure. And what is the accounting treatment, sir? Simple. A part of such expenditure is recorded in the debit side of the income statement. That means we will, for example, we incur 10 crores divided by 5. What is this 5? We assume this is giving benefits for 5 years. So therefore, every year 2 crores we will charge to P&L. Remaining 8 crores will appear in the balance sheet as an asset. So this deferred revenue expenditure we will treat it as an asset, and over the period we will amortize to P&L account. But now one important point I want to bring you to the notice that there is a accounting standard called AS26 which says there is no question of deferred revenue expenditure. Whatever the expenditure you are incurring, you should charge to P&L account immediately. For example, the advertisement cost you incurred, how much heavy advertisement it is, you directly debit to P&L account. No question of amortizing over a period of time. So therefore, to put it simply, there is no concept of deferred revenue expenditure. But if you look at deferred revenue expenditure without considering what is there in the accounting standard, I think you should understand what is deferred revenue expenditure. There is an expenditure we incurred and the benefit is over a period of time we are presuming. Therefore, we will charge some amount to debit to P&L account as an expense. Remaining unamortized amount will be there in the balance sheet. But see here, as per AS26, the expenditure which are recognized as deferred revenue expenditure has to be treated as simple revenue expenses. So therefore, in examination, they may ask, suppose a company incurred heavy advertisement expenditure. So what is the treatment? You have to write as per accounting standard 26. There is no question of deferred revenue expenditure. Entire expenditure has to be treated as simple revenue expenditure. Therefore, entire amount will be charged to P&L account. Now, this 10 crores entirely will be debited to P&L account. Suppose ignore AS26. If there is no AS26, then out of this 10 crores, 2 crores will be debited to P&L account. Remaining 8 crores will continue. Because we thought this 8 crores will give us benefit in the next coming 4 years. Next, so we completed the expenditure part. Capital expenditure, revenue expenditure we completed. Now capital receipt and revenue receipt. Sir, what is this capital receipt and revenue receipt? See, if you receive anything apart from the regular course of the business, so regular operations of the business, that is called capital receipt. See, receipts obtained from operations other than regular operations of the entity. Other than regular operations. What is regular operations? For example, sale of goods. Sale of goods is regular operations, or providing services if you are a service provider. So sale of goods, service, providing of services, these are regular operations. Suppose, for example, apart from the regular operations, if you receive anything, that can be considered as what? Capital receipt. But remember, these capital receipts does not have any effect on the operating results. So for example, see, any additional capital introduced by the proprietor, any partners, for example, partners brought the capital to the business. This is capital receipt. Suppose proprietor brought capital to the business. Similarly, receipts from issue of fresh shares. Suppose we issued fresh shares, we got the money, capital. by the company. Proceeds from sale of long-term assets. For example, we have one fixed asset, we sold it, we received the amount. So sale of fixed asset is also what? Capital receipt now. It is not that something we will do as a part of our business. It is not part of our regular operations. So therefore, definitely it's a capital receipt. And what is the accounting treatment of capital receipt, sir? So such receipt is created to respect to account of capital nature, and gets reflected in the balance sheet. So this capital receipt generally we will credit to the prospective capital nature account. For example, proprietor brought the capital. The amount will be credited to capital account. For example, capital brought by partner, it will be credited to partner's capital account, and where they will appear in the balance sheet on the liability side, capital. For example, similarly, a company issued shares. Now the amount received is credited to share capital. That is also appeared in the balance sheet. So this is capital receipt. Any receipt other than from operating activities of the business, other than from regular operations of the business, and these they do not affect any operating result. What is this capital receipt? Do not affect any operating results. Next, revenue receipt. Sir, what is revenue receipt? From regular operations, what we are going to receive, regular course of the operations, and definitely they will affect our operating profits. Operating profits means incomes minus expenses, so we will consider them as a part of incomes. So definitely they will affect our operating profits. Example, any collection from customers for goods sold on credit, fees received for services rendered in the ordinary course of the business, recovery from customers earlier written off as bad debts. So these are all revenue receipts. So what is capital receipts? What is revenue receipt? And what is the treatment of revenue receipt? Revenue receipt treatment is credited to P&L account. So these are recognized as income and should be credited to income statement, P&L account. So tell me, what is capital receipt? Any receipt other than from regular operations of the activity, regular operations of the business. Okay. So if you receive anything as a part of regular operations, it is revenue receipt. Capital receipt, what we do? Capital receipt we will credit to the respective account and we will show it in the balance sheet. What about revenue receipt? Revenue receipt we will treat as income and we will credit to P&L account. Next, capital profits, revenue profit. Next thing, sir, what is capital profit? See, any profit from other than operating activities, that means non-operating activities. In the regular course of the business, what activities you do, from that whatever the profit you got, that is revenue profit. For example, sale of goods. Sale is nothing but cost plus profit. So the profit is normal profit, revenue profit. We will recognize direct sales in the books. What about any profit apart from normal operating activities? Like for example, when you sell the fixed asset, whatever the profit you receive, that is not from regular operating activities. So profit which arises out of non-operating activities, and they are non-recurring in nature. These profits will not get every time. So examples, profit prior to incorporation. Suppose before incorporation of the company, if any activities is done, now from that activities, whatever the income we received, profits we received, that we generally will be treated as capital profits. Similarly, any premium received on issue of shares. Suppose you issue shares at premium, we will transfer to share premium account. Now that share premium is what? Is nothing but capital receipt, capital profit. Profit made on reissue of forfeited shares. Suppose we forfeited the shares and those forfeited shares are reissued. Now at the time of reissue, we may get profit like capital reserve. We will transfer it to capital reserve now, that is. And redemption of debentures at discount. Suppose if you redeem any debentures at discount, that profit is also capital profit. Profit made on sale or revaluation of non-current tangible asset. For example, any fixed asset, tangible fixed asset we sold and we got profit. So suppose you done any revaluation of the tangible fixed asset, you got revaluation gain. That is also capital receipt, capital profit, nothing but. Now generally capital profits arise out of the sale of assets other than inventory or in connection with rising of capital or at the time of purchasing of the existing business. When you raise capital, when you purchase any existing business, or when you sell any fixed assets, generally these capital profits will arise. What is revenue profit? The profit which is arising from regular operating activities of the entity and they are recurring in nature. For example, profit arising out of the sale of the merchandise that the business deals in. For example, we are dealing in watches. So purchasing and sale of watches. So whatever the profit we got, that is revenue profit. Like profit made by rendering regular services to clients. Suppose if you are a service provider, when you provide service, whatever the amount you received, that is whatever the profit you got, that's a revenue profit. Surplus earned by non-profit organization. For example, there is an NPO, non-profit organization. This non-profit organization, the receipts are more than the expenditure. So we call it as surplus. That surplus is also revenue profit. So accounting treatment, these revenue profits which get determined in the income statement are distributed to the owners of the business or transferred to any reserve account. Suppose if it is a capital profit, Nana, we will transfer it to capital reserve. If it is the revenue profit, we will transfer it to P&L account, right? This P&L account will be used for distribution of dividend to shareholders. So remember. So tell me, what is capital profit? What is revenue profit? Understand the differences. Capital profit means non-operating activities. Revenue profit means operating activities. And capital profits, they are non-recurring in nature. I mean, that means they will not arise frequently. But revenue profits, they are recurring in nature. And when capital profits may arise at the time of issue of shares, at the time of sale of fixed assets, these things will arise. So can you tell me some examples of capital profits? When revenue profits will arise? Revenue profits will arise at the time of sale of goods. See, regular sale of goods, regular, if you are a service provider, on providing of services, these profits will arise, revenue profits. What are the examples of capital profits? For example, when you issue shares at premium, suppose forfeited shares reissued at profit, and when you sell any fixed assets, tangible fixed asset for profit, or when you revalue the tangible fixed asset, whatever the profit you got, so and any profit before incorporation, these are all capital profits. What about revenue profits? Revenue profits, generally, for example, when you sell the goods, when you provide the services, whatever the profit you got, revenue profit. And what you do with capital profit? The capital profit will be transferred to capital reserve. The revenue profit will be transferred to P&L account, and which will again be distributed as dividend to the shareholders. And the last one, capital losses, revenue losses. What is capital loss? So a capital loss is a loss which does not arise to an entity in the regular course of the operations. Capital losses may result from sale of assets other than inventory for less than WDV. Suppose sometimes you may sell the assets less than its WDV, and diminution or elimination of the assets other than as a result of use or sale. For example, that is from extraordinary activities like loss by flood, fire, etc. For example, because of the fire, the asset got destroyed. So that loss is capital loss. For example, because of the flood, the entire asset is damaged. So that means the total loss is capital loss. And what is the accounting treatment of capital loss? So it is either charged against the revenue, that is debited to the P&L account, or it is reflected on the asset side of the balance sheet. That means we will reduce from the corresponding asset, because if it is a capital loss, that loss will be reduced from the particular asset which actually lost, or we will debit to P&L account. That means the entire capital loss will be treated as loss and will debit to P&L account. What about revenue losses? Revenue losses arising to the entity in the normal course of the business. For example, any discount allowed to customer for prompt payment, any loss due to bad debts, etc. So loss due to bad debts. So we will give for example, customer need to pay the amount, customer has not paid, so he become insolvent. So bad debts, it's a loss, revenue loss. For example, we give discount to the customer, so discount allowed, that's the revenue loss. So accounting treatment, debit to P&L account, because all these losses are revenue in nature, so they will be debited to P&L account. So therefore, if you observe carefully, Nana, capital expenditure, revenue expenditure. Tell me, what is capital expenditure? What is capital expenditure? See, capital expenditure is an expenditure which is incurred on the assets. See here. Capital expenditure. Benefit over a number of accounting periods, and it is non-recurring in nature. Generally, these takes place when an asset is acquired or service is acquired, and when the improvement is done to the existing asset. Example, purchase of machinery, construction of building, development of website, heavy repairs to the existing machinery. And what we do with capital expenditure? This capital expenditure, we will treat it as asset and we will show it in the balance sheet. And then revenue expenditure. Revenue expenditure is, the benefit is restricted to this year only, and they are recurring in nature. and they will be incurred in the regular course of the to carry out the regular operations of the entity. Like for example, salaries, wages, rent, depreciation, conveyance charges, monthly rental charges, etc. And what is the accounting treatment? They will be charged as an expense against profit. And that means they will be treated as expenses. Now, certain rules also we discussed. Any expenditure incurred for acquiring long-term assets, capital expenditure. Any expenditure is incurred to improve the present condition of the machine, capital expenditure. Any expenditure is incurred for improving the earning capacity of the organization, capital expenditure. Any preliminary expenses incurred before commencement of business, capital expenditure. Then what is deferred revenue expenditure? See, any expenditure we incurred, any liability which is incurred, which will be carried forward. Presumption that is going to give benefits over a period of time. And it is a combination of both capital and revenue expenses. For example, heavy advertisement expenditure incurred prior to launching of a new product or development expenses of the product. These are examples of deferred revenue expenditure. And what is the treatment, sir? Treatment is some part will be debited to P&L account, unamortized part will be shown in the balance sheet on the asset side. Now, as per AS 26, any advertisement cost will be treated as normal revenue expenses only. There is no question of deferred revenue expenses. Next, capital receipts, revenue receipt. What is capital receipt? See, these are the receipts obtained from operations other than regular operations of the entity, and they do not affect the operating results. Now, example, any additional capital brought by the proprietor, partners, receipt from issue of shares, and any proceeds from sale of long-term assets. And what is the accounting treatment? Whatever the capital receipt we received, so we will transfer to the balance sheet. So, capital nature, it will get reflected in the balance sheet. Revenue receipt, receipts from the regular course of the operations, and it is affect the operating results of the operations. Collection from customers when we sell goods on credit basis, so in the ordinary course of the business. So these are all. And what is the accounting treatment of revenue receipt? It will be created to P&L account. Now, capital profit, a profit arising from other than regular operating activities of the business, non-operating activities of the business. And what is the accounting treatment of capital profit, sir? This capital profit is generally capitalized, that is transferred to capital reserve. Revenue profit arising from the regular operating activities, and it will be created. Generally revenue profit will be reflected in the form of a profit, and it will be used for distribution of dividend. And capital loss, revenue loss. Capital loss, the losses which is arising from non-operating activities, not from regular operating activities. And generally this capital loss, either we will debit to P&L account or we will reduce from the concerned asset. Revenue loss, it is arising from regular activities of the operations or organization. Example, any discount allowed to customer for prompt payment, loss due to bad debts, etc. What is the accounting treatment? Such loss is recorded in the debit side of the income statement, P&L account. So this is capital expenditure, capital and revenue transactions. Very, very important, sir. As a part of the first chapter, this is also to be discussed. Okay, this is one part of chapter number. Now next, sir, another part of chapter 1 we are going to discuss. So journal and ledger and trial balance also. We have accounting cycle. In this accounting cycle, first we will record transactions in journal, and from journal we will prepare ledger accounts. From ledger we prepare trial balance. From trial balance we will prepare financial statements. So these 4 stages are very, very important stages in accounting. In that, the first stage is journal. Let us discuss what is journal. See, journal is nothing but the book where we will record transactions. So that's why it is called book of original entry. The transactions originally will be recorded in this book. And we will record transactions in one chronological order. For example, date wise. So today, 24th May, what transactions happened? 25th May, what transactions happened? So one by one we will record in a chronological order in this book. And actually the word journal means a daily record, which is known as book of prime entry or book of first entry also. The other name for journal is So journal can be called as book of original entry or book of prime entry or book of first entry also. See, MCQs, they may ask from this. So the process of recording the transactions in journal is called what? Journalizing. So whatever the process of recording transactions in this book, we call it as journal. And whatever the entry we made in the journal, we call it as journal entry. Okay. See, journal entry can be of two types. Whether it can be a simple journal entry. What is simple journal entry? One account debited, another account credited. Or there can be composite or compound journal entry. So what is compound journal entry? See, in a transaction, there are two debits or maybe two credits involved. That is called compound journal entry. See, at least two debits and a credit, one credit, or at least one debit and two credits. So this is called compound journal entry. Sometimes we will see. So for a single transactions, we will debit accounts. There are two debit accounts. There may be one credit account, or there may be two credit accounts. There may be one debit account. So this is journal. Now, types of journal. See, this journal, whatever we record transactions, wherever we record transactions, this book is subdivided into two categories. So the book of original entry broadly classified into two categories. One is special journal, that means special book. Next one is general journal. So special, general. What is special journal? See, special journal is nothing but subsidiary books. See, we will maintain particular category of transactions in one special book. For example, all bills related, bills receivable, one book we will maintain. All purchases, one book will be maintained. All sales, one book will be maintained. They are called special journals. Now, if there is no special journal, that means remaining transactions we will record in journal, general journal. Okay. So what are the types of journals, sir? There are two types of journal. One is specific special journal. Second one is general journal. Special journal means specific kind of transactions will be recorded. See here. They are also known as subsidiary books. The different special journals that are usually maintained by an organization for primary recording of transactions. So what are the journals? What are the subsidiary books? First one, cash journal or cash book. So cash book, we will record all cash related transactions, cash inflows and outflows we will record. So exclusively for cash related transactions, we will maintain one book, one journal, that is called special journal, that is called cash book or cash journal, both are same. Next, purchase journal or purchases book. So purchase journal we will maintain or purchase book we will maintain, where we will record only credit purchases. Credit purchases we will record. Only goods, huh? So suppose if I purchase an asset, will I record in purchases journal? No. Here purchases is of goods. Next, what is the source for recording this purchases? Purchase invoice. Whenever we purchases, so supplier will give an invoice, na? So that invoice will be the source to record purchases in this book. Next, sales journal or sales book. See, in sales book, we will record all credit sales. What is the source for recording? Sales invoice. Next, we will maintain separate book for purchase returns. We will maintain separate record for separate book for sales, purchase returns, sales returns. See, say purchase returns, goods returned to suppliers. For example, when we purchase goods from suppliers and if we return them, so that will be recorded in purchase return journal. Similarly, when you sell the goods, customers may return your goods. So that will be recorded in sales return journal. And see, when on what basis you will record this purchase returns? Debit note. And what basis you will record sales returns? Credit note. See, what is this debit note and credit note? See, simple here. For example, you purchased goods from a supplier. What is the entry you will write? So, for example, purchases account debit to creditor, right? Creditor account is created. Purchases to creditor. Now, creditor account is created because you are due some amount to him. For example, 50,000, 50,000. Suppose you return 10,000 worth of goods. 10,000 worth of goods you have returned back. That means how much amount you due to the creditor? Only 40,000, because 10,000 you return now. So therefore you will issue what? You will issue debit note. So goods returned to supplier, debit notes. So I mean the supplier will issue debit note. Why? Because he in his books, so we are the debtors. In our books, he is the creditor, right? So we need to reduce his balance from our books. He is already credited with 50,000. So in order to reduce 10,000, we will issue a debit note so that his account will be reversed. Similarly, credit notes. See, when you sell the goods, customer account is debited. Now, when he return the goods, his balance has to be reduced. That's why we will give a credit note so that his account balance will reduce. So debit note, credit note. Remember, this can be asked as an MCQ. Debit note will be issued in case of purchase return. Credit note will be issued in case of a sales return. Because in sales returns, we need to reduce the customer account. In purchase return, we need to reduce the supplier account. Supplier is already created. Therefore, we will issue debit note to reduce his account balance. In case of sales return, creditor account is already debited. So in order to reduce, we need to issue opposite. That means credit note. Okay. Bills receivable, we will maintain one separate book for bills receivable. Similarly, we will maintain separate book for bills payable. So details of bills of exchange received by an entity from its customers. What are all the bills we received? So we will maintain a separate book. And for bills payable, whatever the bills we accepted, suppose a supplier draw a bill, we accepted. For that, we will maintain one separate book. So therefore, these are called subsidiary books. First of all, what we are learning? We are learning a chapter called journal. What is journal? Journal is a book where we will record our transactions. Okay, this journal is divided into two types: special journal, general journal. So what is special journal? Special journal is nothing but specific type of transactions will be recorded. This is called subsidiary book. See, for cash, we will maintain one cash journal. For credit purchases, we will maintain one purchase journal. For cash credit sales, we will maintain sales journal. Like for purchase returns, we will maintain one separate journal. For sales returns, we will maintain separate journal. For bills receivable, one journal. For bills payable, one journal. Like this, we will maintain. Suppose all other transactions, apart from the above special journals, they will be recorded in general journal. This is a book of original entry. This is also book of original entry, because first time originally you are recording transactions here. From this is the source from where we will prepare ledger, trial balance, financial statements. That way, this is called book of original entry, in which those transactions are recorded for which no specific day book is maintained. See, for above transactions, we have specific book journal. Suppose if there is any transaction which does not have a specific journal, then we will record it in this general book. And what are the types of entry recorded in journal proper? As a general journal or general proper, both are same only. Opening entries, transfer entries, closing entries, adjustment entries, rectification entries. So remember, MCQ is possible. So what transactions will be recorded in general proper, general book? So opening entries, closing entries, adjustment entries, transfer entries, rectification entries. See, rectification entries, adjustment entries. See, at the end of the year, we will pass some adjustment entries. Closing entries, we will pass some closing entries. Transfer entries from one account to another account. Or for example, from trading account, gross profit will be transferred to P&L account. From P&L account, net profit will be transferred to capital account. And opening entries. So this year closing entries will become the next year opening entries. So these entries, opening entries, closing entries, transfer entries, adjustment entries, rectification entries will be recorded in general book. Okay. And what are the rules of journalizing, sir? See, the process of recording the transaction in journal is called journalizing. And there are two alternatives available. How to record a transaction in a book, in a journal? There are two ways. One is basic principles of accounting, that is rules of debit and credit based on the types of account. We call it as golden rules of accounting. Second, rules of debit and credit based on accounting equation approach. So how we record a transaction in the books, sir? There are two alternatives available. One is recording of debit and credit based on type of account. Second one is recording of debit and credit based on accounting equation approach. And first one we see based on types of account. We know we have three types of accounts. So personal account, nominal accounts, real accounts. So based on that, we will record the transaction. For example, you see, for example, nature of account. personal account. Personal account. So tell me, for personal account, what is the rule? Debit the receiver, credit the giver. Debit the receiver, credit the giver. Receiver account is debited, giver account will be credited. And then next, real account. So real account, what is the principle? Debit what comes in, credit what goes out. Debit what comes in, credit what goes out. Okay. See, all personal accounts will be represented under personal account category here. Real accounts, assets will be represented here. Debit what comes in, credit what goes out. For example, when you receive a cash sales, cash is received, debit what comes in. For example, you paid amount to creditors, cash is going out, credit what goes out, cash account is going out. So therefore cash account will be created like that. So these are the rules. Next, nominal account. What is the nominal account principle? Debit all expenses and losses. Debit all expenses and losses. Always remember, expenses and losses will be debited. Credit all incomes and gains. All incomes and gains will be credited. Debit all expenses and losses, credit all incomes and gains. See, these are the rules of debit and credit by using type of account. So personal account, real account, nominal account. Sometimes we will record a transaction debit and credit based on accounting equation approach. Sir, what is accounting equation? You know, for example, assets is equal to capital plus liabilities. This is the accounting equation, like balance sheet. So in accounting equation, suppose for example, there is an asset. When asset account will be debited? When there is an increase. So debit increase. Whenever there is an increase in asset, debit. When it will be credit? When there is a decrease. When asset decreases, you will credit. And next, liability you take. When liability account is debited, when liability account will be debit, liability will decrease. When there is a decrease in liability, we debit. When we will credit liability account? When there is an increase, because basically liability is having a credit balance. When it increases means we have to credit, further credit it. When there is a decrease, we need to debit. Next, for example, capital, you see, asset to liability, capital. Capital, when we will debit? When there is a decrease in capital, right? When we will increase? When there is a, when we will credit capital account? When there is an increase. When there is a increase. Similarly, any revenue you take. Revenue account is generally when there is a debit, decreases. When revenue decreases, we will debit. You know this. When we will credit? When there is an increase in revenue. Similarly, expenses. Expense you take. When we will debit expenses? When there is an increase. Generally, expenses will be debited when there is an increase. And when expenses will be credited? When there is a decrease. See, this is following which approach? Accounting equation approach. So in order to record a transaction, there are two alternatives available. Either you record a transaction based on type of account, personal account, real account, nominal account. So personal account, debit what comes in, credit what goes out. Real account, debit what comes, personal account, debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. Nominal account, debit all expenses and losses, credit all incomes and gains. Or you record based on accounting equation approach. For example, asset, whenever there is a debit, increase. So credit, decrease. Liability, increase, credit. Decrease, debit. Capital, increase, credit. So understand, by nature, what is that? If you want to increase, again you have to do that nature, debit or credit. For example, capital account by nature credit. If you want to increase, again you have to credit, like that. So this is journal. So it is there as a first chapter. See, first chapter is very, very important here. So that's why I'm discussing everything. Okay. Now come to ledger. See, once we prepare journal, based on the journal, we will prepare ledger. So in ledger, what we do is, we will open an account for each and every component, every item. And whatever the transactions we recorded in the journal, that will be posted here. See, this is a book of account in which transactions are recorded in respect to account after they have been recorded in journal, and we call it as ledger. So ledger is nothing but an account. It is also a book where accounts will be recorded. So whatever we recorded, for example, in journal we record salaries account at or to cash or bank. Now that salary account we will maintain in ledger. It is the final destination of all accounts. All accounts you will see in ledger. That's why ledger is called what? Book of final entry. Book of original entry, journal. Book of final entry, ledger. The process of recording the entry in the ledger is known as posting. Whatever you record in the journal, that journal we will post here. See here, for example, here, suppose I have written one transaction. Salaries, account debit to cash or bank account. Suppose 1 lakh, 1 lakh. This transaction I have recorded. So this book is journal. Okay. Now I will open ledger book. In ledger book, what I will do is, I will see salaries account I will open. Salaries account. In that account, I will record. I will post this. See, salaries account debit to cash or bank, 1 lakh. I will write. This process of recording the transactions in a ledger is called posting. Okay. And this is the basis. This account, what you prepare, this is forms the basis for preparation of trial balance. Okay. Now ledger posting. As and when transaction takes place, it is recorded in the journal and in the form of journal entry. This entry is posted again in the respective ledger accounts under the double entry principle form from the journal. This is called ledger posting. Once first you record in journal, from journal you will post it to ledger. And there are two things here. The rules for writing up of the accounts of various types are asset, increase on the debit side, decrease on the credit side. Liabilities, increase on the credit side, decrease on the debit side. Just now we learned, sir, asset. So increases, whenever there is an increase we debit, whenever there is a decrease we credit. Liabilities, whenever there is a increase we will credit. So whenever there is a decrease, debit. Capital, same as liabilities. Expenses also, whenever there is an increase we need to debit, whenever there is a decrease we need to credit. Incomes or gains. Incomes, whenever there is an increase it will be credited, whenever there is a decrease it will be debited. Okay, so this is ledger. So ledger is what? Is a book where in ledger what we maintain? Accounts. Whatever we written in the journal, that will be posted to this respective accounts. And this is the basis for trial balance. Now come to the trial balance. So trial balance is what? See, it is a document prepared using the balances of ledger accounts after they have been closed. So in ledger, there are different accounts. Each account will be closed and that balance will be recorded in one document. So list of accounts balances will be written. That document is called trial balance. So trial balance, why we will prepare? In order to ensure that there is no arithmetical errors. See, generally when we post entries in the journal, after that we will prepare accounts. From that accounts we will list out the accounts balances in a document. Now, why we will prepare is because we follow double entry system generally. So in order to ensure, is there any arithmetical errors when we are recording the transactions? So trial balance will ensure. If the trial balance tallied means there is no arithmetical errors. The tallying trial balance doesn't mean that there are no errors. There may be errors, but prima facie it indicates that there is no arithmetical errors. And remember, trial balance is not an account. It is just a statement. So many of them are thinking that trial balance is one kind of an account we will prepare. No, trial balance is just a statement. It is not an account, remember. And it is prepared on a particular date, not for a period. For example, like balance sheet, the trial balance is also prepared as on or for a particular date, on a particular date. And the agreement of trial balance is only prima facie evidence of the arithmetical accuracy of the books of accounts, but not a conclusive proof of absolute accuracy. MCQ. So it is not a conclusive proof that there is an absolute accuracy. For example, trial balance tallied. Can I say there are no arithmetical errors? It's only a prima facie evidence to say, but maybe even in spite the trial balance tallied, there may be still errors are there. So it is not a conclusive proof to say that there is a 100% pakka absolutely what we maintained are correct. No, there is no such thing. Next, methods. See, there are two methods for preparing trial balance. Of course, one is total method, another one is balance method. The out of this balance method is very popular. See, first we will prepare journal. From journal we will prepare ledger. In ledger we will maintain accounts. Each account is balanced at the end of the year. That balance we will write in the trial balance, right? But there is another method also, that is total method. No need to do any balancing. Just simply, for example, salaries account is there in the ledger, right? What are all debited to salaries account? What are all credited to salaries account? You just take all this total, debit side total, credit side total in the trial balance. That is called total method. No need to do balancing of the account in the ledger. But balance method, we need to do the balancing, and the balancing figure we will take it in the trial balance. Not that much important, but remember there are two methods: total method, balance method. MCQ. Next, what are the errors which are not identified by trial balance? This is important. Sir, trial balance will not identify certain errors. For example, error of omission or duplication. For example, a transaction is not recorded in the books. So it is not possible to identify whether through trial balance, because even if you miss a transaction to record, the trial balance still tallies. So you may thought the trial balance is tallied. So therefore my answer is correct. Whatever, there is no mistakes, there are no errors. But in fact there are errors. You might completely omitted to record a transaction. Or duplication, same transactions you recorded twice or thrice. So in double entry system, what happens is if the same transaction you write in 2 times, so debit side, credit side, both side it will be posted and trial balance will tally. But there is an error, same transactions recorded twice. Error of commission. See, what is error of commission? See, we wrong amount in the correct account. For example, we paid rent, rent account to be debited. So rent account debited. For example, rent is 10,000, but we debit 1 lakh rupees to rent account instead of 10,000. So error of commission, wrong amount in the correct account. This is not detected by trial balance. How trial balance will detect this? So trial balance is nothing but list out the account balances. We doesn't know by looking at the trial balance is there a correct amount is debited to a particular account or not. We don't know. Next, error of principal. Principally there is some error. For example, capital transactions treated as revenue transaction treated as capital transaction. For example, you purchased an asset but you recorded as sales, you recorded as purchases and you debited to P&L account. That is wrong, na? Because whenever you purchase an asset, that has to be capitalized, that should not be debited to P&L account. So error of principal. Error of original entry, so wrong amount. Transaction itself you recorded with wrong amount, originally itself you have recorded with wrong amount. Next, compensating errors. See, 2 or more mistakes in the books which are result in cancelling each other. So compensate each other. So suppose there is a mistake and this mistake is cancelled by another mistake. So which are compensating with each other. 2 or more mistakes in the books which result in cancellation with each other. So that is called compensating errors. So 2 or more mistakes in the books which result in cancelling each other. Okay. So therefore, these are the errors which are not identified by trial balance. Error of duplication or commission, error of omission, error of principal, error of original entry, wrong amount, or compensating error, 2 or more mistakes in the books which result in cancelling each other. See, 2 or more mistakes. For example, see, I will tell you. Depreciation you recorded, sir. Depreciation account debit to asset account. Depreciation asset account debit to depreciation to asset account. So here depreciation is actually 1 lakh. Okay. But unfortunately, for depreciation is 10,000, you recorded 1 lakh. So that means how much extra you booked depreciation, sir? 90,000. One error. Suppose you done a credit sales. So debtor to sales. See, debtor to sales actually 1 lakh, but you written 10,000. See, here one transaction, instead of booking depreciation of 10,000, you recorded 1 lakh. Therefore, your profit is decreased by 90,000. Right? On the other hand, you made a sales. So, what is the sales amount, sir? Sales amount is actually 1 lakh, but you have recorded 10,000. Or else you can take like this. Sales is 10,000, sir. Actually, you have recorded 1 lakh. See here. 10,000 sales you recorded as 1 lakh. That means here the profit was increased by 90,000. So two or more mistakes, two mistakes. One is depreciation, another one is credit sales in the books, which results in cancelling each other. For example, you see, you have to book a depreciation of how much? 10,000, but you booked 1 lakh. Because of that, the profit is decreased by 90,000. Second one, sales. When you have done a credit sales. Now, because of the sales, actually sales amount is only 10,000, but you have recorded 1 lakh. So therefore, there is an increase of profit by 90,000. One hand, there is a depreciation you have shown more. On the other hand, sales you have shown more. Now, both these are compensating errors. So on one hand, there is a decrease. On the other hand, there is a increase. So both are compensated to each other. Now, how I know by preparing trial balance that there are errors here? Not possible, na? So therefore, these are the things. So journal, ledger, trial balance. Of course, I don't think so. There will be a question, but small MCQs are possible from this part. Okay, very simple. Don't miss this. Now let us discuss another area of chapter number 1, which is cash book. So all cash related transactions we will maintain in a separate book. So this book is recording of only cash transactions. Because cash is such an important item, it is necessary to have a separate book for cash. Now all receipts of cash, payments involving cash are recorded in this cash book. And the pro forma of the cash book is similar to that of the ledger account. How we normally prepare ledger accounts. Similarly, we need to prepare the cash book. Now, one of the important thing is cash book is both book of primary entry as well as book of final entry. See, we will maintain cash book for initial recording of cash transactions. So that's why it is book of primary entry, as well as this cash book is book of final entry also. It acts like a ledger. See, once the transactions are generalized, the next step is what? Preparation of ledger accounts, right? So cash book is both book of primary entry as well as it will act as a ledger. So that's why it is book of final entry also. MCQ, they may ask. So that's why it is called journalized ledger. What is journalized ledger? See, this is called journalized ledger. Because we will journalize the transactions, all cash related transactions, and we will prepare cash book in the form of a account. So that's why it is called journalized ledger. So very simple points relating to cash book. Only cash related transactions we will record in cash book. The pro forma of the cash book is similar to that of the ledger account, and it is both book of primary entry as well as book of final entry. That's why it is called journalized ledger. Now, the most important part is types of cash book. See, depending upon the convenience, depending upon the type of organization, they can maintain cash book. Generally, there are two types of cash book. One is regular cash book, another one is petty cash book. We are going to discuss this petty cash book later separately. So understand there are two types of cash book: regular cash book, petty cash book. Regular cash book is what? See, for the normal course of the cash, for the normal course of the business, whatever the cash transactions involved, for that we will prepare a separate book, which is regular cash book. See, in this regular cash book, there are three possibilities. One is single column cash book, double column cash book, triple column cash book. What is that, sir? Single column cash book and double column cash book, triple column cash book. What is single column cash book? See, single column cash book means only one column for amount column. That is, only cash transactions we will maintain among one column. And in double column cash book, we will maintain cash one column, bank another column. And in triple column cash book, along with cash, bank, we will maintain one more column for discount. So, sir, what type of cash book we need to prepare? We require to prepare single column, double column, triple column. See, depending upon your requirements, you maintain. See, depending upon the information you require, depending upon the control you need to access, you prepare. For example, you are having cash transactions as well as bank related transactions, then you prepare double column cash book. Sir, along with cash and bank, we will give discounts, we will receive discounts from customers, then prepare triple column cash book. Sir, we are a simple small organization, we don't have any bank account, so or we have a banking transactions but very less banking transactions, we will maintain separate account for bank column, bank transactions. Then you prepare simple column, single column cash book for all cash related transactions. So that is also allowed. So regular cash book, see here, single column cash book, double column cash book, triple column cash book. And what is single column cash book? See, these single column cash books, you see particulars column, date column, particulars column, cash column, and similarly date, particulars, cash. See, look at the format. The format is similar to that of the ledger. That's why cash book is called as book of primary entry as well as book of final entry. Journalized ledger. The name came. Why? Because the format of the cash book is similar to that of the ledger. So in single column cash book, date, particulars common. So debit side, credit side. So two sides. Date, particulars. For cash, there is a separate column. Date, particulars, cash, there is a separate column. Sir, what about bank column? There is no bank column in single column cash book. Only cash related transactions we will record. So these are maintained by whom? Small entities. Small entities. These are maintained by small business enterprises where they do not have bank account, which is not possible now. So even how small the business is, today's transactions are happening through bank account only. Of course, if you don't have a bank account, which is very hypothetical, not possible in present day scenarios, if you are doing business, you have to do some transactions through bank account. Having bank account is mandatory, I think. Okay. Anyways, in theory, we will discuss. There is a single column cash book where one column exclusively dedicated for cash transactions. Now, these are generally for small business entities where they do not have bank account. Now come to double column cash book. Along with date particulars, see here, cash we have one column, bank also we have one column. That means when you do any banking transactions, we will record here. Credit side also same. So this is double column cash book. So only thing, the difference between single and double column is one more column extra added for banking transactions, bank column. Now see, in case of double column cash book, the concept of contra entry will come. Sir, what is contra entry? See, for example, a transaction where both cash and bank is involved. For example, cash deposited into bank account debtor to cash. Suppose cash withdraw from bank, cash account debtor to bank. So cash as well as bank, both are affected in a single transaction. Now we call it as contra entry. So when you are writing this entry, we will put C symbol. So that's it. not that much important. So double column cash book. Now triple column cash book. Along with the cash, bank, discount column also we will maintain. Cash, bank, discount column. Now debit side discount column is what? Discount allowed. Credit side discount is discount received, income. So discount allowed, discount received. So discount allowed is our expenses. Discount received is our income. Now see, when you prepare triple column cash book, remember discount columns are not balanced. Like cash, bank columns, you should not balance discount column. What you have to do is this discount, the total will be transferred to the respective discount allowed, discount received, and it will directly go to the P&L account. So that's what I have given here. Discount columns are not balanced. These discount columns are not balanced. And only what discount you will write here? Cash discount is recorded, not trade discount. And for that matter, trade discount will not be recorded in the books. Only cash discount will be recorded in the books. So remember, in the question, suppose if they have given any trade discount, don't consider trade discount, only cash discount you have to record. So that's it. This is the regular cash book. Very simple na? Regular cash book, 3 types: single column, double column, triple column. Single column, cash column will be there. Double column, cash and bank column will be there. Triple column, cash, bank, discount will be there. If you are preparing triple column cash book, will you balance discount column? No. First point. Second point is only cash discount will be recorded in the books. And the single column cash book will be maintained by small business enterprises. In case of double column cash book, contra entry will come. Okay. Now, the most important is petty cash book. See, when there are numerous transactions involving cash, see here, when number of cash transactions are numerous, suppose you are a big organization, you are doing number of transactions in cash. Now tell me, is it possible for a single person to have control over the entire transactions, entire cash transactions? No, the cash handling will not be possible for a single person. So what some of the organization might do is, the cash handling, the responsibility of cash handling will be split between 2 persons or 2 group of people. See, obviously there will be principal cashier, main cashier. He will look after the main transactions, big transactions. But apart from this main cashier, we will appoint a small another group for handling small cash transactions. That person is called petty cashier. The word petty means small. So when there are numerous cash transactions, then cash handling is split between 2 groups. One group handling petty cash transactions. Petty means small cash transaction. And the person who is handling this petty cash transactions is called what? Petty cashier. His name is petty cashier. And one group handling other than petty cash. That means, main transactions, big transactions, huge amount transactions. So these people, this main cashier will handle big transactions, amount wise. And the person who is handling this is called as principal cashier or chief cashier. Principal or chief cashier. He will handle the remaining cash transaction. Okay. Now see, important sir. Sir, what I am discussing is petty cash book. So in case an organization is handling number of cash transactions, cash handling is very difficult for one person to handle. Therefore, the responsibility, it will be split between the 2 groups. One group is petty cashier, another group is main cashier. Now, the petty cash system can be of 2 types. One is impressed system, another one is non-impressed system. What is this impressed system? What is this non-impressed system? I will explain with the help of a example. Look at this example. Suppose you take impressed system. For example, April month. See, main cashier will give some amount to the petty cashier. For example, cashier to petty cashier 1000 rupees given. Okay, this is called impressed or petty cash float. How much is the amount given by main cashier to the petty cashier? 1000 rupees to meet the petty expenses, like for example printing and stationery, so small staff welfare, staff expenses, small expenses, so auto charges, like that, small petty expenses of the organization, petty cashier will handle. For that, main cashier will give him some cash, so he has given 1000 rupees. So this is called petty cash float. Now, out of this 1000 rupees in the April month, he spent some small expenses. Small expenses, he spent 650 rupees. Now you tell me, what is the balance have by the cashier, petty cashier? 350. Now listen, 350. In impressed cash system, whatever the cash he already spent, 650 rupees, it is reimbursed by the main cashier to the petty cashier. Initially, how much given? 1000. Out of that, how much is spent by the petty cashier? 650. How much is the balance? 350. Now, whatever the amount spent by the petty cashier will be reimbursed by main cashier to the petty cashier, 650. Now, the entire balance will become 1000. Now, this is called impressed system. Very easy. You can easily control. You can easily have track record of expenses. And reconciliation is also very easy. See, for example, in case of impressed system, what happens is, suppose I am the petty cashier. You are the main cashier. You gave me 1000 rupees. Okay. Out of that 650 rupees I spend it. Okay. Now 350 rupees is there with me. At the end of the month, what I will do is I will prepare one report. In that report, I will mention that these are the expenses I spent, 650 rupees, and this is the cash left with me, 350. I will give this report to the main cashier. Now main cashier will look after this, and he sees that out of 1000 you spend 650, so he will reimburse back 650 rupees to you. Now tell me, as a petty cashier, how much cash is there with you? Already 350 plus this 650, again 1000. Therefore, in impressed cash system, always you started with the same amount. Suppose, for example, May month beginning, how much cash you have? 1000. So therefore, this system is very easy to track down the expenses, and you can have more control over it. So how much petty cashier is spending? I know, because I am reimbursing. How much amount I am reimbursing? That is the expenses he is spending. For example, 650 rupees he spent, I reimbursed. So every time, whatever the amount I am reimbursing, that much is the expenses he spent. And every time he started with the same amount. So therefore, this system is very easy, and reconciliation is also become very easy. For example, 350 cash is there, 650 is spent, so 1000 rupees. So easily we can track down, easily we can have a reconciliation. So therefore, petty cash system. So tell me, what is this impressed cash system? Impressed system. So petty cash can be maintained under two systems, impressed and non-impressed. Impressed system, so main cashier will give to the cashier one amount. See, initially what happens is, this petty cashier will estimate how much will be my small expenses during the particular month. For example, April month, what will be the expenses? For example, he estimated 1000 rupees. So the cashier will give him 1000 rupees. Now what he estimated 1000. Now later on, suppose when the at the end of the month, he came to know only 650 incurred. No problem. He will give you the report to the main cashier, and whatever the amount he spent, he will reimburse by the main cashier. So again, he started with the same amount as he started with the April month, 1000 rupees. So this is impressed system. So this is one way of maintaining cash book. Another system is non-impressed system. See, non-impressed system, what happens is, here, cashier to petty cashier 1000 rupees given, and he spent 650 rupees. Now how much is their balance? 350. 350 is the balance. Now again, see, at the end of the month, this petty cashier will send the report to the main cashier. Main cashier again will give him 1000 rupees, irrespective of the balance what he had. So every time he will reimburse, every time he will give the amount, one fixed amount he will give. Like for example, 1000 rupees I am giving. April month I given 1000. Out of that he spent 650. Still 350 is there. But again I will give 1000, so that it will become 1350. Now see, this is non-impressed system. That means this system is not that much effective. We don't have control over it. So that's why, so we suggest you to follow this impressed system. Now see, whenever you want to prepare petty cash book, Nana, you have to follow the same format of the single column cash book. So in single column cash book, one column is for cash column, na, cash column. So similarly, you need to prepare petty column cash book. So date particulars cash, date particulars cash. All petty expenses will be recorded in this. Separately, petty cashier has to maintain one's cash book. That is called petty cash book. Now see, some organizations, what they will do is, this petty cash book, they will open multiple columns. For each and expenditure, each and every expenditure, they can open a separate column also. For example, postage, one column, rent rates, taxes, one column, printing and stationery, one column. Like that, for every expenditure, they can maintain one column. Okay, so this is the petty cash book. I think you understood this. Very small, easy topic. So this is the chapter 1 cash book topic. Okay, sir. Now let us see chapter preparation of financial statements of commercial organizations. Very important chapter. You have to do it perfectly. So understand, first of all, this chapter is all about financial statements of non-corporate, other than company, commercial organizations, not non-profit organizations. Non-corporate, other than company, like sole proprietorship, partnership firms, commercial organizations only. They are not charitable organizations. So how they are going to prepare financial statements? If my company, if my business is non-corporate, other than company, and I'm a commercial organization, generally my financial statements include three things. One is income statement, another one is balance sheet, another one is cash flow statement. So tell me, what are the financial statements of a non-corporate commercial organization? Income statement, balance sheet, cash flow statement. Now first we discuss about income statement. Now tell me, every business at the end of the year, they want to know their profit. They want to know how they are performing. For that, they need to know the profit earned or loss suffered. So in order to ascertain the profit, what they will prepare generally? See, they will prepare income statement. So in income statement, there are three components. One is trading account. First they prepare, then profit and loss account, then P&L appropriation account. But remember, this P&L appropriation account is only for partnership organizations. It is not for proprietorship organizations, because in case of sole proprietorship, only one person will be there. So there is no question of P&L appropriation. So in case of a sole proprietorship, we need to prepare only trading and P&L account. Okay. Now income statement includes trading, P&L appropriation. Now let us discuss one by one. Trading account. Sir, why we will prepare trading account? See, ascertainment of profit is divided into two stages. First, we need to ascertain the gross profit or gross loss. Second, we need to ascertain the net profit or net loss. To ascertain the gross operating results, gross profit or loss, we will prepare trading account. So gross profit or gross loss, we need to prepare what? Trading account. Now how trading account will be prepared? See, trading account, so one side, left hand side, right hand side, or debit side, credit side. Now trading account is debited with what? Opening stock, purchases, direct expenses. Credit side, we have sales, closing stock. Now the difference is either gross profit or gross loss. Now for example, take opening stock. See, if you are a trader, you have only one stock. What is that? Finished goods. We call it as stock in trade. That is the only item is opening stock, because he is not a manufacturer. He does not have raw material, work in progress, like that. So therefore, opening stock we will write first. Then purchases we will write. Whatever the items he purchased, goods. See here, opening stock, purchases, sales are relating to goods only. Goods only. What items you are dealing in your business? So, sir, for example, I purchased a building. Can I take in trading account? No. Purchase of building should not be taken in trading account. Trading account reflects the gross operating result. See, that means purchase of goods, sale of goods, those things will be considered. Items relating to sales we will consider. Items relating to goods we will consider here. So purchases. Now from purchases we need to deduct purchase returns, goods withdrawn by the proprietor, any goods distributed as free samples we need to deduct. And direct expenses, all direct expenses relating to the goods. For example, we purchased the goods. Now to bring the goods to our factory, the insurance cost, the freight cost, any unloading cost. So these are all costs which is directly attributable to the goods we will take here as a direct expenses. So understand, trading account is all about the cost relating to the goods. So opening stock of goods, purchases of the goods, direct expenses. Now this side, credit side, we will take sales. After adjusting sales returns, if any sales, any goods are returned by the customer after making the sales, those are deducted. And then closing stock we will show how much worth of stock still is there in the business at the end of the year. Now closing stock, you know how they will be valued, sir? Cost or NRV, whichever is lower. What is the cost of the stock we have? We will compare with net realizable value. If it's sold in the market, how much we are going to get? Whichever is lower, we will consider it. Now once you post these 5 items like opening stock, purchases, direct expenses, sales, closing stock, then close the account, balancing it. So the balancing figure is either gross profit or gross loss. When we will get profit, see, when credit side total is more than debit, that means your sales, your closing stock is more than your direct expenses, your purchases, your opening stock, then we call it as profit, gross profit. Suppose if your debit side total is more than credit, we call it as gross loss. So this is the first step in ascertainment of profit. So income statement, first component, trading account. How we prepare trading account? Opening stock, purchases, direct expenses, debited. Sales, closing stock, created. The balance figure is gross profit or gross loss. Okay. See, once we got the gross profit, the next step is preparation of ascertainment of net profit or loss. To ascertain the net profit, we will prepare profit and loss account. So first of all, whatever the gross profit or gross loss we arrived in trading account, that will be carried forward to P&L account. And then P&L account debit side, we will debit all indirect expenses. The trading account, we will debit all direct expenses. In P&L account, we will debit all indirect expenses. So like for example, salaries, audit fees, insurance, advertisement, repairs and maintenance, etc. These are some examples only. Administration costs, selling expenses, bad debts, any kind of expenses, indirect expenses or the expenses which is not covered in trading account, you debit to P&L account. And then P&L account, any other incomes. So like for example, interest received, rent received, dividend received, commission received, so brokerage received, royalty received, any kind of income you credit to P&L account. So one thing is whatever the gross profit or loss which is transferred from trading account. Second thing is other incomes. These are the two credit items. Now debit items, all indirect expenses. Suppose if there is a loss, that loss, gross loss. Now the balance figure could be net profit or net loss. So suppose if your credit side total is more than debit, we call it as profit. Which profit here? Net profit. So first we have taken the gross profit. From that gross profit to that gross profit, we have added other incomes. And from that, all indirect expenses have been reduced. Then we will get net profit. See, in case of non-corporate organizations, this net profit, we don't show separately. Rather, we will adjust directly to the capital accounts of the proprietor or capital account of the partners. So that's why see capital account. This net profit will be transferred. Either we get a profit or loss, whatever. Either net profit or net loss will be adjusted to capital account only. So this is the second component we will prepare. See, there is a concept called net P&L appropriation account. Sir, what is this P&L appropriation account? See, you got the gross profit, then net profit, then from that net profit, some appropriations, some adjustments may be done. See, these are not expenses, but these are allocations from the net profit what you have earned. And remember what I told in the beginning, this P&L appropriation account is only for partnership firms. And because we are talking about non-corporate organizations, these are not for small proprietorship organizations. So this P&L appropriation account shows what? Appropriation of the net profit. See how net profit is appropriated, allocated, adjusted among partners of a partnership firm. For example, see this P&L appropriation account, I have given the format. First we have taken the net profit from P&L account. So by P&L net profit. Suppose company has transferred from this net profit certain amounts declared as dividend. Now tell me, is dividend is an expense which is debited to the P&L account? No, it is not something we need to incur from our incomes. After getting profits, out of that profit, some profits may be given as dividend. So dividend is not a direct expenses. That's why it is not debited to P&L account. Rather, it is adjusted from the net profit. Similarly, you want to transfer to any reserve. For example, company wants to transfer out of its profits 10% of the profits they want to transfer to some other reserve like general reserve. Now, this transferring to reserve is from the existing net profit, right? So it is not an expense. So it is appropriation against profits. So therefore, these are not expenses. These are adjustments from the net profit, allocations from the net profit, like provision for a tax, any bonus declared from profits. These are all appropriations. We don't show them directly as expenses. And finally, whatever the balance is there, that will be go to capital account of the partner. So I think we have completed the first component. What is the first component in financial statements of non-corporate commercial organizations? Income statement. In income statement, we had what? Trading, P&L appropriation. Trading account, main object is to ascertain gross profit or loss. P&L account, main object is to ascertain net profit or loss. And this net profit or loss is adjusted to capital account. And finally, P&L appropriation account. P&L appropriation account main object is how net profit is appropriated. And this is not for proprietorship firms. This is for partnership organizations. And finally, come to the balance sheet. Now, the next component is balance sheet. See, balance sheet is prepared for what? To ascertain the financial position of the enterprise on a specific date. Generally, balance sheet we will write balance sheet as on 31st March 2024, like that. That means on a particular day, what is our financial position? Financial position means assets, liabilities position. See, income statement is prepared to ascertain the profit or loss, but balance sheet is prepared to show the financial position, to know the financial position. What will be my state of position of assets and liabilities on a particular day, on a particular point of time. And you know how it will be prepared. Balance sheet can be prepared either in horizontal format or in vertical format. So, but in case of corporate entity, it is only in vertical format. But for a non-corporate entities, it is not compulsory. They can either prepare in horizontal format or a vertical format. See, horizontal format is nothing but T-shape balance sheet. One side we will show liabilities, one side we will show assets. You know all very well. See here, this side assets, this side liabilities. And suppose vertical format na balance sheet one after another. First, suppose we show liabilities and we will make the total and then assets. Okay, so balance sheet is prepared to show the financial position, to know the financial position on a particular specified date. Now it is either prepared in horizontal form or vertical format. And now the most important thing is when you prepare balance sheet, for example, you are preparing balance sheet in horizontal format, asset side you are writing. Now which items you will write first? See, here they are saying that items should appear in balance sheet in a specific order. There is a established practice. That practice says first when you take assets, the most permanent assets you show at the top. Like for example, fixed assets, land and building, plant and machinery, furniture and fittings, office equipment. You show all these fixed assets first. These are because permanent, most permanent at the top. And then below that current assets, like for example, stock, debtors, cash, all these items. When it comes to liabilities, first always show capital and long-term liabilities. See here, capital, long-term liabilities top. Below that, other liabilities, short-term liabilities, current liabilities. So remember, when you prepare balance sheet of a non-corporate commercial organization, see, in case of corporate organizations, you don't have the choice because there is a schedule 3 format. According to that format, you will prepare. But we are here talking about non-corporate commercial organizations. We are not talking about commercial corporate organizations. Remember, don't confuse yourself with corporate organizations. We follow schedule 3. Why you are not following? See, that is for only companies. Schedule 3. corporate organizations. Here we are learning about non-corporate entities. So non-corporate entities, they have a choice, either horizontal format or vertical format. And that too, in which order they need to show. The established practices, asset side, first if you show permanent assets, most permanent assets you show first, then current assets. And liabilities also same, capital and long-term liabilities first, current liabilities below. Now this items, how they will appear in the balance sheet, they will appear in the balance sheet in a specific order. Now that will be technically called as marshalling. Marshalling means appearing the items in the balance sheet in a specific order. That is called marshalling. Remember, MCQ may be possible. Okay, I think we have completed the balance sheet. So balance sheet, I think you all know how it will be prepared. One side assets, another side liabilities. So I have not taken the format, so you can easily know this format of balance sheet, how it will be: fixed assets, current assets, this side capital, and current year profit will be adjusted, net profit will be adjusted, and then liabilities. Okay, so the important points I have covered here. If you remember this much, more than sufficient. Now the most important part of this chapter is important adjustments. See, when you prepare trading account, P&L account, and then balance sheet, there are certain adjustments we need to do the financial statements. See, from this chapter, they are going to ask MCQs, and they are going to ask one question. So last time also they have asked one question. So one big question they will ask, prepare financial statements. They may ask, or they may ask 4 or 5 MCQs. And mostly if they ask MCQs, they will ask from what? Adjustments. So there are some important adjustments in this chapter. So I have written a note for it entirely. There are 13 important adjustments. So you have to concentrate well on these 30 adjustments. Listen to me carefully. So here itself you can learn all these 13 adjustments with clarity. First adjustment, closing stock. See, first of all, as far as the closing stock is concerned, first, closing stock. Sir, we know when we prepare a trading account, just now I told you, trading account when you prepare, so we will show credit side by closing stock. So what could be the entry here? What could be the entry? Closing stock to trading account. So whenever in the adjustment they have given closing stock, now you directly credit closing stock to trading account, because closing stock is part of trading account. So what is the entry? Closing stock to trading account. See, if closing stock is given as adjustment, it is given as adjustment to trial balance, then the entity now need to take this closing stock as a part of trading account, and it will be credited to trading account. So therefore, closing inventory, account debtor to trading account. Clear? Next. And closing inventory at the end of the year is our asset. So balance sheet, asset side, current assets. See here, if closing inventory is also shown in the closing inventory is also shown in balance sheet on asset side. So two things you have to remember relating to closing stock. Suppose if you are seeing closing stock in the adjustment, they will give trial balance, and they have given certain adjustments. First adjustments or adjustment they have given closing stock. The moment you see closing stock in adjustment, do one thing. This closing stock you credit to trading account, and this closing stock you take to balance sheet, asset side. That's it. Okay. So balance sheet, asset side, you show closing stock. So this is very simple treatment. Okay. So credited to trading account, asset side, balance sheet. Sir, suppose if closing stock is already appearing in the trial balance, they have not given as an adjustment, then that means what? See, if closing stock is already appearing in the trial balance, it is already adjusted. So no need to adjust again in the trading account. If closing stock appears in the trial balance, means it was already adjusted with purchases. Sir, it is there in the trial balance, means it is already adjusted. Why? Because see, how it will come to trial balance? Only if you make an entry. So if you write an entry in the journal and then it will come to ledger. From ledger to trial balance na. That means if it is appearing in the trial balance, it is already adjusted. So once closing stock is already adjusted with purchases, why again we will take it? So now the purchases given in trial balance are adjusted purchases. See, that means closing stock, if it is already appearing in the trial balance, means it was already adjusted with purchases. Now the purchases which is given in the trial balance, we call them as adjusted purchases. Then closing inventory is not entered in the trading account. Important. Remember, suppose there is a trial balance. In that trial balance, now they have given, in the trial balance, they have given closing stock 50k. Now that means this 50k is already adjusted. So no need to take again. Okay. And it is only shown in the balance sheet. Of course, you have to show it in the balance sheet asset side, because it will be an asset. It will continue as an asset. Suppose if it is appearing in trial balance also, it is an asset. So adjustment in balance sheet will not change. It will be shown as an asset. So what is the adjustment for closing stock, sir? Tell me. If closing stock is given as adjustment, recollect, closing stock given as adjustment, what you do? Credit to trading account. Asset side, balance sheet. That's it. If closing stock is already appearing in the trial balance, that means it is already adjusted with purchases. Now, is there any adjustments again we need to do? Purchases already it is adjusted. So no need to do any adjustment. I mean, no need to take it in the trading account. Whatever the purchases which is given in the trial balance is an adjusted purchases. It is already including the closing stock. Okay. But asset side of the balance sheet will continue as it is. Very simple adjustment. Yes. Next. Second, outstanding expenses. Listen, what is outstanding expenses? Expenses incurred but not paid in the current year. Suppose, for example, rent. The moment the month expired, for example, February month over. Now, February month rent already accrued, incurred, but we have not paid it. So that is called outstanding expenses. So at the end of the year, you have to see during the year what are the expenses we incurred but not yet paid in the cash, not yet paid. Those are called outstanding expenses. Now, simple. If outstanding expenses is given as an adjustment, this much is the outstanding expenses. That means what? This expenses already incurred in the current year but not paid. Therefore, you need to make an adjustment entry that with corresponding expenses, you will add these expenses. Corresponding expenses, you will add these expenses. And whatever the outstanding expenses is there, that will be shown on the balance sheet liability side. Balance sheet liability side. So if outstanding expenses given in the adjustment means add to the respective expenses balance sheet liability side, because it is not yet paid. Anything not paid at the end of the year is our liability. And then it is part of current year expenses, because in accounts we follow accrual concept na. The moment expenses incurred, we will take it. Whether we paid or not, that's not matter here. So the expenses incurred. So incurred means it is part of current year expenses, but it is given in adjustment. That means it is not included in the current year expenses. So add it now. For example, salaries outstanding they have given, wages outstanding they have given. Simply add to the wages. Whatever the wages appearing in the trial balance, to that this outstanding wages you add. That means what is the entry we are writing? See, we are increasing the respect to expenses. So expenses account debtor to outstanding expenses. See, this is the adjustment entry here. Expenses account debit to outstanding expenses to outstanding expenses. That means the corresponding expenses we are increasing. For example, salaries. Okay, given 1 lakh in the trial balance. In adjustment, they have given 10,000. Now, what you need to do? 10,000 you should add. That means your salary expenses will be 1,10,000. Because this 10,000 is also incurred during the year, so it should be part of current year profits. Sorry, it should be part of current year expenses. And this 10,000 not yet paid na. So therefore, what we need to do? Outstanding expenses means liability, balance sheet liability side. That is what they given. See, if outstanding expenses given as adjustment, then it is added to the relevant expenses in P&L. What is the entry? When you increase the relevant expenses, expenses account, respect to expenses account debtor to outstanding expenses. And the outstanding expenses will be shown under the liability side. Suppose, sir, if this outstanding expenses is already there in trial balance, that means it is already adjusted. already adjusted to the respective expenses account, no need to adjust again. Therefore, simply show balance sheet liability side. See, if outstanding expenses given under trial balance, then it is shown under liability side only. Like how closing stock is already appearing in the trial balance means no need to take again in trading account. So here also see, whatever the item which is already appearing in trial balance means it is already adjusted. Don't do any other adjustment. Simple. So this is outstanding expenses. So whenever you see outstanding expenses, what you see? Expenses incurred but not paid. Not paid means it is liability. Expense already incurred means it is part of current year expenses. So add to the respective expenses. Now come to prepaid expenses. Sir, what is prepaid expenses? See, simple. Prepaid. That means paid in advance. That means any expenses we paid, but benefit will accrue in the subsequent accounting period. Subsequent accrued accounting period, the benefit will come. Not now. That means we paid expenses, already we paid during the year, but that is not belongs to this year. For example, insurance premium. Next year insurance premium is also we paid in the current year. That means you paid premium, but the benefit of insurance coverage will be for next year, because this premium belongs to next year premium, next year. So therefore they call it as prepaid expenses. Prepaid expenses means expenses you paid in advance, but those expenses actually you have not received any benefit relating to those expenses, or you are going to receive the benefit in the subsequent accounting period. Or we can put it like this: expenses paid but not incurred. Those expenses actually not incurred. Even if suppose this insurance premium you can pay in the next year, you can pay in the next year, but you paid this year. Okay, so that means, can you tell me, when you paid something without actually it is not incurred, is it part of current year expenses? Simply because you paid means it should be considered as an expense in the accounts? No. In accounts we will consider expenses only when we incur them. Only when we incur. So expenses not yet incurred, the benefit not yet received, it is going to be received in future. Therefore, what we need to do, the prepaid expenses, what we paid, is to be reduced from the corresponding expenses. So if prepaid expenses given as adjustment, then it is reduced from the relevant expenses. For example, insurance premium, we paid 1 lakh. Out of 1 lakh, 50,000 is belongs to next year. Therefore, you reduce 50,000 from this 1 lakh. You reduce 50,000 from this 1 lakh. And this prepaid expenses is shown on the asset side. Like how outstanding expenses is my liability, na? Prepaid expenses means my amount is there with other parties. Even without incurring any expenses, I paid it. So at the end of the year, that is my balance with outstanding, balance amount with others. So it will be my asset. Suppose if prepaid expenses is already given in trial balance, don't do any adjustment. Don't reduce from corresponding expenses, just to show it on the asset side of the balance sheet. And what is the adjustment entry? For example, what is the adjustment entry for outstanding expenses? Respective expenses to outstanding expenses. Now, here we are reducing the expenses. So expenses will be credited. Respective expenses will be credited. Prepaid expenses will be debit. So prepaid expenses to respective expenses. Okay. Next, fourth item, accrued income. Sir, what is this accrued income? Very simple. Accrued income means income earned but not received during the current accounting period. Now see, outstanding expenses, prepaid expenses. Expenses over now. Now come to incomes. Income earned sufficient. If it is earned, it is part of current year income, even though it is not received during the current accounting period. So if any incomes you earned, any accrued incomes, if it is given as an adjustment in the trial balance, that means it is part of current year income. So what we need to do, we need to add to the corresponding incomes. We need to add to the corresponding incomes. So, and we will show it as a asset in the balance sheet, because it is income. Income means receivable. So it is part of our assets. Here, if accrued income given as adjustment, then it is added to the relevant income in P&L, and accrued income is shown on the asset side. What is the entry? Here we are increasing our incomes now. So income means credit balance. So to credit incomes, respective income. Debit will be what? This one, accrued income. So accrued income to respective income. See, you have to see whether you are increasing the income or decreasing the income. Expenses, whether you are increasing or decreasing. For example, if you want to come to first expenses, outstanding expenses means you are increasing the expenses. So therefore expenses, respective expenses account will be debited. Outstanding expenses will be credited. In prepaid expenses, you are reducing the expenses. So expenses account will be credited. Respective expenses account is credited. Prepaid expenses is debited. Similarly, when it comes to incomes, when you earn income, so that means you have to increase the current year income. So how can you increase the current year income? Income is obviously having credit balance. If you want to increase, again credit it. So respective income, and which account will be debited? Accrued income. So accrued income account debtor to respective income. And if it is already given in trial balance, that means accrued income is already included in the respective income. Again, don't include, just to show it in the balance sheet asset side. That's it. Next, suppose sir, sometimes you receive income in advance. Income received in advance. See, for example, see, customer, even though you have not supplied the goods, he has given the advance. You received it. So income received in advance. That means, see, income received but not earned. From your point of view, when you make the actual delivery, that will be your income. But you have not delivered the goods, but you have received the amount from the customer. So that is called income received in advance, but not earned. See, in accounts, we follow accrual concept. Only when you earn, we will recognize as current year income. But still, you have not earned it, but received it. Therefore, it is not part of current year income. So what we need to do? We need to reduce from corresponding incomes. So when you want to reduce, the income account will be debited. So respective income to unaccrued income. Unaccrued income means income received in advance. Income received but not earned. So if it is given in trial balance, adjustment, sorry. If income received in advance is given in adjustment, what we do? We need to deduct from the relevant income. And this income received in advance, we will show it as liability. Liability, because advance received from customer is a liability. Without earning, you are received. So therefore, at the end of the year, whatever the amount is there in the form of advance, it is liability. And if it is already there in trial balance, means it is already reduced from corresponding income. Therefore, no need to adjust again. Just you show it on the liability side only. Okay, this is one adjustment. So I think these four are very, very important. Outstanding expenses, prepaid expenses, accrued income, income received in advance. Now, goods sent on approval basis. See, sometimes as a seller, I will sell goods on approval basis. That means I will send the goods. Only if the customer makes the approval, I will treat them as actual sales. Suppose if any goods are sold on approval basis, and at the end of the year, still no approval has been received. So what we need to do? See here. There are two situations here. First is, we send the goods on approval basis. Customer accepted the goods, made an approval. He accepted. See, the approval is received before the end of the financial year. We received the approval. See, when we receive the approval, definitely we will treat them as normal sales. So what is the entry for normal sales? So sales, debtor account debtor to sales. Debtor to sales, normal credit sales entry. Debtor to sales. So when goods are sent on approval basis, and at the end of the year, by the end of the year, we received the approval. Simply recognize the sales as current year revenue. Therefore, debtor account debtor to sales. This is the entry you will write. See, sales to debtor at a selling price. At what price you sold? That price. Okay. So that is what I have written. If approval received before the end of the financial year, or the reasonable time period expires. So for example, you send goods on approval basis, sir. The reasonable time period is 3 months. So 3 months expired and he has not confirmed anything. That means it's a deemed approval. Therefore, you can recognize them as sales and treated as sales added to the current year revenue. Okay. Now come to the second situation. Sir, we send the goods on approval basis. No approval has been received, or reasonable time period not expires by the end of the year. So at the end of the year, there are certain goods we sold on approval basis. Customer has not approved anything, or reasonable time period also not expired. Then what to do? See, then in such a situation, simply treat the whatever the stock is there with our customer is our stock laying with the customers. Now include it as a part of your closing stock. For example, see here, your Mr. A, your customer is Mr. C. You send goods to Mr. C on approval basis. Now at the end of the year, you see whether any confirmation received? No. Is reasonable time period expires? No. Therefore, in such a situation, you cannot treat it as sales. Rather, what you need to do is, whatever the stock you send to him on approval basis, treat them as your stock laying with your customer. The stock which is laying with the customers. Therefore, you show it in your books as your closing stock. But remember, the most important point is, when you value the stock, at what price you will value? Cost or NR, whichever is lower, na? So therefore, here you need to take it at a cost. See, important. This is the main point. when you recognize the sales, you recognize the sales at selling price. But when you treat them as part of your stock, you have to value them at cost. So remember, this will be your stock. And what is the entry? Stock with customers to trading account. Generally, whatever the closing stock is there, we will credit to trading account. Na? So that is what we need to do. See here. Treat it as stock laying with customer and shown in closing stock. So remember, this is very, very important. So tell me, any goods sent on approval basis, and there are two possibilities. By the end of the year, you received approval, reasonable time period expires. Treat them as normal sales. Write an entry, debtor to sales at selling price, over, including the current year revenue. Now, second possibility, you send the goods on approval basis, no confirmation received, reasonable time period is also not expired. Then you treat the stock, what is there with your customer, as your stock laying with the customers, and you treat them as part of your closing stock. So trading account you credit, buy stock with customer. But remember, when you are valuing the stock, you have to value at a cost. Next, sometimes goods may be distributed as free samples. See, suppose for example, company may distribute for promotion. So free samples, certain goods have been given as free samples. Whenever any goods are given as free samples, what is the entry? Whatever the worth of the goods we are giving, sir, it is like advertisement only, advertisement cost. So advertisement account debtor, and we reduce this stock from purchases. See, advertisement account debtor to purchases. Advertisement to purchases. Remember, advertisement to purchases. When the goods are distributed as what? Free samples. When goods are distributed as free samples, advertisement account debtor to purchases, because it's a sales why we will give free samples, sir? To promote our business. So therefore it's an advertisement cost, and we will reduce from purchases. Why? Because our stock has been reduced now. We are giving away free samples, so our worth of stock has been reduced from the business, so purchase account is created. Now sometimes the goods may be distributed as free samples to employees. See, when it is given as free samples to employees, what we need to, instead of advertisement, we will debit to salaries or wages account debtor to purchases account. Next, goods withdrawn by proprietor. See, sometimes the proprietor of the business will withdraw the goods for his personal purpose from the business. In such a situation also, what we need to do is, we need to adjust directly this goods withdrawn from his capital account. So we will treat it as what? Drawings. So drawings account debtor to purchases account. So remember, purchases account is commonly created when goods are distributed as free samples or when goods are withdrawn by the proprietor. Okay, so drawings to purchases. And come to depreciation and amortization. So this is also one of the adjustments, sir. Sir, depreciation and amortization, you know, sir. Depreciation is generally provided for what? Tangible fixed assets. Amortization is provided for what? Intangible fixed assets. So tangible fixed assets, intangible fixed assets. So whenever we provide any depreciation account debtor to fixed asset account. Whenever we provide any amortization account debtor to fixed asset account. This we know. And next, abnormal loss of stock. See, most of the students will confuse here. I will throw some light on it. See, important, remember. Abnormal loss of stock. First of all, there are two types of losses for the stock. One is normal loss. Another one is abnormal loss. What is normal loss, boss? Normal loss means due to the inherent natural characteristics of the product may lose its value. Like for example, evaporation. Some of the liquid items will evaporate. So that is their natural characters. For example, you take vegetables, so milk, all these are perishable items. So the moment after 4 days, 5 days, 1 week, they naturally perish, right? Their value will be decreased. Because of its natural characteristics, that the goods may lose its value. That is called natural loss. Can you control natural loss? Obviously no. So the practice is, when there is a normal loss, no need to recognize it separately. And whatever the loss is there, let it be included in the worth of other stock. So no need to recognize normal loss separately. So remember, there is no accounting treatment for normal loss. That means we don't want to make separate entry for normal loss. That's why you don't see anywhere the entry for normal loss. Because whatever the normal loss happened, that normal loss will be inflated with the remaining stock. For example, we have 100 units. Out of 100 units, 5 units lost by normal reasons, normal loss. Now that means, what is the remaining stock? 95 units. Now whatever the cost we incurred, that cost will be equated with 95 units. That means the normal loss is also included as a part of the cost of the remaining good items, good stock. Okay, so remember, simply the stock can be There are two types of loss, normal, abnormal. Now come to normal loss, no treatment. Now come to abnormal loss. Sir, what is abnormal loss? Avoidable loss. Avoidable loss. Avoidable loss means, see, due to the negligence, due to the carelessness, so there are certain times the goods may lose its value. But maybe, for example, accident, maybe because of fire, maybe because of any proliferage, maybe because of any theft. Because of these reasons, the stock may lose its value. A certain worth of stock may be loss for the organization. See, simple. Whenever there is a loss, Nana, whatever the worth of goods lost, okay, credit to trading account. So the entry is loss of stock to trading account. Suppose, for example, here 10,000 worth of goods are destroyed by fire. So this 10,000 you credit to trading account. You credit to trading account. So loss of stock to trading account. Sir, why we are crediting to trading account? Indirectly, what we are doing is this loss we are deducting from our existing stock. See, generally, if you prepare trading account, opening stock, purchases, so it will be there, opening stock, purchases, from that stock only, na? So there is a loss. So therefore, this loss of stock we credit to trading account. Indirectly, we are reducing from the existing stock. Okay, so that is the first entry. Whatever the worth of goods we lost, so credit to trading account. So what is the entry? Loss of stock by fire, or whatever the reason, loss of stock, account debtor to trading account. Or you can write abnormal loss to trading account also. Anywhere you see abnormal loss account debtor to trading account, don't confuse abnormal loss. Some people call it as loss of stock. Some people call it as loss of stock by fire. If the fire is the main reason, like that. I have written here loss of stock to trading account. How much? 10,000, 10,000. This will be one thing. Second thing. Generally, what happens is, in case of stock, we have insurance. In case of stock, we have insurance. So, out of the loss, some of the amount may be admitted by the insurance company as insurance claim. For example, out of 10,000, 60,000 is claim admitted. That means 6,000 we are going to recover from the insurance company. And what is the irrecoverable portion? 4,000. Now, this 4,000 irrecoverable portion, we need to treat it as loss, business loss, and we need to debit to P&L account. And whatever the 6,000 we are going to receive from the insurance company, write a due entry like insurance company account debtor to loss of stock. So this 6,000 will be appear in the balance sheet asset side because this is going to be received from the insurance company. Once again, I am telling, sir, whenever there is an abnormal loss, the entire loss credit to trading account. First step. Second step, if there is an insurance, out of this 10,000, out of this abnormal loss, how much amount we are going to receive from the insurance company, debit to insurance company account, credit will be given to loss of stock. 6,000 in this case. And this insurance company account is nothing but the amount due from insurance company. So therefore, this 6,000 will appear in the balance sheet. And whatever the irrecoverable portion, what is irrecoverable portion? What is the total loss? 10,000 minus what is the insurance claim? 6,000. What is the irrecoverable portion? 4,000. That 4,000 you debit to P&L account. I think you understood this. See this example carefully. Now comes the next part, bad debts. See, very simple treatment here. Why I don't know, so many students are confusing. Just listen to me carefully. See, first of all, bad debts. The moment the debts are not collectible, irrecoverable, treat them as bad debts. See, there is a difference. There is a difference between doubtful debts and bad debts. Students are confusing. See, doubtful means what? Doubtful means, and bad debt. See, doubtful means we are doubtful whether amount will be collected or not. We have a doubt. Still, we don't know the position. Just we are estimating or we are predicting that out of this amount, some amount may be doubtful. For example, our debtors total 10 lakhs. 10 lakhs. Now we may have a doubt that, see, out of this 10 lakhs, 2 lakhs may not be recovered. Doubtful only. Whether it will be actually recovered or not, we don't know. As of now, I am doubtful. But bad debts means what? Impossible to collect. They already become bad, irrecoverable. So therefore, this bad debts is a business loss. Straight away you debit to P&L account. Okay, so understand, the moment you see the word bad debts, it is a business loss. See, treat it as a business loss. Debit to P&L account. So it is irrecoverable from debtors. Doubtful word you see, that is a different treatment. The moment you see bad debt, debit to P&L account. So what is the entry for bad debts, sir? You know, bad debts to debtors. because debtors amount will be reduced because of the bad debts. For example, total debtors 10 lakhs. Out of that 2 lakhs is a bad debt. So 2 lakhs account, 2 lakhs bad debts to debtors. Now these bad debts you transfer to P&L account. That's it. Now come to provision for doubtful debts. So bad debts I explained. Bad debts means irrecoverable portion, impossible to collect. So therefore you straight away debit to P&L account. What is the entry for bad debts? Bad debts to debtors, and this bad debts will be transferred to P&L to bad debts. Now provision for bad debts. Sir, what is this provision for bad debts? Provision for doubtful debts. See, simple. See, just now I told, I have a doubt whether this amount will be collected or not. For example, out of my total debtors, I have a doubt that 2 lakhs may not be collected. Doubtful. Okay. When you have a doubt, what will you do? Simple. You ready. You prepare yourself for the loss, because you are thinking, you are anticipating that maybe out of the total debts, some of the portion is doubtful. See, when you are doubtful, do one thing. Create a provision. In accounts, we have a provision. Create a provision from profits. Separate some of the profit for this loss. So you create a provision. See, debts which are doubtful to realize, not yet become bad, they are only doubtful. Now provision to cover the loss of possible bad debts. So you create a provision. Generally this provision is created as a prescribed percentage on debtors. Now the question is on which debtors? Only see net debtors. Debtors minus bad debts. Because see, bad debts, already debts become bad means they are not doubtful, na? They already become bad debts. So from the total debtors you reduce bad debts. Whatever the remaining debtors is there, on that you apply certain percentage. See, some companies follow 2.5%, some companies will follow 5%. Like that, out of the profits, out of the debtor, certain percentage they will create a provision. P&L account debtor to provision for doubtful debts. So this provision will be debited to P&L account, and this provision for doubtful debts, what we do, we deduct from the particular customer account, a debtor's account in the balance sheet. That means indirectly what we are saying is, see, out of this, this much of debtors, see, this is our doubtful portion. Suppose 2 lakhs is our doubtful amount. We created a provision by debiting to P&L account. Indirectly debiting to P&L account means we are reducing from the incomes now. That means from P&L account we are separating certain portion to provision in the form of provision for doubtful debts 2 lakhs, and later on this provision will be adjusted against actual bad debts, actual loss. So understand the difference between bad debt. See, when it is become bad, there is no question of provision. It is already become bad. So it will be your business loss directly debited to P&L account. Now come to doubtful. It is not bad, but we are doubting whether it will be collected or not. Do one thing. When you have a doubt, create a provision from the profits. How? P&L to provision for doubtful debts. On what portion? On net debtors. What is net debtors? Total debtors minus bad debts, because bad debts portion is already irrecoverable. On that, how can you create a provision? We create provision for the future debtors. Already it becomes bad debts. That means no need to create. That portion should be eliminated. Hope you understand it. So P&L account debtor to provision for doubtful debts. Next, provision for discount on debtors. This is also very simple. See, we sold the goods to our customers. We want our customers to make the payment in time. So tell me, in order to encourage the customers to make the prompt payment, we will give what? Discount. Discount we will give now. Now that discount is a kind of a loss to us. Why can't you create a provision for that? That's the idea. See, for example, I am the seller, you are the buyer. Now I told you that if you make the payment within 45 days, I will give 5% discount. Now that means to encourage you to make the payment within 45 days, I am giving 5% discount now. So therefore, some of the customers may pay within 45 days, some of them may not pay. Suppose if they pay within 45 days, they will definitely claim discount. So that discount is my loss now. For that you create a provision. So understand, you create provision for discount on debtors on which portion? Only the good debtors. Because the debtors which are become doubtful or the debtors which are already bad, they are not going to make the payment. Therefore, when you create a provision, you have to create a provision for discount on debtors. You create provision on good debtors. What is good debtors? Take total debtors. From that, any additional bad debts, any provision for doubtful debts, you remove it. Only remaining debtors, on that you apply the provision. So whatever the discount you are going to give. See, generally discount allowed. will be debited to P&L account. That will be your business loss. And you create a provision generally. See, when you create a provision, P&L to provision for discount on debt. And last one, any goods in transit at the end of the year. See, goods in transit is our loss, our stock only, na? So trading account will be created, goods in transit account will be debited. Like how when we sold goods on consignment, approval basis, whatever the still approval is not received at the end of the year and the reasonable time period is not expired, we will treat that as part of our stock. We created to trading account. So the moment you see on the trading account credit side, stock laying with consignee, stock laying with customer, goods in transit, that means they are your stock only, but not part of current year income. But we have to treat them as part of our closing stock. So that's it, sir. These are all adjustments I have explained. So this is chapter number 1. Sorry, this is chapter for financial statements of commercial organizations. Hope you enjoyed it and please see it carefully. Thank you. Now let us see the preparation of financial statements of non-profit organizations. So what is non-profit organization? A non-profit organization is an organization whose primary object is providing some kind of service to the society or the particular class of members, whose main objective is not to earn profit. Suppose if you take a commercial organization whose main objective is to do some kind of commercial activity and earning profit is the main motive. But in case of a non-profit organization, earning profit is not the primary objective. So which is primarily formed with the object of offering some specific services to the society and not with the profit motive. They are called non-profit organizations. Now see, if you are a non-profit organization, how financial statements will be prepared? So that is what this chapter is all about. So non-profit organization can be a charitable trust or can be a society or can be a trade union or can be a association of persons, body of individuals, or maybe a social club or maybe a cultural club or maybe a hospital or maybe a educational institution. Anything can be. So a non-profit organization, we have to see the bylaws of the organization, whether the purpose of forming that organization is to earn profit or not. We have to see. If it is not for the profit motive or for some kind of service to the public or to the members, then it will be considered as non-profit organizations. See, since non-profit organizations are main objective is not earning profit, they will not prepare trading and P&L account like commercial organizations. Instead, they will prepare income and expenditure account. So remember, this is the main thing. So non-profit organizations will not prepare trading and P&L account because their object is not to earn profit. So what they will prepare is they will prepare income and expenditure. See, in case of a commercial organization, if you prepare trading P&L account, you will get what? Net profit, right? Or net loss. In case of a non-profit organization, if you prepare income and expenditure account, we will get surplus or deficiency. Surplus or deficiency. So understand, if you are a non-profit organization, there won't be any net profit, there will be surplus. There won't be any net loss, there will be deficiency. When your expenditure is more than income, then we say there is a deficiency. When your income is more than deficiency, we call it as surplus. Because since these non-profit organizations are formed not for the purpose of earning profit, so there is no question of net profit or loss. There is only a question of surplus or deficiency. So if the incomes are more than expenditure, surplus. If the incomes are less than the expenditure, deficiency. So what are the financial statements of non-profit organizations? See, generally, as far as the financial statements of non-profit organizations is concerned, we will prepare three things. One is receipts and payments account. Another one is income and expenditure account. Another one is balance sheet. See, this balance sheet is common, whether you are a commercial organization or non-commercial organization, balance sheet is compulsory. Next, trading and P&L account is compulsory for commercial organizations. Commercial non-corporate organizations, trading and P&L account is prepared. Suppose if you are a non-profit organization, instead of trading and P&L, you will prepare income and expenditure account. I told you the reason also, because our object is not to earn profit. So therefore, we will prepare income and expenditure account, and the result of that income and expenditure account is maybe a surplus or maybe a deficiency. And see, these non-profit organizations will also prepare an account called receipts and payments account. So now I am going to discuss one by one. So first, receipts and understand the financial statements of a non-profit organization. Three things. So receipts and payments, income and expenditure, balance sheet. Actually, these two are important: income and expenditure and balance sheet. Okay. Now first, let us discuss about receipts and payments. See, every non-profit organization will prepare one receipts and payments account. It is like a cash book where all receipts, payments, inflows and outflows of cash will be there in this receipts and payments account. Irrespective of the nature of the receipt, irrespective of the periodicity of the receipt, if it is received or if it is paid during the current financial year, we will include in the receipts and payments account of this year. For example, we purchased a building, outflow, so it will be payment side, receipts and payments. See, this is a receipts and payments account. Every non-profit organizations will prepare receipts and payments account for every year. One side we write all the receipts, another side we will write all the payments, receipts and payments. And there will be opening balance, all the receipts minus all the payments. Then you will have a closing balance. So that's why I said it is similar to cash book. Opening cash balance, receipts of cash, payments of cash, closing cash balance. Like that, we will prepare receipts and payments account. Because see, non-profit organizations, whatever the receipts they are receiving during the year, whatever the expenditure, whatever the payments they are making during the year, and what will be the available cash with us. So in order to track down all these things, in order to have control over our cash, receipts and payments, generally they will prepare this receipts and payments account. And what is the nature of this receipts and payments account? It is like a real account. What is the principle of real account? Debit what comes in, credit what goes out. That's it. Whatever is coming, receipt side. Whatever is going, like payment side. But remember, it should be in the form of cash. Then only it will come in receipts and payments account. So very simple, similar to cash book. If you see here, see receipts and payments account, receipt side, payment side. It is always starts with opening balance. First you write the opening balance of cash, bank, everything. All receipts, whether they are capital or revenue, there is no need to distinguish because this is not income and expenditure account. Suppose if you are preparing income and expenditure account, or if you are a commercial organization, if you are preparing trading and P&L account, we will make a distinction between revenue and capital, because revenue items will come in P&L account. Capital nature items will come in balance sheet. Similarly, for a non-profit organization, when you are preparing income and expenditure account, we should make a distinction between revenue items and capital items. But see, cash book, receipts and payments account does not have any difference. Whether it is a revenue receipt, capital receipt, everything will be recorded. Revenue payment, capital payment, everything will be recorded if it involves inflow or outflow of cash. So opening balance you take all the receipts, whether capital nature, revenue nature. And next, may be related to any period, previous, current or subsequent. For example, last year amount received during this year, no problem. Received this year, na cash balance increase, na receipt. Suppose last year payment made in the current year, payment side you have to show. You cannot say, sir, this item belongs to last year, sir. See, when you are preparing cash book, there is no distinction whether there is inflow or outflow in the current year or not. We have to see that only. What is the nature? What is the timing? We are not bothered. Whether this year there is a receipt or payment, then you will put it in the receipts and payments account. If it is a receipt side, payment side. All payments, capital nature, revenue nature, and ends with closing balance. I think this is very, very easy. So when you are preparing receipts and payments account, simple, remember the cash book or cash account. Opening cash balance you take. All receipts you take. Whether they belongs to previous year or whether they belongs to future years, doesn't matter. For example, prepaid expenses. You paid expenses during the year, take it. Sir, these expenses belongs to future, sir, next year, sir, but we paid this year. So in receipts and payments account, it will come, because we have to see whether there is inflow or outflow. Sir, last year amount received during this year, sir, you have to write in receipts and payments account. So whatever be the nature, whatever be the period, you write in the receipts and payment account. So this is the first component we prepare for a non-profit organization. So that's why this is a summarized form of cash book of a non-profit organization. Entries are made on cash basis, and items pertaining to previous year or current year or subsequent year are also recorded. It is a memorandum account in which receipts are shown on left side and payments are shown on the right side. See, on one hand we have to show the receipts, on another hand we have to show the payments. Capital as well as revenue items entered in the receipts and payments account. This is called real account in nature. I told you. Debit what comes in, credit what goes out. So what is coming in, what is going out. Whatever is coming in the form of cash, receipt side. Whatever is going, payment side. And this account begins with opening balance of cash and bank and ends with the closing balance of cash and bank balance. So this is a summarized cash book of non-profit organization. Now the most important is this one. Sir, every non-profit organization, they will prepare income and expenditure account, sir. It is like a P&L account for a commercial organization, where we will write all incomes and all expenses. Finally we will get net profit or loss for the period. Similarly, if you are a non-profit organization, you will prepare income and expenditure account. Remember, when you are preparing income and expenditure account, you have to prepare on accrual basis. Normal P&L account, how you are preparing, similar to that you have to prepare. But receipts and payments, you prepared on cash basis. But this is not on cash basis. This is just like a P&L account. So whatever the incomes earned during the year, whatever the expenses incurred during the year, we have to write. So this is the income statement of non-profit organization. As the name suggests, only revenue items, that is revenue incomes and revenue expenditures, are recorded. It is by nature nominal account. Debit all expenses and losses, credit all incomes and gains. Sir, when you prepare P&L account, generally I think you consider only revenue items, na sir. Similarly, for a non-profit organization, if they are preparing income and expenditure account, they will consider only revenue items in the income and expenditure account. But if they are preparing receipts and payments nature is cash. They are preparing on cash basis. So therefore, whatever be the nature, we will record it. But here in income and expenditure, we will record only revenue nature items. Suppose, for example, any revenue expenses, like for example, non-profit organizations paid rental expenses. So non-profit organizations may paid some salaries. So like that, they are all revenue expenditure that will be debited to the P&L account, debited to income and expenditure account. And both incomes and expenses must be taken on the basis of accrual concept. Remember, income and expenditure is like normal P&L account, how you are preparing, accrual basis. This account should reflect only items that are pertaining to current year. Only current year. See, when you are preparing P&L account for 23-24, year 22-23-24, you will consider only the incomes and expenditure belongs to this period in the P&L account. Similarly, if you are a non-profit organization, same rule will be applied. Whatever the year you are preparing income and expenditure account, in that year, what items are there, and that too revenue items you will consider. And finally, you write all your incomes, all your expenses, then you will get the balance, either a surplus or deficit. When we say there is a surplus, excess of income or expenditure is called surplus, and excess of expenditure over income is called deficit. See, look at this format, very simple format. Remember, income and expenditure account, it is like a P&L account of non-profit organizations. If you imagine the P&L account, one side we have expenses, other side incomes. So expenses, only revenue expenses you take, only relating to the current period you take. Income side you take, only revenue receipts you take, only related to current year you take. So if income is more than expense, we call it a surplus, otherwise there is a deficit. As simple as that. So there is no confusion, there is no room for confusion here. Simple. Income and expenditure account is like a P&L account. Like how we prepare P&L account on accrual basis, we consider only revenue items, only items belongs to the current year we will consider. So therefore, if I could tell you the reason for differences between receipts and payments and income and expenditure account, can you tell me the differences? Receipts and payments account is prepared on which basis? Cash basis. Income and expenditure, accrual basis. Receipts and payment account will consider both capital as well as revenue receipts and payments. But income and expenditure consider only revenue items, revenue incomes, revenue expenditures. Receipts and payments account will consider payments and receipts of all the periods, current year, previous year, future years. But income and expenditure consider only expenses or only revenues of the current year, like how normal P&L account is prepared. So non-profit organizations will prepare what? To ascertain the surplus or deficiency. Surplus or deficiency will be ascertained through income and expenditure account. And non-profit organizations will prepare what? To have control over cash receipts and payments. Receipts and payments account. Next balance sheet. Sir, suppose you take a commercial organization, sir, you prepare balance sheet. Suppose when you prepare a balance sheet, you will have liabilities and assets. Similarly, for a non-profit organization also same manner, balance sheet will have assets as well as liabilities. The assets of the non-profit organization, the liabilities of the non-profit organization. But the most important thing is, see, in case of a non-profit organization, there is no capital. We call it as capital fund. Assets minus liabilities generally will get capital. But in case of a non-profit organization, we have capital fund. Remember, capital fund will be there. There is no capital account. You should not call in case of a non-profit organization, they have capital. No, there is no capital in case of non-profit organization. There is a capital fund, because see, for a non-profit organizations, the majority of the source is donations, subscriptions, legacies, endowments, so lifetime membership fees. Like this, a non-profit organization will receive. For example, there is a hospital, okay, which is run by a charitable trust. Now this charitable trust is NPO, non-profit organization. Now tell me how this charitable trust will function, sir? Because they will collect donations from different people. They will collect donations from different people. They will tell to the people that, sir, we are providing medical services to the poor people, so please help us. Like that, they will collect donations. So these rich people, organizations, government, everyone will contribute some amount. Now that amount what they have received is their source, donation. Sometimes, see, for example, you joined as a member in a club, you paid membership fees. Now that is also one of the source for this non-profit organization. So therefore, the point to understand is, so in case of a non-profit organization, okay, there is no capital. There is a capital fund. There is a capital fund. So see here, it is prepared as on the last date of the accounting period. It has assets and liabilities and prepared based on accounting equation. But there is no capital account. Instead, there is a capital fund. The surplus or deficit from income and expenditure account is adjusted against this capital fund at the end of the year. Correct only, na? See, if you are a commercial organization, what you do, you will get net profit. That net profit you will adjust it to the capital account. Similarly, here there is no profit or loss. There is a surplus or deficiency. If there is a surplus, it will be added to capital fund. If there is a deficiency, it will be deducted from the capital fund. So I think we discussed the components of non-profit organization, financial statements of non-profit organizations. Now, there are certain special items, very, very important. So, accounting treatment of certain items of non-profit organizations. So, what are the special items in case of non-profit organization? See, I have prepared a note for this. See, for example, first one, entrance fees. See, for a non-profit organization, how they will run their activities, sir? How they will fulfill their objectives? They have to get money from somewhere, some sources. One of the sources is entrance fees. Whoever wants to become member of this non-profit organization. For example, there is a club, cultural club. I want to become a member in that cultural club. Now, definitely that club will charge some entrance fees from me. Now, that will become their source. Now, what they will do with that entrance fees, whether they will treat this entrance fees as a revenue receipt or capital receipt. Revenue receipt or capital receipt, because if it is a revenue receipt, it will come in income and expenditure account. If it is not revenue receipt, it will not come in income and expenditure account, rather it will go to balance sheet. Because see, what we are doing is we are learning the preparation of financial statements of non-profit organization. So what are the possibility of different amounts which is received by non-profit organization? First is entrance fees. Now, when entrance fees is received by non-profit organization, received at the time of admission of a new member. For example, Indian Geological Society of India. Now, you want to become a member of that. Now, there will be entrance fees. You need to pay. Suppose, for example, 1,000 rupees entrance fees you have to pay. Now, that 1,000 rupees, what that society will do if it is a non-profit organization? Whether that 1,000 rupees they will treat it as a revenue receipt or capital receipt. If it is a capital receipt, is it created to capital fund? Because I said for a non-profit organization, there is no capital account, there is a capital fund. So, see, what they are saying is, first of all, entrance fees is nothing but the fees which is paid by a new member. Now, there are two arguments here. One argument says, see, this is a one-time fees we are collecting, because this is again and again will not be paid by the member. Now, this is entrance fee. That means at the time he is entering into the society or entering into the non-profit organization, he pay. So this is one-time fees, and that too non-recurring. Therefore, they say you treat it as capitalized. Whenever you receive this amount, you credit to capital fund. You credit to capital fund. Capitalize. You capitalize it. Another argument says is, see, this entrance fees every year so many members will come and we collect the fees. So this is ordinary. So addition of a member is an ongoing activity, and every year the institute will get entrance fees. So for example, Mr. X joined as a member. Now Mr. Y joined as a member after 2 months of Mr. X. Like that. So it's an ongoing activity, right? So addition of a member is an ongoing activity. So therefore they say every year the institution will get entrance fees. Every year they will receive na. So entrance fees is generally, because new members are adding. When new members is added, they will pay. So they say it is normal revenue receipt only. Normal revenue receipt only. Sir, what is entrance fees? If a person joined as a member in non-profit organization, he pays initially certain amount. We call it as entrance fees. Now, what we do with this entrance fees? Entrance fees is revenue receipt. See, if it is a revenue receipt, credited to income and expenditure account. If it is not a revenue receipt, it will be capitalized. Now, generally, it will be received at the time of admission of a new member. So, it's a one-time fees, non-recurring fees. Generally, they will be capitalized. But there is an argument that, see, this members, coming new members is a every year's practice, and we are going to receive it every year whenever a new member joins. So, therefore, it should not be capitalized, it should be revenue receipt. Some people will argue that. Sir, okay. In question, suppose your entrance fee is given, what we need to do? See, they will definitely tell you the purpose. Is it a one-time fees, non-recurring? If you see one-time fees, non-recurring fees, just capitalize. Suppose if you see it's an ongoing activity, they want to treat it as revenue receipt, then treat it as normal revenue receipt. Okay. Suppose sometimes the entrance fees, what they have charged from you is a very small amount. And recovering only the expenses of admission. It is not some bulk amount or big amount. So small amount is collected and it is only to cover the admission expenses. Then in such a situation, better you treat this as your income. That's why it is created to income and expenditure. So I think you understood what is entrance fees. So the first source for a non-profit organization is entrance fees. Whenever a new member joined in the society, club, or whatever the charitable trust, non-profit organization. So whatever the amount we take it from him, it's a entrance fees. Is it capitalized or is it revenue receipt? Since it is one time, non-recurring, capitalized. But there is an argument that it is an ongoing activity, so therefore it will be a revenue receipt. So therefore, you have to see the bylaws of the company. See, bylaws of the company, bylaws of the non-profit organization. You have to see what they have written. See, for a normal company, we have memorandum of association, right? But similarly, for a non-profit organization, they have bylaws. Now, in that bylaws, they can prescribe certain conditions or rules for accounting of entrance fees and all those. Accordingly, they will follow. Next, second source for a non-profit organization is donations. Sir, donations are quite common, sir. These days, hospitals, educational institutions, these cultural societies, so clubs, they're collecting a lot of donations from different people, right? For example, ISKCON is collecting donations. So, for example, you went to ISKCON and they have collected, for example, you given 1,000 rupees. Now they want to construct one temple in a particular place. So they are started collecting donations. That means the donation you given for the construction of the temple. Now the donation is given for a particular purpose, right? Special purpose. That is construction of the temple. Therefore, in such a situation, whenever any donation is received for a specific purpose, that donation will be transferred to a separate fund. Separate fund account we need to transfer. So ISKCON temple collected this amount for construction of the temple. So whatever the amount they collected, they will create it to separate fund account. For example, they have received amount for construction of a temple. So therefore, temple fund. So like that. For example, if they received any donation for construction of a building, so building fund. Like that, whenever we receive any amount, that amount will be created to the fund, particular fund account. And sometimes the balance in the fund account we will invest. Meanwhile, we will invest. Now, whenever any income received from investment of the fund balance, that income is also created to fund only. Don't treat it as normal income and created to income and expenditure account. So, invested in specific securities, income from such investment is created to the fund account. Now see, sometimes we receive very small donations not earmarked for any specific purpose. That means there will not be any purpose, but small donations, 100 rupees, 500 rupees, 300 rupees, like that we received. And these donations, generally, they have not earmarked for any purpose. Generally, they will be treated as what? Revenue receipt. For example, see, you went to a temple. In hundi, there is a hundi. Hundi is what? Anonymous donations, because the person who is giving the donations, whose name is not there, details is not there. Suppose you went to Tirupati. Now, Tirupati hundi, suppose for example 100 rupees Mr. X deposited. Now that 100 rupees is what? It's a small donation. Is it given for a particular purpose? Is he written on that 100 rupees note, please use this 100 rupees for construction of building, like that? No. So it's an anonymous donation, not earmarked for any specific purpose. Then TTD will treat the donation as a revenue receipt. As a revenue receipt, because they are not for any particular purpose. Okay, I think you understood. Anonymous donations. Suppose every temple you go, so there is a box, hundi. That in that hundi, people will, when small amounts they will keep, right? So that will be small amounts and not for any particular purpose. So therefore, they will be treated as revenue receipt. Next, see, any other donations? See the bylaws of the non-profit organization. By what they have written. For example, generally they say if you receive any donation and if it is non-recurring in nature, non-recurring means again and again you can't receive, only one time donation you received it. So then you credit it to capital fund only, treat it as part of capital fund account. Suppose recurring nature, sir, you receive on regular basis this donation. For example, there is a trust that will collect donations regularly to maintain the trust. For example, to provide free meals to the underprivileged people. Now, that donation is recurring in nature, so therefore it is credited to income and expenditure account. So tell me, donations. If donation is received for a particular purpose, then you will credit to specific fund account. And if the fund balance, any of the amount is deposited anywhere and income is received, that income is also credited to that fund only. Important. Now, if you receive any small donations, like hundi, in hundi, different people, the devotees will keep small amounts, not for any particular purpose, then generally treated as revenue receipt. Next, any other donations you receive, now you see the bylaws. If the donations are non-recurring in nature, capital fund, treated as capital receipt, capital fund. If it is donations are recurring in nature, treated to income and expenditure account. Next source for a non-profit organization is endowments. Endowments means gifts. Suppose there is a person, Mr. X. He has gifted, for example, AC to a charitable organization, or he may gift a vehicle. For example, a car is there, car he has donated, or a building is there, that building is donated. Whatever the donations he made, so they are gifts. Endowments is gifts to be used as per the instructions of the donor. So donor clearly specified that, see, I am giving this gift, you utilize for this one. For example, I made one gold item, gold ornament for the temple. So I have given that gold chain, specifying that this gold chain has to be utilized for this purpose only, for this particular purpose. Like that, I specified. The donor has prescribed the instruction that this you utilize it for this purpose. Or for example, see, there is a land. Now, this land has given by a person to a trust, saying that you use this land for the trust activities, temple activities or trust activities only. You should not do any other thing. Only trust activities you have to do. Now, this gift, whatever he has given, generally they will be treated as capital receipt. It's not revenue receipt, capital receipt only, gifts. But instructions of the donor, see, lot of PTMs, so they will receive so many assets. So the donors will prescribe the instructions. So accordingly, they will be utilized. All those assets which received from different donors with instructions, they will be treated as capital receipt. So that is one thing. So it will be transferred to capital fund. Next, another kind of receipt for non-profit organization is life membership fees. See, if you become a member of any society or if any organization, non-profit organization, they will collect you entrance fees. That is okay. Admission fees, entrance fees, okay. This is life membership fees. So they will collect amount in the name of life membership fees. For example, 15,000 life membership fees, like that they will collect. Now treat it as revenue receipt, capital receipt. And remember, initially when you receive this lifetime membership fees, the non-profit organization, they will be treated as deferred receipt in the balance sheet. That means you put it as a liability in the balance sheet. And every year you credit certain portion of this life membership fees to the income and expenditure account. Once again, I am telling, sir, when you receive lifetime membership fees, bank account debtor to deferred life membership fees account. That means it is part of liabilities of the balance sheet. And every year, out of this deferred receipt, out of this life membership fees, certain amount we will credit to income and expenditure account. So that means it is treated as a capital receipt. And when you receive it, life membership fees, so it will be treated as a deferred receipt. Deferred receipt means it cannot be credited to P&L account at a time. It will be credited to P&L account over a period of time. Here there is no P&L account, therefore income and expenditure account. So taken as a capital receipt. On receipt, treated as a deferred receipt in the balance sheet, and every year a specific amount is credited to income and expenditure account. And subscriptions. Suppose any subscription, you might hear it. So these non-profit organizations will collect subscription amount every year. Every year you have to subscribe. So every year they will collect it now. Every year, every quarterly, half yearly. So therefore it is a revenue receipt. It is credited to income and expenditure account. This year annual subscription will become this year revenue. See, simple nana. If it is a revenue of the current year, income and expenditure account. But see, life membership fees, will I credit this life membership fees entirely to income and expenditure account? No. This lifetime membership fees, whatever we collect, we will credit to income and expenditure account on some reasonable basis, logical basis over the period. Only to the extent the amount credited to income and expenditure will become the income of this year. Next, legacy. See, what is legacy? For example, any non-profit organization started in the memory of any person. For example, Alfred Nobel. Now this person, in the name of Alfred Nobel, so there is a Nobel Foundation, which may be a non-profit organization. Whatever the profits, whatever the properties, assets this Alfred Nobel had, this will be transferred to the trust once he died. So once he he is expired, he died, so all his properties, cash, everything will belongs to the trust. That is called legacy. So legacy is nothing but the amount what received from the in whose memory the trust was initiated, the trust was started. Now that is called legacy, and this legacy is a one time receipt, so definitely you treat it as capital fund. Okay, so once again, very important, sir. See, entrance fees. First of all, this is collected at the time of admission of a member, and this entrance fees is generally one time fees, non-recurring, so generally it will be capitalized. But there is another argument that this is ongoing activity, therefore every year we are receiving. So a new member is joining, we are receiving, so treat it as a revenue receipt. So you need to see the bylaws of the trust, bylaws of the non-profit organization, and accordingly you need to take a decision. But remember, if the entrance fees is a small amount and it is covering only admission expenses, so then in such a situation treat it as revenue expenses. Next, donations. If any donation is received by the non-profit organization for a specific purpose, then the donation amount is credited to specific fund account only. If it is received for construction of building, credited to building account. If it is received for construction of temple, credited to temple account, temple fund account. And from this fund, whatever the amount you invested, the income received, that is also be adjusted in the fund account only. And if you receive any small donations like anonymous donations, so where they are not earmarked for any specific purpose, generally treat them as revenue receipt. Any other donations, you see the bylaws. If the donations are non-recurring in nature, generally treat them as capital receipt, credited to capital fund. Okay. Suppose if the donations are recurring in nature, better you credit to income and expenditure account. Now, endowment means gift. The gifts are treated as, and the gift what we receive as per the instructions of the donor, we have to utilize it. So therefore, they will be treated as capital receipt, credited to capital fund. Life membership fees, it's a one-time receipt. So therefore, on receipt, we will treat it as a deferred receipt, and it is treated as liability in the balance sheet, and every year certain amount will be credited to income and expenditure account. And subscription every year we receive now, so it will be treated as revenue receipt. Legacy is a one-time receipt, it will be taken to capital fund. So these are the things about non-profit organizations. Now students, let us have a discussion on accounting from incomplete records. Actually, financial statements from incomplete records. Incomplete records. If you see the CMS study material, we have financial statements of commercial entities, financial statements of non-profit organizations, and the third one is financial statements from incomplete records. See, these three together are given as one set. Now, very important these three chapters are. So now in that, accounting from incomplete records or financial statements from incomplete records. See, what is this financial statements from incomplete records? Suppose if you are not maintaining books of accounts as per the double entry system of accounting, then those records are called incomplete records. So when you have not prepared accounts completely, so in such situations, how we need to ascertain the profit or loss? By using the available records. That is called accounting from incomplete records. See, it is nothing but finding out the missing figures. By using the available information, how we can ascertain the profit or loss? How can we prepare the balance sheet of the business enterprise? That is what this chapter is all about. So first of all, in order to master this chapter, you should have a little bit idea. So through this revision, I am trying to give you some idea about it. See here in this, first you need to learn certain theory. First of all, what is incomplete records? What are the features of incomplete records? And I will give you the methods. This is most important to solve certain problems of this chapter. So you need to understand what are the methods available to make incomplete records as complete records. By using these incomplete records, how can I prepare financial statements? Actually, there are two methods here. One is ascertainment of profit or loss from incomplete records. And there are two methods for this. So, and then there is a preparation of balance sheet from incomplete records. How to prepare balance sheet? See, every business organization at the end of the year, they want to know their profits. And at the same time, what is the financial position, balance sheet, assets and liabilities. Now, these two are the agenda, but the records are not complete. By using these incomplete records, how can I prepare the P&L account? I mean, to ascertain the profit or loss, how can I ascertain the profit or loss? Second thing is, how can I prepare balance sheet? Okay. So this is the objective. So in this chapter, they are going to ask you one question, that they will give some incomplete records. By using that incomplete records, you have to ascertain the profit and you have to prepare the balance sheet. Okay. Now, first of all, what is incomplete records? See, accounting records which are not strictly kept according to double entry system are known as incomplete records. You know, double entry system, for every transaction there are two aspects, debit aspect, credit aspect. If any one of the aspect is missing, we call it as what? Incomplete records. It is a mechanism of maintaining records whereby some transactions are recorded with proper debits and credits, while in case of others, either one-sided or no entry is made. See, for some transactions, we will maintain complete details, like debit we will record, credit we will record. For other transactions, so we will not record, or we will record only one part of the transaction. See, especially these business, small trader is there now, small business people. See, if I am a small trader, okay, now small traders, what they will do is, the transactions relating to cash and debtors, the transactions relating to cash and debtors, they will maintain complete records, because they feel that cash is very important item. So they will record everything, whatever the cash sales they made, whatever the credit sales they made, from whom we need to receive the amount, who are the customers who we make the sales, how much amount we made the sale. So everything they will record relating to cash and debtor. See, this is the ideal situation I am saying. It is not that every small trader will maintain all these records. Even some small traders, they will not maintain recording for cash and debtors transactions also. But this is most of the situations I am telling. See, in most of the situations, what small traders do is, they will give importance to the cash and debtors transactions. Nothing but cash sales, credit sales. They will have a complete record regarding cash sales and credit sales. But what about transactions relating to assets, liabilities, expenses, revenues? Like for example, they purchased an asset, they will not maintain any record. They incurred some liability. For example, they have taken a bank loan, they will not maintain any records. Suppose they incurred rental expenses, administration expenses, selling expenses. So different kinds of expenses they will incur, depreciation, but they don't maintain any record for that. They don't record entry. Depreciation account data to asset, they don't record it. Rental expenditure, they don't record it. This is the scenario, what is happening in the ground level. So either they will record only debit or credit sometimes, or they don't record at all. For example, they purchased an asset, they will just record the asset in the books. So from which sources this asset is purchased, how much cash is gone out of the organization, and this asset is purchased from which source, the corresponding source must also be recorded. Now they will not record it, they will not update it. Similarly, they incurred a liability, they written loan taken from bank, that's it. So when the loan is taken, obviously the amount will come and the cash balance will increase now. So one aspect they will record, another aspect they will miss. Expenses they will incur. For example, rent paid, that's it, they will record. So when you pay the rent, obviously there is an outflow and you need to book it as an expense in the P&L account, but they don't record. Only one aspect they will record. So this is called single entry system. So understand what is double entry, what is single entry. Double entry means complete recording. Some transactions you will record completely, especially cash related, debtors related, credit sales. Small business people, they will maintain record for this. So they follow double entry system. But for certain transactions, they will either record only debit aspect or credit aspect. Now those transactions comes under single entry system. See, in your syllabus, you have incomplete records, not single entry. The incomplete records includes the single entry. Incomplete record means what? Either you are not maintaining the records or you are recording only one aspect. So this is incomplete records. In that, one of the aspect is single entry. Incomplete records could be anything. You are not maintaining accounts at all. That is also incomplete records. You are maintaining half, only debit aspect, credit aspects. Either one you are recording. That is also incomplete records. So therefore, don't say single entry, incomplete records, both are same. No. Incomplete records includes single entry. Okay. Now, what are the features of incomplete records? See, if I'm a small shopkeeper, like I'm selling groceries and I'm a vendor, small businessman, what I will do is I will do partial recording of transactions. Therefore, my records are incomplete. Do you expect the small business people to maintain everything? Their accounting system is not that much perfect, that much not, they don't maintain any detailed records. So they don't keep vouchers also, evidences also. Whatever the transactions they incurred, they don't maintain evidences, they don't maintain vouchers also. Only for certain important transactions, they will keep a record. If they feel what they feel is very important. So, but you take a large business organization like a corporate company, they are mandatory to maintain books under double entry system. If you read Companies Act, there is a proviso in the Companies Act that companies have to maintain their books as per double entry system by accrual concept, like that. So all records, see, if you are a large business organization, all records are maintained according to double entry system. Suppose if you don't maintain double entry system of recording, then you are punishable. So if you are a large businessman, you have to make a lot of compliances. So first GST department will come, second income tax department will come, next some other department will come. So therefore, obviously you have to spend entire life in the jails, in the courts, if you do a crime in respect of not maintaining books of accounts, not paying taxes proper. Because see, everything starts from maintaining books of accounts. If you don't maintain proper books of accounts, how you will ascertain tax? What will be your tax liability? So it is very difficult. Now how will you prepare financial statements? So that's why if you're a large enterprise, there are lot of legal compliances you need to make, and it is compulsory. As per the law, you have to maintain records, and records are lost by fire or theft or due to any other natural calamity. Sir, I'm maintaining perfect records, sir. So one day fire gods visited my premises and they have taken away all my records. That means now you also incomplete records. You're also having incomplete records. Incomplete record means maybe some of the records available in the system, maybe previous year records available with somebody else, maybe my annual report. All that information is there with me. Some important transactions records are available with me, but majority of the records are destroyed by fire. That could be the situation. So what are the scenarios incomplete records will arise? First of all, if I'm a small businessman, naturally I don't maintain records. I will maintain records selectively. Therefore, incomplete records. Suppose if I'm a large business organization, anyway I have to maintain the books of accounts on double entry system. But I'm maintaining. But because of any reason, like fire, theft, or due to any natural calamity, my books may become incomplete. Incomplete records. Now, these are the scenarios where incomplete records could arise. Now, incomplete records, it is an unsystematic method of recording transactions. We don't accept, especially those who are in the finance field, we want everything to be recorded. Accounting should be given priority. Whatever the transactions you do, you maintain complete records by following double entry system. It is not that one aspect I will record, another aspect I don't record, or I will keep a diary. In the diary, whatever the transactions I like, I will record. See, these are not, we don't encourage. Generally, records for cash transactions and personal transactions are properly maintained, and there is no information regarding revenues and gains, expenses and losses, assets and liabilities. Only transactions, cash transactions. You go to any small businessman, so he will do a lot of cash transactions, right? Of course, nowadays it is not possible to do all cash transactions also. So government is very stringent. So through so many acts, they are putting a lot of restrictions. So therefore, on one hand, they will, do a lot of cash transactions. So cash transactions, they will definitely maintain a record. And personal transactions, because they should know from X how much amount I need to receive, from Y how much amount I need to receive, or to Mr. A how much amount I need to pay. So it is very easy for them to maintain personal accounts. So therefore, this is the most of the scenarios. Majority of the situations is cash transactions, personal accounts are properly maintained. But when you see, when you ask them the information regarding revenues and gains, expenses and losses, assets and liabilities, they don't have any records, or even if they have records, I think they will maintain only one aspect of it. For example, an organization has made some investments. Okay, from that investments, he received some interest. Now that interest nowhere he will record. For example, there is a sole proprietorship share. So there is a partnership firm, for example. The partnership firm has made some investments. From that investment, they received interest. Now, the interest they will not recording in the books. Okay. So, for example, they purchased an asset. That asset they are not recording in the books. So, these are the features of incomplete records. Now, you understood there is a possibility of incomplete records, especially small business people. They don't maintain, or we are not expecting complete records. We know that the accounting systems, accounting are not complete. Personal transactions of owners may also be recorded in cash book. For example, see, business entity concept says the owner and the business both are separate. Whatever the transactions done between the owner and the business, they must be recorded in the books. But here, personal transactions of the owners may also be recorded in cash book. Sometimes it may happen. This is also, this is a kind of a mistake they will do. Personal transactions of the owner no way connected with business. Why you are recording in the books of business? For example, there is a sole proprietor. His daughter marriage is happening. The marriage expenses is spent from business. So will marriage expenses will become business expenses? No, but they have recorded it. Sir, in what way it is incomplete records? See, this is not incomplete records, but these are the mistakes may happen. So when you are solving the questions of incomplete records, so these personal transactions also they will give. So you have to be very careful. In case the personal transactions are recorded in the books of accounts, they have to be eliminated. Next, there is no uncertainty in the nature of records. Summary information maintained to the extent of records available depends on the requirements and convenience of the each firm. Okay, there is no uniformity in the nature of records, sir. See, you can't expect every organization to maintain same records. So some people will fill some records. For example, they will keep everything in a diary. Some people will record only cash transactions. Some people will record cash credit transactions also, like that. There is no universality that you have to maintain these records only. No, not possible. Okay. The profit or loss for the year cannot be ascertained under this system with the high degree of accuracy, as only an estimate of the profit earned or loss incurred can be made. The balance sheet also may not reflect the same. See, what they're telling is, in this chapter, what is our main idea? Tell me. From incomplete records, I need to ascertain profit or loss, and I need to prepare balance sheet. So on the one hand, I don't have proper records, but they're asking me to ascertain the profit. So I ascertain the profit. In the process of ascertaining the profit or loss, I will make a lot of assumptions now. Because when records are not complete or not available, what I have to do? With the available information, I have to compromise and I have to ascertain the profit or loss. Now, can you expect, sir, this profit, what you arrived through incomplete records, is this correct? See, this is maybe correct or maybe wrong also, because whatever the information available with me, based on that information I prepared. How can you expect me 100% same? Because I made some assumptions. For example, this business has made only cash sales, credit sales. So whatever the information available, that information, based on that I will make some assumptions, and based on that assumptions I will prepare. Similarly, balance sheet also. Based on the information available, I will prepare the balance sheet. So Nana, this chapter, in fact, very easy chapter. The problem with this chapter is, from incomplete records, you have to prepare complete records. Now, for that, first of all, you should have the patience to read the question. So what information is available? What is missing? Now, how can I ascertain the profit or loss with this available information? What are the connecting points? So if you have the fundamental accounting knowledge, then you can easily connect the dots. Okay. Anyways, this is the theory. I don't think so they are going to ask the theory, but first of all, you should understand what is this chapter is all about. The base you have to learn. Without base, if you try to solve some questions, I don't think so you are going to get it. First of all, understand what you are learning. You are learning financial statements from incomplete records. What is incomplete records? They are not maintained as per double entry system. Either some transactions are not recorded, or only one-sided, one aspect is recorded. Especially business people, small business people, and even large organizations also, sometimes because of the fire, natural calamities, theft, they may lose their data, accounting information. Then also they are having incomplete records. So from this incomplete record, how can I prepare financial statements? How can I ascertain the profit or loss? How can I prepare balance sheet? I think in this chapter we are trying to ascertain that. Now, next thing, very, very important, sir. These things, see, you remember these things, I think you can solve the questions. Ascertainment of profit or loss or balance sheet from incomplete records. See, sir, from incomplete records, you said we have to ascertain the profit or loss and we have to prepare the balance sheet. How, sir? See, there are two methods, they say. From incomplete records, profit or loss and balance sheet is arrived by using the following method. There are two methods. One is capital comparison method. One is capital comparison method. Okay. What is the first method, sir? Capital comparison method. Second is conversion method. Think about it. What is the first one? Capital comparison method. Sir, what is this capital comparison method? Very simple. We know in case of non-corporate entities like sole proprietorship, partnership firms, during the year, whatever the net profit we got or net loss we got, we will adjust with capital account. Na? We will adjust with capital account. Therefore, the current year net profit, net loss is already adjusted with the capital. Already adjusted with capital. So therefore, if you know the opening capital, if you know the closing capital, how opening capital, what adjustments I have done to the opening capital, I arrive at the closing capital. So in that adjustments, one of the adjustment is current year net profit or loss. For example, see, my opening capital 10 lakhs, my closing capital 20 lakhs. Now 10 has become 20. Tell me what adjustments might happen to the capital, opening capital. Maybe additional capital introduced, maybe drawings, and current year net profit or loss. So current year net profit or loss I want, because I want to know what is the profit of the business from incomplete records. How can I get it? Simple, compare capitals. If you compare capitals, the difference between the opening and closing capital is what? What adjustments will be done to arrive closing capital from opening capital? Maybe additional capital introduced will be added to the opening capital. Maybe drawings will be less, and then you current year net profit or loss, and then you will arrive at the closing balance, right? So you know one of the aspect is net profit or loss. So therefore you can easily ascertain. See, I have written here. See here, ascertainment of profit or loss. First you take capital at the end of the year. Closing capital you take. Or see, simply you can do like this also. First, opening capital, right? Add additional capital minus drawings, and add net profit or loss. Then you will get closing capital. This is everybody knows this. Opening capital, add additional capital minus drawings, and add net profit or loss. Then you will get closing capital. See, I want this one. For example, my opening capital 10 lakhs, additional capital 5 lakhs, drawings 2 lakhs. Okay. See, my current year profit 3 lakhs. So tell me what is my closing. 10 plus 5, 15 minus 2 plus 3. So it will be 16 lakhs. It will be 16 lakhs. Correct? 10 plus 5 minus 2 plus 3. So it will be 16 lakhs. If everything is known, see, this is the thing. So therefore, I know my opening capital is 10, my closing capital is 16. So I know how much capital introduced, I know how much drawings. So balancing figure can be ascertained as net profit or loss for the period. How can I see? For example, first take closing stock 16. Drawings is minus from opening stock. Now add back. Additional capital is added to opening capital, minus from closing capital. Opening capital is already included, minus. Then you will get what? Net profit or loss for the period. So here, take first capital at the end of the year. Add drawings. Why you are adding drawings? See, for opening capital, we will add drawings. From closing capital, already while arriving closing capital, it is deducted, na? So add back. See, for opening capital, drawings was deducted, then you will get closing capital. Now your starting point is closing capital. So closing capital reverse you do. Add back drawings. Additional capital introduced. So from arriving to arriving the closing capital, additional capital was added to the opening capital. So minus it. And then capital at the beginning minus. Then you will get profit or loss made for the year. So this is the thing. This is very, very easy. If in exam, suppose if the question is given relating to this capital comparison method, easily you can solve. Don't leave it. Okay. Very, very simple problems are there. You try to solve it. So understand how to arrive profit or loss for the period under capital comparison method. Take closing capital. For that, add drawings minus additional capital. Then you will get profit or loss for the period. Very simple. Sir, you said take closing capital. How will you arrive closing capital, sir? See, they say you need to prepare statement of affairs. Like statement of affairs is nothing but like balance sheet. Suppose, for example, at the end of the year, you try to prepare the balance sheet and ascertain capital as the balancing figure. Capital as the balancing figure. Similarly, opening capital, how will you arrive? You prepare statement of affairs. Compute from statement of affairs. What is statement of affairs? It's like balance sheet. For example, I prepared a balance sheet. I have written all assets, all liabilities. The balance figure is capital. Take this capital. They will give information relating to assets and liabilities, sir. You have to. They have to give. Otherwise, how can I arrive capital? Without arriving capital, it is not possible for me to ascertain the current year profit or loss for the period. So this is one method, sir. This is one method. This method is called capital comparison method. This method is called capital comparison method. See, how can you arrive capital? See here. I said prepare statement of affairs. Na? How can you see? Okay. See here. Opening, closing capital balances are arrived by preparing statement of affairs. In statement of affairs, assets will be shown on asset side, one side. Liabilities will be shown on the other side. And capital is arrived as the balancing figure. You prepare a balance sheet, take assets, take liabilities, capital will be the balancing figure. Now you know opening capital, closing capital, how much capital introduced, how much drawings. So closing capital, add back drawings minus additional capital, then you will get profit or loss for the period. MCQ is also possible. For example, they may ask one MCQ. So they will give you closing capital, they will give you opening capital, they will give you drawings, they will give you additional capital, ascertain the profit. Then simple, remember this, closing capital, add drawings minus additional capital. Add drawings minus additional capital, you will get profit or loss. Two minuses you have to do. Drawings you have to add and additional capital you have to minus. Opening capital also you have to minus. The balance figure is the profit or loss made during the period. Sir, this is very easy method, sir. Okay. Now, or you can prepare this by preparing this ledger account also. Instead of statement, if you want to ascertain profit, then you can follow this also. If it is very easy for you, you can follow this capital account. For example, opening balance by balance brought down. Additional capital introduced by cash or bank. Next, two drawings. Whenever there is a drawings, capital account is debited, na? Capital account debtor to cash or bank. Goods withdrawn by the proprietor, everything. And closing balance. So you know the opening balance, you know the additional capital introduced, you know the drawings, you know the closing balance. Now ascertain the net profit as the balancing figure. Because net profit of the current year will be added to capital. So therefore it will be there on the credit side of the capital account. So, but I want this balancing figure, I will ascertain. So if I know the opening capital, if I know the closing capital, if I know the additional capital, if I know the drawings, then game over. Okay, you can easily ascertain the profit or loss for the period. So this is how you will ascertain the profit by using incomplete records under capital comparison method. Sir, how I prepare balance sheet? Statement of affairs itself is balance sheet. So assets, liabilities, and capital you know. So the balance sheet already came. Next, but see, they won't ask capital comparison method. If at all they want to ask a question, they will ask conversion method. See, even last time also, December 2023, they've asked a question from conversion method. So you can expect a question from conversion method. This is very, very important. Listen to me carefully. See, I am having incomplete records. Okay. But you are expecting me to ascertain the profit or loss. Okay. And you are expecting me to prepare balance sheet with these incomplete records. Okay. That means, first of all, whatever the accounts available with me, they are single entry. That means incomplete. I need to convert them into double entry system, first of all. That means, whatever the records available with me, incomplete, try to make them complete. So, for example, see here, once you try to, complete information, try to convert single entry into double entry system by using the available information only, by making assumptions. How? I will tell you, wait. Now, then prepare trading P&L account and balance sheet. Sir, what is the limitation of capital comparison method? Just now we have seen. What is the limitation? Tell me. In capital comparison method, we know the profit, but we don't know the breakup of what are the incomes, what are the expenses, what are the everything we don't know. Just we know the profit. If you see, if I prepare trading and P&L account, I know everything na, what are my incomes, what are my expenses, direct expenses, indirect expenses, then I will get net profit. But in capital comparison method, I don't know anything because I am comparing capital and ascertaining the profit. So that will be the main limitation of this capital comparison method. That's why the conversion method is very, very important, because conversion method will give you some more detailed information regarding incomes and expenses. So I want incomes, I want expenses, I want assets, I want liabilities. So therefore, single entry, incomplete records, I need to complete it. I need to convert into double entry, complete records first of all, and then prepare financial statements. That means ascertain the profit or loss and balance sheet. Okay. See, in order to prepare this trading account and balance sheet, I want what? One needs complete information regarding expenses, incomes, assets, and liabilities. In case of incomplete records, details of some items like creditors, cash purchases, debtors, cash sales, other cash payments, and such receipts are easily available. See, what is the information which we can easily ascertain from the business? Tell me. For example, cash sales, we can easily ascertain because we know who are the regular customers to whom we sold the goods. For example, credit sales also we can easily ascertain who are the persons we make the credit sales. Similarly, credit purchases, cash purchases, these things we know. For example, every month rent, how much we pay, cash expenses, every month how much interest we receive from the bank. For example, if we make any investments, so definitely some details are readily available. We can easily ascertain. So, but there are number of items, the details of which will have to be ascertained in an indirect manner by using the logic of double entry system. But there are certain other items we don't know. Some items you can easily ascertain. For example, I want to know the cash sales. I can ascertain. Okay, I can call my customers and ask them, what are the sales I made during this year to you. They will tell. They will, if you want them to, send the record, they will send it. So no problem. Like that, credit purchases, credit sales, all these things we know, but there are certain aspects we don't know. So those things we ascertain by logic of double entry system. That means we will try to find out the missing figures to make incomplete records as complete records, and then from that complete records we'll try to prepare balance sheet, P&L account, trading P&L account, and balance sheet. And see, I have prepared the most common items that are missing and have to be worked out. See, I have given here what are the missing figures they will give in the question. See, I have given here 7 items. Please at least learn these 7 items. See, usually in the questions, these are the missing figures. So if you do these 7 things, if you know these 7 things, see, when you are doing question relating to incomplete records, read the question. At the time of reading, identify which figures are missing. Mostly these 7. What are those? First, opening capital is missing. Okay. Credit purchases is missing. Credit sales is missing. See, credit sales. Bills payable accepted missing. Bills receivable received missing. Payments to creditors. How much payment we done to the creditors missing. Amount received from debtors missing. Any other cash and bank related items. I think you can easily remember. Tell me, what are the items generally missing in the questions? First, opening capital. Next, credit purchases, credit sales. Bills payable accepted, bills receivable received, payment to creditors, amount received from debtors. Or you can easily remember like this: relating to debtors, relating to creditors. Relating to debtors, tell me, amount received from debtors. Sometimes it is missing, so we need to ascertain amount received from debtors. Because if you don't know how much amount is received from debtors, how can you close cash account, closing balance? How can you ascertain? Similarly, how much amount you paid to creditors? See, there is an interconnection. If you don't know how much amount you paid to creditors, how can you ascertain closing cash balance? If you don't know the closing cash balance, how can you ascertain balance sheet? How can you prepare balance sheet? So there is an interlinking between the accounts. And for example, credit purchases, sometimes it is missing credit purchase. How much credit purchases we made to the creditors? How much credit sales we made to the, how much credit purchases we made from the supplier? How much credit sales we done to the customer? Bills payable accepted, bills receivable accepted, received. For example, bills received. One of the customer has given a accepted the bill, so we received bills receivable. For one of the supplier, he raised a bill and we accepted, so bills payable accepted. And any amount paid to creditors. So whatever the amount we paid to creditors, we don't know. So we need to ascertain any amount received from debtors. and any other cash and bank related items may also be missing. So usually these are the 8 or 9 items are there. 8 items are there. So these are the missing in the questions, majority of the situations. Now, how to ascertain it? See, I have given one by one. Opening capital you can easily ascertain by preparing statement of affairs. Opening balance sheet you prepare, ascertain the opening balance, opening capital as a balancing figure. That's it, over. Now, credit purchases, how to prepare? See, we know there is a connection between creditors and credit purchases, right? Prepare creditors account, and what are all the information given in the question relating to creditors, you write it. Ascertain credit purchases as a balancing figure. Like see here, when the credit purchases are not given in the question or any other information relating to creditors are missing in the question, we need to prepare total creditors account to ascertain the missing figure. So in examination, suppose for example, any item relating to creditors, for example, how much amount we paid to creditors is missing. How to ascertain? Prepare creditors account. And usually you should know what items will come in creditors account. For example, opening balance, we'll take opening balance. Opening balance, everybody knows this. And whenever we make any credit purchases, see here, this is the balance figure we want. Whenever we purchased credit purchases, what is the entry? Tell me. Purchases account debtor to creditors. So creditors account by purchases. But this is the balancing figure we want. So we will ascertain this as a balancing figure. Now before ascertaining this as a balance figure, we need to record everything. So therefore opening balance we return. Next, what are the other transactions relating to creditors? For example, any cash paid to creditors, we make the payment to creditors, creditor to cash. Any checks issued to the creditors, so creditors to bank. Suppose we accepted a bill, creditor raised a bill, we accepted, so creditor account debtor to bills payable. Next, any purchase returns. For example, we have written the goods which purchased from creditor. So when we return the goods, what is the entry? Creditors to purchase returns. So purchase returns. And see, sometimes creditors will give you discount. When they give discount, what is the entry? Creditors to discount received. So see, understand, credit purchases, opening balance, credit purchases, cash paid to creditors, checks given to creditors, bills accepted to creditors, purchase returns, discount received. See, this everyone knows. Record all these transactions. If you know, if it is given in the question, and then closing balance also you write down. Now, some other transactions could be check dishonored. For example, you given a check to the creditor and it is dishonored. The check is not honored. What happens? Again, you need to credit his original position. You need to, your amount due to him. So therefore, by bank. So whenever check is given, creditor to bank, the check dishonored, same entry is reversed, na? Bank to creditor. So check dishonored. And also bills payable. Suppose for example, when you accept a bill, what entry you will return? Creditor to bills payable. Suppose for example, the bills payable is not honored on the due date. You have not paid the amount on the maturity date. What happens? The same entry will be reversed now. So bills payable to creditor. So by bills payable dishonored. Now you write all these entries. If it is given in the question, ascertain balance figure as credit purchase. If credit purchases is missing figure, suppose credit purchase is given, sir, some other item is missing, sir. For example, we don't know how much cash we paid, sir, to the creditor. Now this will be the balancing figure. You write everything, what you know, this will be the balancing figure. So see, not only credit, but I tell credit purchase is the usual missing figure. It is not that other item should not be missed. Any other item can also be missed. See, if any other item is missed, now ascertain that as a balancing figure. But understand what are the normal items will come. Opening balance, credit purchases, cash paid to creditors, checks given to creditors, bills accepted for creditors, discount received, purchase returns, bills check given dishonored, bills accepted dishonored. That's it. These are the entries will come. So remember, only 4 accounts are there. You remember this much and try to solve some questions. This chapter will be done. Okay. Next, come to the next one. Credit sales. Sometimes credit sales are missing. You need to prepare debtors account. Like when you, if you want to know anything relating to creditors, you have prepared creditors account. Na? Similarly, you have to prepare the debtors account. So when credit sales are not given in the question, or any other information relating to debtors are missing in the question, we need to prepare total debtors account in order to ascertain the missing figures. Now tell me, what items will come in debtors? Opening balance first. And sales. For example, whenever we make any credit sales, what is the entry? Debtor to sales. So to credit sales. And similarly, suppose for example, debtors make the payment, you received cash account debtor to debtors. Suppose debtors given a check, bank account debtor to debtors. Suppose debtors accepted a bill, bills receivable to debtors, and we allowed discount to debtors. So when we allow a discount to debtors, what is the entry? Discount to debtors. So debtors account is created by discount. Sales returns, whenever we make the sales, customer return the goods. When customer return the goods, what is the entry? Sales returns to customer. So by sales returns. And sometimes bad debts will also come. Bad debts, what is the entry? Bad debts account debtor to debtor. So by bad debts. So, and closing balance. And closing balance. See, sometimes closing balance itself is the missing figure. Then you write everything, ascertain closing balance, that we will record, that we will use for make the incomplete records to complete records. And then apart from that, for example, customer given a check, that check is dishonored. What is the entry? When we receive the check, what is the entry? Bank account debtor to customer. So same entry will be reversed, customer to bank. So therefore again customer account is debited to bank, check dishonored. Similarly, bill dishonored, bills receivable dishonored. For example, a customer, we raise the bill, he accepted, on due date he has not honored the bill. So therefore what happens? Reverse entry, customer to bills receivable. So the missing figure is credit sales, we ascertained. So therefore the simple logic is what items will come relating to debtors. If I want anything relating to credit sales, I know that it is relating to debtors. Therefore I will prepare debtors account. What items usually come in debtors account? I will record everything based on the information given in the question. See, in question, I don't think so all these items are possible. Here I have written everything which comes in this particular account. But in question, you cannot expect everything. Maybe 3 or 4 items. Okay, maybe see, they will concentrate more on this check dishonored, bills receivable dishonored, because most of the students know all these things. Cash received from debtors, check received from debtors, bills receivable from debtors, bills discount allowed, sales returns, bad debts, but they are not concentrating on these items also. These items you have to concentrate more. So this is, so usually in incomplete records, I think you have to prepare 2 accounts, creditors, debtors. Creditors account is for cash purchases, credit purchases, or any other missing figure relating to creditors. Okay. And also you need to prepare debtors account to ascertain what? Credit sales and any other missing figure. Now see, sometimes you need to ascertain bills receivable and bills payable. See, in the question, they will give transactions relating to bills receivable and bills payable. See, when information relating to bills receivable received during the year and bills payable accepted during the year not given in the question, we need to prepare total bills receivable account and total bills payable account to ascertain the missing figures. So we need to prepare bills receivable account as well as bills payable account to ascertain the missing figure. So when you don't know the information, I mean when information relating to bills is missing, then you have to prepare bills receivable or bills payable account. Sir, why I need to prepare bills receivable and bills payable? Sometimes what happen now, we have seen the creditors account and debtors account. One of the transaction in creditors account and debtors account is bills. For example, if you are a creditor, you are preparing creditor account, creditor will raise a bill on you and you will accept bills payable. Suppose if you don't know how much bills accepted during the year, you cannot complete creditors account now. Then first you come to bills payable account, complete it, ascertain the balancing figure, how much bills we accepted, and then prepare creditors account. So there is a interlinking. Similarly, when we raise a bill, customer will accept, right? We will receive the bill, bills receivable. Now suppose if you don't know how much bills received during the year, first you come and prepare bills receivable account. And then after ascertaining this, you go and complete debtors account. So there is an interlinking between debtors and creditors, bills payable and bills receivable. See here, bills receivable account, generally what items will come? For example, opening balance. Suppose during the year, we may, for example, see debtors, bills receivable dishonored. So for example, debtors accepted the bill, but on due date they have not honored it. What is the entry we will write? Debtors to bills receivable. So by debtors. Similarly, any amount received from bills, cash or bank to bills receivable honored. Suppose if you receive a check in respect of bills receivable, or amount is directly credited to bank account by bank, closing balance. So what could be the balance figure? Bills receivable accepted. How much bills accepted by the customers during the year? When the customers accept the bill, what is the entry? Bills receivable to customer. So 2 customers or 2 debtors. This is the balance figure. See, if you know this, then only you can prepare debtors account. So therefore in the question, if there is transactions relating to bills and you want to ascertain the, you need to close the debtors account. First try to ascertain how much bills accepted by the customers during the year by preparing bills receivable account. And for that, you should understand what items will come in bills receivable account. Opening balance, closing balance, everybody know. And what other items, what other transactions will affect bills receivable? See, on the due date, bills receivable dishonored, that item will affect bills receivable account. For example, on the due date, payment is received, that item will affect. So you need to understand what items will affect this bills receivable account, and accordingly you need to record. And similarly, come to bills payable account. So what is the object here? How much bills accepted by the customer, how much bills we accepted for the creditors, and what items will come? Opening balance, closing balance. And similarly, on the due date, we may dishonor the bill, we may pay the bill. Suppose if you pay the bill, creditors to, cash or bills payable account data to cash or bank. Suppose if it is dishonored, we will reinstate na. So bills payable account data to creditor, so to creditor. The balance figure is how much bill we accepted during the year. See, I have written a note also. There is a link between bills receivable and debtors account. So we need to close the bills receivable account. The missing figure is ascertained and it will be placed in debtors account to ascertain another missing figure from debtors. For example, sir, in the question, see, they may give one missing figure. For example, debtors credit sales is missing. Okay, if I need to ascertain credit sales, I need to write everything relating to debtors, including how much bills I received from creditors during the year. Bills receivable account data to creditors, bills receivable account data to debtors, I should know. For that, how much bills I received during the year, information is not given. Therefore, first I need to go and prepare bills receivable account, ascertain these bills accepted by debtors, I need to find out, and then I place this amount here, ascertain the credit sales as the balancing figure. So therefore, understand there is an interlinking between debtors, creditors, bills receivable and debtors, bills payable and creditors. And see, similarly, there is a link between bills payable and creditors. I think you understood it perfectly right. So if you do this much, I think these four accounts, I think majority of the problem you can solve. Debtors, creditors, bills receivable, bills payable. And ascertainment of missing figure information through cash account. See, sometimes you need to ascertain the missing figures through cash account also. Like for example, when the amount paid to creditors or the amount received from debtors or the opening and closing cash balance is missing in the question, we need to prepare cash book to ascertain the missing figures. For example, sir, how much amount we paid to creditors missing. Suppose if you don't know how much amount you paid to creditors, how can you close creditor account? If you don't know the creditor's closing balance, how can you prepare balance sheet? Or for example, credit purchase. Without credit purchase, how can you prepare trading account? So there is an interlinking, understand. There is an interlinking. So therefore, when amount paid to creditors or amount received from debtors or opening or closing cash or bank balance is missing in the question, we need to prepare cash book to ascertain the missing figures. For example, see, there is a link between debtors, bills receivable, cash book. There is a link between creditors, bills payable, cash book. See, for example, how much cash received from customers is missing. So first you need to prepare cash book and ascertain cash received from debtors as the balance figure. First thing. Second thing is maybe bills accepted during the year. Bills accepted by the customers during the year is missing. So you need to prepare bills receivable account. Then these two things will be taken to debtors account and ascertain the credit sales as the balancing figure. So that's why I have written here debtors account, bills receivable account, cash book, these three are linked. So you have to see, in order to close debtors account, maybe sometimes I need to close bills receivable account, maybe sometimes I need to close the cash book. And whatever the missing figures there in the cash book and bills receivable may be useful for me to close the debtors account and to find out the missing figure in the debtors account. Similarly, creditors, bills payable, cash book are the interlinking things. So the missing figure of the cash book, see, whatever the figure I will get from cash book, I will ascertain through cash book and I will use it. I will ascertain one more figure as a missing figure from the bills payable and use these two in creditors account to ascertain the missing figure in the creditors account. So see, this chapter is all about this, Nana. So I explained it, but you have to solve some questions. Sir, if you open the study material, listen to this theory, open the study material, try to solve 4 or 5 questions. Study material sums you do. So more than sufficient. Okay. Thank you. Now the next chapter for discussion is departmental accounts, sir. See, the modern organizations, the big organizations nowadays, they are dividing their business into small components. So for effective operation, or for effective control, or to increase the competitiveness of the departments, so they have divided the business into small components. Each such component we can call it as department. For example, a hospital may divide its business into rooms, one department; medical store, one component; cafeteria, one component. Or hotels, you take hotels, they divide rooms, accommodation as one component; restaurant they are running as one component; confectionery, gym and spa as one department, one separate component. For example, you take a bank, you see credit card department, underwriting department, forex department. So like that you can divide. Or you go to a departmental store where you can observe, for example, you went to a DMart, stationery, so they maintain as a separate component; electronics separate component; grocery items separate component. You went to a two-wheeler showroom where you can see motorcycles, one separate component; scooters, one separate component. Or you get to a automobiles showroom, hatchback, sedan, SUVs, EVs. See, what are these? These are illustrative departments and industry. So this is the order of the day. So each big organization is dividing their business into small components. Sir, why they are doing this? Because see, effective operation. It is very easy to manage the business small component, and easily we can fix the responsibility. For example, for each department we will allocate some budget and we will appoint a person who look after the department. And if something happens, so we will directly ask him what is the reason, and we will fix responsibility on him. And suppose if a department is performing well, we will give incentives. How will you know? See, the concept is quite simple. We want to increase the competitiveness of our departments. We want each department will need to compete with other. So, and based on your performance, we want to give you the incentive. So if your department is performed well, we will give incentive. So each department feels that we want to perform better than others, so that we will get better incentive. So with that idea, the modern management has brought the concept of this departmental accounts. Not only that, for ease of business and efficient management, you can efficiently manage the business. Nowadays, see the modern organizations, how effectively they are running. For example, Godrej is dealing with number of products. How effectively they are doing? Why? Because of the departmental system of accounting and adequate control. So many big organizations that deal with various products or services or multiple types of specialized activities consider each product, service or specialized activities as a separate segment. And now we call them as departments. Technically, we call them as what? Departments. Now see, when you divide your business into segments, into departments, you want to know the performance of each segment. You want to know the performance of each department. Now, this chapter is all about how to ascertain the performance of each department. That's it. Sir, what you know when you know the performance of each department? See, we know whether the department is performing as we desired or not, or we know whether the department is achieving the targets or not. Now, in our organization, which is the weak link? Which department is not performing better? So we can fix the responsibility and we can improve the department, so that the overall effectiveness of the organization, overall profitability of the organization will also increase. So see, the management of the concerned entity wants to evaluate the operating results of each department. Each department we want. So hence, on the basis of a system of responsibility accounting, the idea of department accounting has emerged and has been widely implemented. Sir, what is responsible accounting? As I told you, responsibility accounting means who will take the responsibility. For example, if something wrong happened in the organization, can I blame purchase department? Can I blame production department? Can I blame sales department? Or can I blame marketing department or accounts department? Which department I need to blame? So on whom I can fix the responsibility? Very difficult now. Everybody says, see, we are doing our work perfectly, so we are not liable for punishment, or we are not the reason, they say. So that's why we want to know exactly where the lapses are, which department is not performing well. That's why, see, we will fix the targets and budgets are also allocated. A manager or supervisor is assigned. For example, we will purchase department, one department we will establish, and we will allocate budget for the department, and we appoint one person to look after this purchase department, and we allocate specific task for this purchase department. Now this purchase department will make all raw materials. The job of the purchase department is to identify the suppliers and purchase raw material from the suppliers, quality materials with low cost. So they need to evaluate all suppliers, and they need to select the supplier whom can offer qualitative products with low cost, reasonable cost. Okay, that is the department job. Suppose if purchase department is not purchasing the items effectively, or inferior quality of the products they purchase, it is indirectly affecting the production department. It is indirectly affecting the sales department also, because if you purchase inferior quality raw material, obviously your production will be of low quality. If your production is low quality, how sales department will make an effort to sell these goods in the market when other competitors are producing high quality products? So that's where the problem. So therefore, see, one department has done the mistake, other departments are suffering. We don't want that. So we want where the weak links is. So that's why we want, see, we will fix the target, we will allocate the budget, and we also appoint a manager or supervisor, and we will fix him responsible. For example, we will identify, okay, the sales department makes a complaint that, sir, the products are of not qualitative, because most of the customers are giving a feedback that the products are not qualitative. Now we will ask the production department, what's the problem? Production department says the raw material is of not good quality. Then we will ask the purchase manager, so why you are purchasing raw material from the supplier this much of inferior quality? So he says, we, because of overlook, because we have not studied well. So now you are responsible. So that we will study, set right that department. So that is called responsibility accounting. So with the departmental accounting concept, this responsibility accounting came into the picture. So I think you understood now why departmental accounts has came into the picture. Now, in this chapter, what we are going to learn is how to ascertain the profit or loss of each department. Okay. Now that is the main agenda of this chapter. See, concept of departmental accounting is we want to assess the financial performance of each department of a large organization, which we call it as departmental accounting. So fix in your mind that there is a big organization. In that organization, there are number of departments. Now we want to know the financial performance of each department. Now, how we need to ascertain that? That is the departmental accounting chapter. So to find out the profit or loss of each department. Now, once I know the profit or loss of each department, and I will consider all the profits, all the losses of the department, and I will transfer it to general P&L account, and I will consider all indirect incomes, indirect expenses, which is not considered in departmental trading or profit and loss account. Then I will get the overall net profit or loss of the organization. Okay. So see, there are two methods of maintaining departmental accounts. Very simple. So one method is, see, the maintenance of the books is in the hands of the head office, central office. Central office. There is a central accounting department where they will maintain the records, the expenses, the incomes, the assets, liabilities, whatever are relating to each department, they will maintain in a separate column. For example, see, department 1, department 2, department 3, like that. For each department, we will allocate separate column, and in that column we will record. For example, there is a sales done by whom? Department 1, we will record in department 1 column. Purchases, which department? Department 2, we will debit to purchase department. So there are two methods of maintaining departmental accounts. One is maintenance of same set of books. That means the main office will maintain records of department. For each department, one column will be allocated. So that's why this method is called columnar method or tabular method. Okay. The amounts of various items of expenses and incomes are gathered by maintaining the books of accounts in a tabular or columnar format. Hence, this method is referred as columnar or tabular method. Accounting department, see, centralized in nature, maintains the entire records. Okay, this method is widely accepted as it is comparatively less expensive. There is one more possibility, sir, maintenance of separate set of books. See, each department will maintain their own books of accounts. So, but this is very costly. So that's why this is not mostly not followed by the organization. So in maintenance of separate books of accounts, each department will maintain their own books, separate books. In the one set of books, there is a central office, central accounts department. That central accounts department will maintain so records of every department, and one column is allocated for one department where we will maintain the records. So individual figures of various items of expenses and incomes are obtained by keeping the books of each department separately. Each department we will keep separately. Hence, this method is referred as unitary method. Each concerned department maintains their own records independently. So, although the method is very expensive, large sized firms usually practice this. Okay. So, there is a single set of departmental accounts or there is a separate set of departmental accounts. For all departments together, head office, I mean, not centralized office, centralized accounts department will maintain the records. For sometimes separate set of books also can be maintained by department. Okay, now the most important part is to ascertain the departmental trading account, profit and loss account, general P&L account. See, in case of preparation of departmental final accounts, how to ascertain the profit or loss of a department? First, sir, you prepare departmental trading account. See, department trading account you prepare. After completion of department trading account, you prepare department P&L account. Once you prepare department P&L account, sir, you prepare general P&L account. See, this general P&L account is for the entire organization. So what is the order? First, departmental trading account. Second, departmental P&L account. Third, general P&L account. And what is the object of preparing departmental trading account? To ascertain the gross profit or gross loss of particular department. And what is the main object of department P&L account? To ascertain the net profit or net loss of the department. And what is the object of general P&L account? Overall profit, overall net profit or net loss of the entity. Overall net profit or net loss of the entity. So this is the components what we are going to prepare in departmental accounts. So first one, departmental trading account. We know this. See, generally for commercial organization also we prepare departmental trading account. In trading account, opening stock we will take, purchases we will take, and then all direct expenses we will take, sales we will take, closing stock we will take, then we will get gross profit or gross loss. Same manner. Next, P&L account, whatever the gross profit or gross loss we get, so we will transfer it to P&L account, and in P&L account we will take all indirect incomes, indirect expenses, then you will get net profit. Now that net profit or loss will be transferred to general P&L account. And what are all the expenses, incomes which is not covered in departmental trading and P&L account, we will consider in general P&L account. Then you will get overall profit or loss of the organization. So this is how we will prepare. So the main object of departmental accounting chapter is each department performance we want to know. How? By preparing departmental trading account, P&L account. Once you got profit and loss, net profit from departmental P&L account, then transfer it to the general P&L account. Then you ascertain the overall profit or loss of the organization. Okay. See, look at this format. This is how you need to prepare. See, in this chapter, there are two sets of problems. One set of problem is, actually, only one set of problem, but there are two combinations, two situations here. One thing is normal departmental trading and profit and loss account. Simply, they will give you the details. You have to see which expenses, which incomes belongs to which department. You just apportion it. You have to write, see here, like departmental trading and P&L account for the year ended, particulars column. Each department one column, department 1, department 2, particulars, department 1, department 2. First, trading and P&L account, opening stock you take, purchases you take, direct expenses like wages you take, other direct expenses you take, transfer. This is very, very important. See, transfer means what? In the organization, between departments, the goods will be transferred. For example, from department X, the goods are transferred to department Y. Now from department Y, goods may be transferred to department X. So if there is a interdepartmental transfers, so they will be treated as sales to the transfer department, purchases to the transfer department. So transfer department account will be debited, transfer department account will be credited like a sales. See, that's why see transfer. Any transfer between the departments also we need to take. And sales, and transfer. See, suppose department X transferred goods to department Y. For one department it is sales, for another department it is purchases. That's why it is debited to the purchasing department, so credited to sales department, and then closing stock. The balance here is gross profit or loss. Now this gross profit will be carried to P&L account and consider indirect incomes and then indirect expenses like rent, salaries, depreciation, other indirect expenses. Then you will get net profit or loss. This net profit or loss of the department will be transferred to general P&L account. The departmental net profit is transferred. Now once you prepare departmental trading and P&L account, the next is general P&L account. See, this is for the overall entity. This is for the overall entity. So whatever the net profit you got from departmental P&L account, you transfer it to general P&L account. So by departmental P&L account net profit, and what are all expenses which is not considered in department P&L account, you consider here general expenses. Okay, and the most important is stock reserve, that is provision for stock, unrealized profit. This is one of the main discussions of this topic, this chapter. So that I am going to discuss later. So then you will get profit, net profit of the entity. Of course, that will be transferred to capital account. So tell me, in departmental accounts, first you prepare what? Departmental trading account. You will get what? Profit, gross profit. That will be transferred to departmental P&L. You will get departmental net profit. That will be transferred to general P&L account. And general P&L account, you will consider other indirect expenses which is not covered in departmental P&L account. And stock reserve, unrealized profit. What is unrealized profit? What is stock reserve? I will explain. Wait. And then you will get overall profit of the organization. That will be adjusted to capital account. See, this is the sequence. Okay. Sir, you said we need to prepare a departmental trading account, departmental P&L account. Each department one column. Suppose there are expenses. Some expenses are directly attributable to the department. Now you debit directly to that department. Some expenses are common. For example, rent. Rent we paid. The rent, suppose for example, there is a building. In that building, two departments are there. One floor is for one department, another floor is for another department. Now we are paying rent for the entire building. Now this rent is a common expenditure between the departments, common expenditure for the entire organization. Now in such a situation, this common expenditure we need to allocate between the departments. Similarly, there are common incomes. See, if there are incomes which is directly attributable to the department, you credit to that department. But if there are any common incomes, it will be allocated between the departments on some reasonable basis. So here you need to prepare departmental trading and P&L account. Na? See, sometimes all items may not be available individually. Here also, if they are not available, you need to allocate. If they are available, directly you take it. If you can able to identify that this income, this expenses belongs to this department, okay, you can directly. Suppose if there is any common expenses, common incomes, then you need to allocate between all the departments. For example, see here, step 1, determination of gross profit or loss. Suppose when you are preparing departmental trading account, okay, directly allocable direct expenses. For example, there are direct expenses, wages, so manufacturing expenses or any expenses which is directly allocatable. Debit to departmental trading account. Suppose direct expenses that cannot be directly allocated. For example, see, there are direct expenses which are common, which is not allocated to the particular department. So, for example, we paid wages to the workers. Workers worked in both the departments, department 1 as well as for department 2. So, common workers are there. We paid wages. Now, this wages what we paid is for the workers who worked for department 1 as well as for department 2. Then in such a situation, these wages you have to apportion the expenses on some suitable basis and debit to the departmental trading account. So on some reasonable basis you allocate. So which base is correct, you decide. For example, wages based on time. How much time they worked in department 1, how much time they worked in department 2. You allocate based on that. So directly allocable direct incomes. For example, there is a sales. Particular sales done by particular department. We know directly credited to that department. But if you don't know which department sales is this, suppose we received some income. That income is common between the departments, which is not particular one department. Then in such a situation, you allocate between the departments. See, directly allocable direct incomes credited to departmental trading account. Suppose goods transferred from one department to another department. Important, I told you. For example, department X transferred goods to department Y. For one department it is sales, for another department it is purchases. So debit to receiving department and credit to sending department. So therefore, what could be the journal entry? Transferee department to transfer department. Transfer department you credit, transferee department you debit, because transferee department it is purchases, debit. Transfer department it is sale. So this is how you need to prepare departmental trading and P&L account. If directly allocable, identifiable, allocate. If you are not able to allocate, apportion. After determining departmental gross profit or loss, transfer to departmental P&L account. Now come to the departmental P&L account. Same. If you any indirect incomes or indirect expenses, if they are directly allocable, allocate it. If you are unable to allocate, apportion. For example, see, directly allocable indirect expenses debited to departmental P&L account. If they are directly allocable, indirect expenses that cannot be directly allocated. Suppose if you are unable to allocate it, then apportion the expenses on some suitable basis and debit to the departmental P&L account. Suppose directly allocable indirect incomes, you credit to the department. Suppose if they are not directly allocated, then apportion the income on some suitable basis and credit to the departmental P&L account. Then you will get, after departmental, determining the departmental net profit or loss, you will go to transfer to general P&L account. Now the general P&L account, indirect expenses that could not be allocated to departments. Suppose any indirect expenses, if that is not part of departmental P&L account, then that will be debited to general P&L account. Similarly, any indirect incomes that could not be allocated to departments, then that could be credited to general P&L account. For example, interest received for the entire organization, not for particular department. Therefore, it will not be credited to departmental P&L account. Therefore, it will be formed part of general P&L account. Next, the most important thing is this one, provision for unrealized profit. So on closing stock, closing inventory, debit them to the general P&L account, and on opening inventory, credit them to the general P&L account. And once we got the balance from general P&L account, that will be transferred to overall net profit or loss. Sir, what is this? Unrealized profit. I will tell you. Listen. See, one department transferring goods to another department. The transfer may be at cost, may be at cost plus profit, may be at market price. Suppose if goods transferred by one department to another department at cost plus profit, and if those goods are not sold by other department, overall entity point of view, the profit is not realized. Therefore, that profit which is included in the unsold stock of the department, we need to eliminate in the overall books of the organization. That is called provision for unrealized profit. Okay, so that I will explain by taking numbers, then you will understand it better. Okay, sir, you said we need to allocate incomes and expenses. So if they are common, we need to allocate between the departments. So suppose incomes which are directly allocable to a specific department, we will credit to respective department. Suppose incomes which are common for more than one department, apportioned rationally over all departments. Suppose income items common for more than one department. For example, discount received. Suppose we purchase the goods and these goods are for both the departments. Now, whatever the discount received, this discount belongs to both the departments. Now, on what basis you will allocate? Sir, when will you receive discounts, sir? When you make purchases. So, based on net purchases, we will allocate. Whatever be the net purchases is there. I mean, purchase minus returns, purchase returns. So, based on that amount, we will allocate the discount received between the departments. Similarly, sales commission. For example, we made the sales. Now, the sales is common for both the departments. Sorry, commission. We appointed same persons, they will sell department X products, department Y products, both the products they will sell. Now whatever the commission we pay to the same person who sell both the department goods, now that commission what we pay, we will allocate between department 1 and department 2 or department X or Y. On what basis? Sales basis, net sale basis. Common sense na, see, when there is a common incomes, I mean items of income, so common for more than one department. Suppose any discount received, any sales commission received. See, they are talking about incomes. Incomes means maybe this department will act as a sales agent to somebody else. So any commission received, any discount received. So based on sales, based on net purchases, we will allocate. And other indirect incomes, any other indirect incomes like dividend received, interest received on deposits, profit on sale of fixed asset, it is created to general P&L account. Okay. And similarly, expenses also same. See, expenses items common for more than one department. For example, commission to purchase manager, carriage inwards. So based on purchases, we will allocate between the departments. Any selling expenses, commission to salesman, bad debts, discount allowed based on sales. Remember, when you are allocating incomes like sales commission, just now we have seen these are incomes. Discount received, sales commission based on net purchases, net sales. We have to allocate incomes. If the income is belongs to more than one department, then that will be allocated based on net purchases, net sales. Suppose if the expenses, common expenses between the departments, how they will be allocated? Suppose for example, commission to purchase manager, carriage inwards based on purchases, just purchases, not net purchases. Selling expenses, commission to salesman, bad debts based on sales. Any depreciation, insurance, repairs, maintenance based on the value of fixed assets. Rent, rates, insurance, heating. So based on floor area occupied. For example, rent is allocated based on floor area occupied. So any taxes, insurance, we have taken insurance for the department, two departments. Now the insurance is, maybe allocated based on the floor area occupied. Maybe heating, power. So based on horsepower, HP into hours worked. So some other basis. Okay. So this is the basis of apportionment. Now, any other expenses which are of the general nature, like general charges, sundry charges, managing director remuneration, miscellaneous expenditure, they are not for departments, they are general expenses. Then they will be transferred to general P&L account and cannot be apportioned between the departments. First of all, you need to see whether these expenses belongs to any particular department, then allocate to that department. Maybe these expenses or this income common between the departments, then allocate on some reasonable basis. For example, you paid commission to the purchase manager. On what basis commission will be allocated? Based on purchases. For example, you paid commission, sales commission to the sales agent. Based on sales, you allocate between the departments. For example, you received commission or you received discount. That will be income. That income, common income, is apportioned based on net purchases. For example, discount received is relating to purchase. So based on net purchases. Any sales commission we receive based on net sales, like this. So this is the basic things of this chapter. Now the most important chapter is interdepartmental transfers. See here. When goods and services are transferred from one department to another department, it is known as interdepartmental transfer. Now such transfers are considered as purchases of the transferee department and sales to the transfer department. That's what I said. That's why transferee department will be debited, transfer account will be created. That means we are indirectly creating to transfer department, means it is sales to them. And transferee department account, trading account will be debited. That means it is purchases for them. Now, valuation of transfer. See, this is the topic, very, very important. Just listen to me carefully. Suppose, Nana, there are two departments. Department X, Department Y. There are two departments. Suppose Department X transferred to Department Y goods at a cost. No problem. Because, for example, 100 rupees is the cost. Suppose they are selling one product. Department X is dealing with one product. Now that product they transfer it to Department Y. Now the cost is 100 rupees. We also transferred it 100 rupees. Is there any problem? Tell me. No, because there is no profit element. At cost only we transferred now. So therefore Department X account will be created with cost. So what is the entry here? Department Y account will be debit. Department X account will be credit, right? So if you take trading account, 100 rupees is created to Department X, 100 rupees is debited to Department Y. So no problem. So both will be set off. 100, 100. Now listen. Sometimes what happens now? Suppose there is a Department X, there is Department Y. Now Department X transferred goods to Department Y at a cost plus profit. Cost plus profit. For example, cost 100 rupees, we added another 25 rupees profit and 125 rupees we sold, we transferred. Now you tell me, So in the books of department X, how much is the income? Sales they booked, income, sales. They booked 125 sales. Right? In the books of department Y, how much purchases we will debit? 125. But the problem is, this stock which is sold by department X to department Y, if it remains unsold at the end of the year, unsold, that means it is not sold to outsider. This stock is still there in the department Y only, the unsold stock. Now you tell me, overall organization point of view, is this profit of 125 rupees is realized or not? Because see, sales 125 nana, cost 100, and we added a profit of 25. So we transferred it 125. That means in the books of department X, we booked a profit of 25. But is this profit what we have recognized in the books of department X? Is it really a profit to the organization? For example, this is A Limited. Is this A Limited point of view, is this 25 rupees is a profit? No, it is not a profit. Because goods are transferred from department X to department Y. Department X and department Y both are part of A Limited only, na? So, and this stock is still there with the department Y only. Therefore, this 25 rupees, even though it is recognized in the books of department X, but it is not profit for organization point of view. That's why this is called unrealized profit. This unrealized profit we need to eliminate. We need to eliminate. We need to eliminate. How we are going to eliminate it, sir? Simple. By creating a provision for unrealized profit and debiting general P&L account. So you credit to P&L account now you debit. But which P&L account? General P&L account. See here. So on closing stock, see this unrealized profit is there on the closing stock, because here the closing stock is 125. On this 125, 25 we need to eliminate. So what is the entry we will write? General P&L account debtor to provision for unrealized profit. This we can call it as stock reserve. And this stock reserve is deducted from the particular closing stock. Therefore, in the balance sheet, 125 minus stock reserve 25, we will show 100 rupees only. So therefore, general P&L account, see general P&L account is for the entire organization, right? So general P&L account is debited with stock reserve, nothing but provision for unrealized profit. First understand why we need to eliminate profit. Simple. One department transferred to another department at a cost plus profit. Therefore, the transferor department has recognized a profit. But that stock is there with the transferee department, which is not sold outside, which is not gone out of the organization. That means that stock is still unsold. Now, when stock is not sold between the departments, how can it be profit for the organization? Therefore, this profit, whatever we have recognized, we need to eliminate it, or we need to create a corresponding provision for unrealized profit. 25 rupees is the unrealized profit. So we create a provision for unrealized profit by debiting general P&L account. So general P&L account debtor to provision for unrealized profit. This is on closing stock. Suppose next year opening stock also this unrealized profit is there, na? So therefore you need to write it for the opening stock also. Provision for unrealized profit to general P&L account. So this is for closing stock. This is for opening stock for subsequent period. So this entry will continue, because last year closing stock, this year opening stock. Now the closing stock is at 125. That means in that 125 there is a profit of 25 rupees which is unrealized. So I created a provision for unrealized profit. So therefore this provision will continue for next year also, na? So that is the reason. Sir, and you mean to say that when one department transferred goods to another department, and that too at cost plus profit, this creation of provision for unrealized profit will arise. Suppose if one department transferred to another department at cost, where is the question of profit here? So when department X transferred to department Y at cost, so where is the question of unrealized profit? Why we need to eliminate? No need, na? So that is the thing. So when one department transferred goods to another department at a cost plus profit, this situation will arise. See here. See, sometimes at normal selling price also we can transfer. What is this normal selling price? Like for example, one department may transfer goods to another department at market price, normal selling price. For example, if it is sold outside, how much price it is charged. Same price it will transfer to another department. In that situation also, provision for unrealized profit is required to be made. I think you understand the purpose why we need to create a provision for unrealized profit, because from overall organization point of view, this is not a profit. So as per the concept of prudence, unrealized profit is need to be adjusted. Hence, provision for unrealized profit is maintained both on closing stock as well as the subsequent opening stock. Moreover, it needs to be noted that such provision is required to be created on goods received at higher than the cost from all predecessor departments and not only the immediately preceding department. So whichever department received goods higher than the cost, for all those departments, we need to adjust this unrealized profit by creating a provision for unrealized profit. See, what is unrealized profit? Unrealized profit refers to the profit we booked but not earned. Why? Profit booked by transfer department out of interdepartmental transfers. Although due credit is given to transfer department and the profit is reflected in the transfer department profit, this profit cannot be considered as earned or realized by the entity. By the entity, as it is not yet earned from any outside party. Suppose, for example, department X transferred to department Y. Overall organization point of view, nothing happened. If department Y transferred to outside, then it is a sale for us. So therefore, between interdepartmental transfer, one department transferred goods to another department at cost plus profit. At cost plus profit. So in the transfer department unsold stock, there is this stock which is transferred from department, another department. In that stock, whatever the unrealized profit is there, for that you need to create a provision, because this is not a profit for the entity. This profit is recognized but not earned. Prudence concept. Prudence says when income earned you recognize here. Without earning, how can you recognize? So therefore, what I need to do, first I need to identify how much worth of stock still unsold laying with the transfer department. Point number one. Point number two, I need to identify the GP ratio. How much profit? GP ratio of the transfer department. Then unsold stock, I mean the stock which is transferred from department into GP ratio you apply. Then you will get unrealized profit. See, for example, see here, one department X transferred to department Y at 125 rupees, now 100 plus 125. Suppose, for example, we transferred 1 lakh worth of goods at a 25% profit. So therefore 1,25,000. Now, so for example, at the end of the year, only 75,000 worth of stock is there. Now, you need to eliminate unrealized profit proportionately relating to 75,000. That means you need to, for example, for 1 lakh, 25,000 profit is there. So for 75,000, 12,500 profit you need to eliminate. Remember, unrealized profit, we need to create a provision. We need to adjust it only for the unsold stock. I think apart from this, there is nothing in this chapter. Okay. So I think you understood on closing stock, on opening stock, why we create provision for unrealized profit, because this is not a profit for the entity at the end of the year. So that's why we created a equivalent amount of provision for unrealized profit. And I will add one question also for the departmental account. So that question you see it, I think you'll understand it better. That's it. This is departmental accounts. Thank you. Now let us solve problem number 2, sir, in departmental accounting. So we solved problem number 4 and problem number 1. So see problem number 2. So A and Co has two departments, P and Q. Department P sells goods to Department Q at normal selling prices. Normal selling prices. What is normal selling price? Normal selling price means usually the outside customers at what price company is selling, the same price it is selling to department also. It's inter-department transfer also. Normal selling price. So Department P sells goods to Department Q at normal selling price. From the following particulars, prepare departmental trading and P&L account. See, again they are asking departmental trading and P&L. See, this chapter is only one kind of problem, that is trading and P&L account of the department. For the year ended, and also ascertain the net profit to be transferred to balance sheet. So overall net profit of the organization. That means we need to find out the department trading and P&L account we have to prepare. And after that, we need to ascertain the profit of the entity also, like how we have done in the last problem. First we ascertained raw material department, manufacturing department gross profits, then we prepared general P&L account. Now from that general P&L account we eliminated unrealized profit, then we got total net profit that we transfer to capital account. Similarly we have to do. So department P, department Q, opening stock given, purchases given, goods from P given. That means goods transferred by P to Q. So P point of view sales, Q point of view purchases, 8 lakhs. Wages given, traveling expenses given, closing stock at cost to the department given, sales given, printing and stationery given. Okay. Following expenses incurred for both the departments which are not apportioned between the departments. So common expenses, we need to apportion it. Salaries 33,000, advertisement 1,20,000, general expenses 5 lakhs, depreciation to be charged at 30% on machinery worth of 96,000. The advertisement expenses of the departments are to be apportioned in the turnover ratio, sales ratio, advertisement expenses. Obviously, even if he doesn't specify, also advertisement expenses will be allocated on sales ratio only. Salaries and depreciation are to be apportioned in the ratio of 2:1. He specified, and 1:3 respectively. So salaries, depreciation 2:1, 1:3 ratio. General expenses are to be apportioned in the ratio of 3:1. So general expenses we need to allocate based on 3:1 ratio. Very good. So in this problem, nothing great. So everything is given. So just we need to do the allocation. But here the most important point is department P is transferring goods to department Q, right? So there is a transfer, inter-department transfer. Whenever there is an inter-department transfer, we need to eliminate unrealized profit. Okay. So based on this sales, we have to, based on this information, we need to prepare the departmental trading account and P&L account, and also we need to prepare the overall net profit of the organization. Okay. So we'll try to solve this question, sir. First thing is very easy. First open the format, trading account, P&L account of department. Till that point, there is no problem. You have to do it perfectly. After that, you have to be very careful when you are eliminating unrealized profit. Okay. So same problem number 2. So department P, department Q. So departmental trading and P&L account for the year ended 31st March 2022. So particulars. So department P, department Q. So two departments are there. Department P, department Q. Similarly, particulars. Department P, department Q. So first departmental trading account. So first we will take opening stock. So what is the opening stock here? 5 lakhs nil. So 5 lakhs nil. Next purchases. What is the purchases portion? 28 lakhs, 3 lakhs. Then goods from P. To goods from P. How much? 8 lakhs. So it is purchases to department Q and sales to department P, right? Wages they have taken. I think we can take it as a part of this one. Wages 3 lakh 50, 2 lakhs. Sir, sometimes they are taking wages as part of trading account, sometimes they are not taking, sir. Suppose in examination, if you want to take, so please mention a note that wages, I assumed it is a direct expenses, so consider it here in order to have no risk. Okay. Now this side by sales. What is the sales of department P and Q? 30 lakhs. And two, what is this? How much amount is this? 30 lakhs, maybe 20 lakhs. Yes. And see the goods transferred to Q, 8 lakhs. The department P point of view, it is sales. Q point of view, purchases. 8 lakhs. Okay, done. Closing stock. By closing stock, what will be the closing stock here? 8 lakhs, 2 lakhs, 9,000. 8 lakhs, 2 lakhs, 9,000. Now to gross profit. Same what we have done in the last problem. So 30 lakhs plus 8 lakhs plus 8 lakhs. So it will be total 46 lakhs. Minus 5 lakhs, 28 lakhs minus 3 lakh 50. So it will be 9 lakh 50,000. What is this 9 lakh 50? 46 lakhs is the total. And this will be 22 lakhs 9,000. Minus 3 lakhs, 8 lakhs minus 2 lakhs. So it will be 9 lakh 9,000. So GP very easy, sir. All you have to do is just write the figures. Find out the figures from the question, just write it. Next, P&L account. So by gross profit 9 lakh 50,000, 9 lakh 9,000. Now what are all the expenses we had? Indirect expenses like traveling expenses is there. So take traveling expenses. Traveling expenses 20,000, 1 lakh 60,000. Traveling expenses. Printing and stationery given to printing and stationery. Printing and stationery 30,000, 25,000. And remaining expenses has to be a portion. For example, salaries, advertisement expenses, general expenses, depreciation is there. Now out of these salaries, I think the advertisement expenses of the department are apportioned in turnover ratio. Salaries and depreciation is to be apportioned in 2:1, 1:3 ratio. So everything is given in the question itself. So first, if we take salaries, what basis we are apportioning salaries, sir? 33,000. Salaries and depreciation are to be apportioned in 2:1, 1:3 ratio. So 2:1 ratio you apportion. Salaries 33,000 divided by 3 into 2. So it will be 22,000 and it will be 11,000. Total 33,000. Advertisement expenses. Advertisement expenses. So if we see advertisement expenses 1,20,000, what is the ratio given? Advertisement expenses apportioned in turnover ratio. What is the turnover ratio here? Turnover of the departments given 30 lakhs, 20 lakhs. So I think 3:2 ratio. 3:2. So advertisement expenses 1,20,000. So 72,000, 48,000. 3:2 ratio we apportion. And then general expenses 5 lakhs. To general expenses. See, general expenses, how we need to allocate given 3:1 ratio. General expenses total 5 lakhs. So 3,75,000, 3:1 ratio. 1,25,000. Okay. Next, depreciation. Depreciation apportioned in 1:3. So to depreciation. So depreciation is allocated on what basis? 1:3. So total depreciation is 30% on the machinery worth of 96,000. So 96,000 into 30%. So it will be 28,800. And this 28,800 will be apportioned in 1:3 ratio. So it will be 21,600. 7,200. 7,200. 21,600. I think everything we have recorded, sir. So we'll try to finish this. So to net profit. Sorry, this net profit we transfer to general P&L account. Correct? General P&L account. So whatever be the net profit will be net profit. So let us try to calculate this. So 9,50,000, 9,09,000. So it will be 4,23,800. I think, minute. Sir, in this one small correction is there, sir. Actually, they have taken salaries here. They have given clearly 33,000. But while solving the question, they have taken 3,30,000, sir. That's why the board of studies answer and our answer may be different. But anyway, we'll put one more zero. Maybe they forgot to put here 3,30,000. So if I allocate based on 3,30,000, it will be 2,20,000, 1,10,000. It's a, I think 10 missed, sir. That's it. So it will be 2,25,800, sir. This will be the profit of department P. What about Q? It will be 4,19,400. So 9,50,000, 9,09,000. Now we got the departmental trading and P&L account. So I mean, we got the profit of department. Now we need to prepare general P&L account because we want the profit of the entire organization. Like how we done in the last question, same manner. Also ascertain the net profit transferred to balance sheet. So therefore, we need to prepare general P&L account. First of all, to that general P&L account, we need to transfer. So by trade, I mean, what is that? Department P&L account. So department P, department Q, 2,25,800, 4,19,400. So this is what we transferred. Now the question is, we need to eliminate unrealized profit from this. Okay. Now the question is, how much is the unrealized profit is there? Provision for unrealized profit. How will you ascertain? In the question, is there any way? One thing we know, sir, department P transferred goods to department Q. So in the transfer, there is a profit element. But how much is the unrealized profit? We don't know. First, we need to ascertain the GP ratio. GP ratio of department P, because department P is transferring goods to department Q. So how much worth of goods transferred? In that, what is the profit element? So goods transferred into GP ratio. So GP ratio not given. In the last problem, GP ratio given. But last year opening they have given, closing they have not given. We ascertain. Same manner we need to ascertain here. How to ascertain GP ratio? Very simple now. Sales, I mean gross profit divided by sales. If you do, for example, 9,50,000 divided by 38 lakhs, 25% GP ratio. Very simple. So I'm doing working note. First working note, GP ratio of department P. What is the GP ratio of department P, sir? So GP margin or GP ratio is equal to gross profit divided by sales into 100. What is the gross profit here? Gross profit 9,50,000 divided by sales. What is the total sales? 38 lakhs into 100. So 9,50,000 divided by 38 lakhs. So 25% is the GP margin. Now what is the unrealized profit? So unrealized profit we want to ascertain. So how much worth of goods we transferred? In that, what will be the unrealized profit? On that, if you apply this 25%, then you will get the answer. Sir, first of all, here, how much worth of goods transferred by department P to department Q? You know, no, sir? Don't know. Closing stock given at cost to the department. So this is the closing stock of department Q, 2,09,000. And this is the closing stock of department P, 8 lakhs. And during there, how much worth of goods they send given. So how to ascertain how much worth of stock they have transferred? So 2,09,000 is the closing stock of department Q. And see here, actually department Q closing stock is 2,09,000. And how much is the total purchases of department Q, sir? Purchases 3 lakhs and transferred from P 8 lakhs. So therefore 3 plus 8, total 11 lakhs purchases. In that 11 lakhs, 8 lakhs is purchased from department P. So therefore, can I say 2,09,000 is my closing stock divided by 11 lakhs into 8 lakhs. So 1,52,000 is the closing stock of department P. That's sir. Once again, sir, I'm telling. Simple, sir. Stock of department P in closing stock of department Q. In this question, actually, they have not told how much is the worth of stock they transferred, but we know how much purchases they have made. So their total closing stock is 2,09,000. Department Q total closing stock is 2,09,000, right? And their purchases, total purchases is 11 lakhs. Out of that, 8 lakhs they purchased from department P. That means proportionately, if you take out of 2,09,000, proportionately you take, it will be 1,52,000. So this is the best way to get it. So 1,52,000 is the value of closing stock of department P including department Q. Now in this 1,52,000, still it is not sold because it is there as a closing stock. Into 25% profit if you take GP ratio on sales. Now the important thing is 1,52,000 into 25%. So it will be 38,000 is the unrealized profit. Because the department P is transferring to department Q at cost plus profit. So what is the profit? 25%. So 1,52,000 is the value of stock of department P including department Q. So now 38,000 I need to eliminate. So I will write to provision for unrealized profit, 38,000. So what will be my profit that I will transfer to capital account? That is net profit transferred. Two lakh 25,800 plus 4,19,400. So it will be 6,07,200. This will be my total profit. Okay. So that's it, sir. This is problem number 2, sir. Very simple problem. The only thing is gross profit ratio we need to ascertain, and this may be worked as second working note. Stock of department P in closing stock of department Q proportionately we ascertain. See, we know this is the closing stock, this is closing stock, and we know this is the total purchases of department Q, total purchases. In that, the purchases from department Q, department P. So from department P, proportionately we have taken. So out of total 11 lakhs, 8 lakhs is goods purchased from P. So how much is in 2,09,000? Because in other problems they have mentioned this much of worth of goods they send, but here they have not mentioned. That's why in the closing stock, what is the share of closing stock of the department P? 1,52,000. In this 1,52,000, what is the profit element? 25%. We ascertained. So I eliminated. So this is the answer. 38,000 is the unrealized profit we need to eliminate. In examination, directly they can ask MCQ also. How much is the unrealized profit? 1,38,000. So this is problem number 2, sir. Okay. Now let us discuss accounting standard 12, accounting for government grants, sir. So very small standard. So let us discuss accounting standard 12. The business enterprises will receive different kinds of assistance from government. So when any kind of assistance received by business enterprises from government, what is the accounting treatment we need to follow in the books? So that will be the main agenda of this standard. And what we are going to cover in this standard is, first we should understand what is the object of accounting standard 12. Then we should understand the scope, because whether this standard is going to cover all kinds of assistance, the answer is no. this standard has its own limitations. So this is not going to cover all kinds of assistance which is given by the government to the business enterprises. And only those assistances which is fit into the definition of government grant, which is defined in this standard, are applicable, covered under this standard. It is not what we generally presume as government grant is covered under accounting standard 12. That grant has to be satisfied the definition of government grant, and it will, subject to the scope of this standard. And we need to understand the definitions. Government, what is government grant? So government, we all know, state government, central government, local authorities, or maybe foreign government, any kind of government agencies. So all these things are government. And recognition of government grant. See, when we need to recognize the government grant in the books, so that will be the main topic of this standard. So this standard will prescribe us the recognition criteria of government grant. And also, when we receive government grant in different situations with different purposes, what is the accounting treatment we need to follow? What is the appropriate method of presentation we need to do? Because see, these government grants, whatever we receive from the government, if they are directly affecting our financial statements. So therefore, appropriate method of accounting is very much necessary to ensure there will be true and fair view of financial statements. So this standard will provide us the different the situations, whatever the grant we received, what is the accounting treatment we need to follow. So it is covered by topic number 5 to 9. And then there is a topic called refund of government grant, which is also very important. See, whenever government is giving some kind of assistance, some kind of grant to the business enterprises, definitely they will put some conditions. So very rarely government will give grants graciously, freely. So definitely when there are some conditions to be fulfilled, so if you violate those conditions, the grant, whatever you received, you need to refund it back to the government. So when there is a refund of government grant, what is the accounting treatment we need to follow? That is also covered under accounting standard 12. And then finally, we end up with learning some disclosure requirements. According to AS 12, what disclosures we need to make in the financial statements relating to government grants, we need to understand. Now let us start with the objective. Sir, what is the object of accounting standard 12? See, the object of accounting standard 12 is to prescribe appropriate accounting method for accounting of government grant. Whenever we receive any government grant, so what is the appropriate method we need to follow for accounting of that government grant? See, government grants may be in the form of subsidies, maybe in the form of cash incentives, maybe in the form of duty drawbacks, maybe in the form of tax holidays, maybe in the form of tax concessions. So see, different ways government will give you assistance. Sometimes direct cash assistance will be given. Sometimes government will provide you tax concession, tax holidays. Sometimes government will give you the facilities at subsidized prices, material at subsidized prices. Sometimes they will give you the refund of taxes. So various ways government will give you assistance. But is all kinds of assistances are covered under this standard? Answer is no. Even though the object of this standard is to provide appropriate accounting treatment for accounting of government grants, but we should understand which kind of grants are covered under this standard. So first we should understand, we will go directly to the government grant. See, what this standard has defined is, first of all, government means here local, national, state or international government. So state government, national government, central government, local government, international government is also covered, any government agencies. So these people can provide assistance, grants. Now what is government grant as per accounting standard 12? See, accounting standard 12 says government grant is an assistance in the form of cash or kind. See, they said government grant is an assistance in cash or in kind. Either in the form of cash or in the form of kind. For what? For past or future compliance of conditions. Either you satisfy some conditions past, or we put some conditions you need to satisfy in the future. So what is the notable point in government grant? Government grant is an assistance in the form of cash or kind. Suppose for example there is a government grant which is not in the form of cash, not in the form of kind. The standard is not applicable, as simple as that. For example, the electricity cost per unit for an industry is 50 rupees. Now government is giving you at a concessional price of 25 rupees. Now remaining 25 rupees is an assistance which is given by the government. Is it in the form of cash? No. Is it in the form of kind? No. So therefore it is not covered under accounting standard 12. So only those assistance which is, I mean, in the form of cash. Suppose for example you are starting an industry in a backward area. Government is giving you some amount. So it's a cash assistance, right? Or government is giving you some cash for welfare expenses. It's a cash assistance. Or sometimes kind. For example, government is giving you a land free of cost, or government will assist you in purchase of plant and machinery. So these are assistance in the form of cash or kind, and subject to fulfillment of conditions. See, any government assistance which cannot be reasonably valued is excluded from this standard. Very, very important. Suppose government is giving you some assistance, but you cannot have a value placed upon it. Then how can you bring it in the books? So it sometimes the assistance what you are receiving from the government may not have a reasonable value placed upon it. For example, you are receiving some kind of technical assistance from the government, or maybe some kind of expert advisory from the government or governmental agencies. You cannot have a reasonable value placed upon it. Then when you can't place it upon it, when you can't assign any reasonable value, so please don't cover under this standard. So now I think you understood what is government grant. So the important point to remember is government assistance in the form of cash or kind is covered under this standard. If it is neither in the form of cash nor in the form of kind, then this standard is not applicable. Okay, so we completed what is government grant. What is the object of this standard? So the object of this standard is to provide accounting treatment, appropriate accounting method for government grant. Now, the most important thing is scope. Sir, whether all kinds of assistance in cash or kind is covered? No, subject to scope. Scope has prescribed three conditions, three things. Now, in these three things, this standard is not applicable. This standard is not applicable for the following. First, last one I will see, government participation in the ownership of the entity. Suppose government is purchasing the shares of the company, participation in the ownership of the entity. So it is not covered under accounting standard 12, which is excluded from the scope of AS 12. For example, in government entities, predominantly the investment is made by government only. Na? So government participating in the ownership of the entity. Now, can I apply AS 12 for purchasing shares, investment in shares of company by the government? Answer is no. For that company, can I apply AS 12? For example, there is a company called A Limited. In that, the state government has invested. The state government has invested 60% invested. Obviously, it will become a government company. Now, can I apply AS 12 for this A Limited? Government participation in the ownership of the entity. This standard is not applicable. Why? Because it is excluded from the scope of this standard. Government participation in the ownership, even though it's a kind of an assistance, maybe government wants to help that company. For example, there is a loss making industry. Now government want to revive that. So government invested in the equity of that company. Still, it may fit into the definition of assistance in the form of cash, but still it is excluded from the scope of this standard. Therefore, this standard should not be applied for government participation in the ownership of the entity. First thing. Second also very, very important, government assistance other than in the form of government grant. Sir, government is giving you some kind of assistance, but it is not in the form of government grant. So we see just now government assistance in the form of cash or kind. Suppose if it is not cash nor kind, so no cash assistance and no kind. Some kind of expert advisory, consultancy services which cannot have a reasonable value placed upon it, then this standard is not applicable. So this standard has its own limitations. I told you, only when you receive something in the form of cash or kind, the standard is applicable. And also the first one, any special problems arising in accounting of government grants. Actually, this is not like this. See, special problems arising in accounting of government grants reflecting the effect of changing prices. reflecting the effect of changing prices or supplementary information of similar nature, like that. Any special problems arising in accounting of government grants reflecting the effect of changing prices. See, this standard is not applicable. I will explain this. Sir, age 12 is not applicable when special problems arises in accounting of government grants which is reflecting the effect of changing prices. See, the word is what? Reflecting the effect of changing prices. Now the prices are changing. Okay. Now because of the changing prices, there will be effect. So to reflect that effect, what is the method of accounting I need to follow? This standard is silent. Sir, what is this? See, special problems arising in accounting of government grants reflecting the effect of changing prices. So that means indirectly they are talking about inflation accounting. For example, sir, I will tell you. For example, government has given you a plant and machinery. Suppose, for example, they have given you plant and machinery 10 lakh rupees. Okay. Now 10 lakhs worth of plant and machinery they have given. Now suppose the life is 5 years. Now once the life is over, this plant and machinery again we need to replace. Now every year we provide depreciation, or we transfer the amount to provision for depreciation, or to that extent of the loss we create a fund to replace this plant and machinery, right? Now see, after 5 years, for example, the plant and machinery may be 15 lakhs. So therefore, the current purchasing price and the future purchasing price at the end of the 5th year, maybe it went to 15 lakhs. So now initially when we receive this asset, we have received it at 10 lakhs. Now can you tell me the change in prices? How much change in price? 5 lakhs. Now whatever the change in prices happened, the effect of such a change in my books, is this standard is going to address? Is this standard is going to address? Answer is no. You cannot say, sir, we received grant in the form of asset from the government, 10 lakh rupees. Now the cost is 15 lakhs. So how I need to replace it with, how I need to brought it to current cost? Because see, in accounts, the historical cost concept has become outdated mostly. So most of the assets, they want to reflect at their current cost, fair market value. Now in that situation, the inflation accounting will play a major role, right? Now, if I consider inflation accounting into account, there will be definitely changing prices are happening. Now because of these changing prices, there will be effect on my books. Now how I am going to address this issue? Is this standard is going to address? No, this standard is not going to address any special problems arising from accounting of government grants. Now suppose for example the standard says whenever government has given you something, suppose for example you will see any non-monetary asset given by the government at a concessional price, you will record it acquisition cost. That means whatever the price you acquired, you need to record it that value. For example, the plant and machinery cost is 25 lakhs, but government has given you at 10 lakhs. So you have to record it 10 lakhs only. You have to record it 10 lakhs only, but the market price may be 15 lakhs. So in future, because of changing prices, there will be effect. That effect is not going to be addressed by this standard. So therefore, understand, accounting standard 12 is not going to address the issue of inflation accounting. So inflation accounting, because of the changing prices, whatever the effect is there, so that special problem is not going to be addressed by accounting standard 12. Okay. So tell me what are the things which is excluded from the scope of accounting standard 12? Government participation in the ownership, government assistance other than in the form of government grant, special problems arising in accounting of government grants reflecting the effect of changing prices. Next, recognition of government grants. Okay sir, we received government grant. Okay. When we need to recognize the government grant? See, accounting standard 12 says there are two conditions you need to satisfy in order to recognize the government grant. First condition is there must be a reasonable assurance that the entity will comply with the conditions attached to the grant. What is that? Reasonable assurance. Very, very important word is reasonable assurance. there must be a reasonable assurance that government is and company is going to satisfy the conditions attached to the grant. There must be a reasonable assurance. Second condition is when ultimate collection is reasonably certain. The ultimate collection is reasonably certain. So only if these two conditions are satisfied, we need to recognize government grant in the books. Sir, government has just now sent the notice, sir. In that notice, they said that we are going to give you this much grant. Can I recognize the grant? No, you should ask two questions according to AS 12. First question is there a reasonable assurance that the entity is going to fulfill the conditions attached to the grant? How we know, sir, reasonable assurance that the entity is going to fulfill the conditions? Understand the intention of top management. Ask the top management, the intention of the top management, whether they are ready to fulfill the conditions attached to the grant, or simply they will receive the grant and whatever the conditions attached they does not have the interest to fulfill it. Now standard says there must be reasonable assurance. You should get reasonable assurance. Before you recognize government grant in the books, you get reasonable assurance from the top management that are you willing to satisfy the conditions attached to the grant. For example, government is giving you 25 crores grant and government said coming 5 years, every year you need to provide 20 job opportunities. So first year 20, second year another 20 job opportunities, third year another 20, fourth year 20, fifth year 20. That means you need to provide job opportunities for 100 people in the next 5 years, every year 20, 20, 20, 20, 20. Now, are you willing to satisfy these conditions? Is there a reasonable assurance? You ask the top management. Top management said, we don't have the intention to provide any job opportunities. We will lay off the existing employees. Then there is no reasonable assurance. Don't recognize government grant. Sir, there is a reasonable assurance. Top management is committed that they are going to fulfill the conditions attached to the grant. Can I recognize? No. Wait. Is there ultimate collection is reasonably certain? Ultimate collection is reasonably certain. So there should be reasonable certainty in two things. One is fulfillment of conditions. See, in fulfillment of conditions, there is no reasonable certainty. There is a reasonable assurance. Only top management can give you assurance that yes, we are going to fulfill the conditions. Second thing is there must be reasonable certainty that the collection is certain. Sir, most of the times in the case of government, we don't know until we receive the amount. So whether we are going to receive or not, we don't know. That's why this condition has been brought. They may say, we are granting you the amount. Yes, they have given the notice. In the year 2020, they have given the notice. Now this is the year 2024. Still amount is not created in my bank account. You know how, government departments, government organizations, they have their own procedure. Accordingly, they will give the benefits. Of course, they will announce it. They will announce that this company, we are going to give you 20 crores grant. When we also don't know. So that's why standard says, see, you recognize the grant, but it is not yet ultimately collected. What is the use of recognizing it? That's why wait till actually you received. So there is a reasonable certainty. Actually, are you going to receive it? Is collection is reasonably certain? Then only you recognize. Simple announcement does not bring you reasonable certainty. So therefore, as a business entity, when I need to recognize my government grant, first thing is there a reasonable assurance that you are going to fulfill the conditions attached to the grant? Second thing is there a reasonable certainty that the collection is certain? If any one of these conditions fail, don't recognize the grant. And is there. So both the conditions we need to fulfill. Okay. So tell me, two things you have to remember. Reasonable assurance, reasonable certainty. Reasonable certainty regarding what? Collection. Reasonable assurance regarding what? Fulfillment of conditions attached to the grant. Now, by satisfying these two conditions, you recognize the government grant. Okay, sir. Sir, then when we receive the grant, what is the accounting treatment? See, if you see accounting standard 12, they are telling you two approaches. One is capital approach. Another one is income or revenue approach. See, capital approach says, whatever the grants you are receiving now, you treat it as grants of capital nature and you transfer it to capital reserve. Second approach is income approach. Whatever the grant you are receiving from the government, this is your revenue, income. Treat it as income. Or you credit to P&L account in a systematic manner. So very simple, na? When you receive something from government, either capital approach or revenue approach. They are saying either you follow capital approach or revenue approach. So the intention of capital approach is treat the government grant as a part of shareholders fund. That means credit to capital reserve because it is of capital nature. Suppose if you are treating it as income approach, revenue, then transfer it to P&L account, credit to P&L account as a income. Sir, when I need to follow capital approach, when I need to follow income approach. See, in accounting standard 12, if you read accounting standard 12, there is an arguments in favor of capital approach, arguments in favor of income approach. They say, what are the arguments in favor of capital approach? See, when you receive something from the government, if it is directly related to the total capital outlay, it is directly relating to the total capital contribution of the entity, and it is not required to give it back to the government, then you may treat them as part of capital approach and treat them as a part of shareholders fund. When government grants you receive is directly relating to the capital contribution or directly relating to the capital outlay. For example, you are starting a new project. The cost of the project is 100 crores. Now, out of 100 crores, 50 crores is given by the government. That means this 50 crores is directly relating to the capital contribution. And there is no condition that you are going to repay the government back. That means there are no conditions attached to the grant. Then in such a situation, government is giving you something very freely and it is relating directly to this one. Capital, therefore you follow capital approach. So when I follow revenue approach, see, when government is giving you something and definitely they put some conditions. Now you have conditions to fulfill it. To fulfill conditions, you need to incur some cost. So there is a cost, therefore government grant will become your income. So income and expenses, so matching concept you need to follow. Because government grants are very rarely gracious in nature. So if they are very gracious in nature, capital approach. If they are attached with some conditions, anyway you have to fulfill some conditions. So therefore whatever the grant you received, treat it as income. So that is income approach. So in case of income approach, created to P&L account in a systematic manner. So you understood the two approaches, sir. Very simple, sir. Whenever you receive something from the government, either capital approach or revenue approach. Capital approach says you receive a grant if it is directly relating to the total capital outlay. It is directly relating to the total investment you made. And there are no conditions to be fulfilled. It is not required to repay it back to the government. Then you better to treat them as a part of capital approach. And suppose, for example, government is giving you something and there are conditions attached to it, and that means they are not gracious, they are not giving freely, you have to fulfill certain conditions. Like in the example I said, for example, you need to create 20 job opportunities in the next 5 years. Now that is, you have to fulfill certain conditions relating to this grant. Then grant can be treated as what? Income. And it is systematically created to P&L account to match with these expenses. That is called income or revenue approach. So whatever approach you feel correct, you can follow it. Next. Now one by one we will see. Suppose you receive any monetary grant in the form of cash. For example, see, first one, grants in the nature of promoter's contribution. Sir, what is grants in the nature of promoter's contribution? See, if you see, promoter will bring what? Capital. Initial capital he will brought. Similarly, government is giving something which is directly relating to the investment, directly relating to the capital contribution. That is called grants in the nature of promoter's contribution. When grant is in the nature of promoter's contribution, you have to follow capital approach. Because promoters is bringing capital. Na? So when the grant is in the nature of promoter's contribution, what we need to treat it as, we need to treat it as part of shareholders fund. Therefore, we can transfer to capital reserve. So the entry is bank account data to capital reserve. So second one, grants related to fixed assets. Sir, sometimes for purchase of fixed asset, government is giving you grant. Now you have to see whether it is depreciable or non-depreciable. Depreciable asset or non-depreciable asset. Suppose you are receiving grant relating to depreciable fixed asset. Then you have two options. One is whatever the grant you receive from the government, you directly deduct from the cost of the asset. And the remaining depreciable amount, remaining value of the asset will be depreciated over the remaining life, over the life. Or you treat the grant as deferred income and credit to P&L account in a systematic manner. So systematic manner over the life of the asset. So once again, sir, when government is giving any grant, if it is relating to fixed assets, you have to see whether that fixed asset is depreciable or non-depreciable. If it is a depreciable fixed asset, you have two options. One is deduct from the gross value of the asset. Directly reduce the grant from the concerned asset. That means when you receive a grant, bank account data to asset account you will write. Therefore, whatever the remaining value of the asset is there, that will be depreciated over the life of the asset. This is one approach. Another approach is when you receive any grant relating to depreciable fixed asset, instead of directly deducting from the cost of the asset, what you can treat it as, you can treat it as deferred government grant. That means when you receive the grant, bank account data to deferred government grant. Don't credit to P&L account directly at a time. Credit to P&L account over the life of the asset in proportion to the depreciation. So treat it as deferred grant, recognize as income in proportion to the depreciation. So depreciate the asset as usual. Because the cost of the asset is not disturbed in this case. So what are the entries? Bank to deferred government grant or deferred government grant to P&L account. Okay, so this is another approach. Suppose if you are receiving any grant relating to non-depreciable asset means, for example, you are receiving any grant relating to purchase of a land. Land is a non-depreciable asset or any kind of non-depreciable asset. When you receive any grant relating to non-depreciable asset, you have to see whether any conditions attached to it or not. If the conditions attached to it, then what you need to do is you need to treat the grant as deferred government grant and you credit to P&L account. So over the life to match with that cost what we are going to incur to fulfill the conditions attached to the grant. Or otherwise, if there are no conditions attached, simply credit to capital reserve. Don't adjust the asset value because these are non-depreciable assets. Non-depreciable assets, suppose grant received relating to non-depreciable asset. So can I reduce this grant amount from the asset cost? No. That is possible only in case of depreciable fixed asset. Because depreciable fixed asset, if you reduce the cost of the grant amount from the cost of the asset, so depreciation will be affected. So we can reflect the effect through depreciation. But it is not so in case of non-depreciable asset. That's why standard says if you receive any grant relating to non-depreciable asset, you have to see whether any conditions attached to the grant or not. If there are no conditions attached to it, then whatever the grant you receive, simply credit to capital reserve. If there are conditions attached to grant, then what you need to do is whatever the amount you receive, you treat it as deferred government grant and you credit to P&L account over the life in a systematic manner over the period of meeting the cost to fulfill the conditions attached to the grant. See here, suppose if there are conditions to be fulfilled, treat it as deferred government grant and credit to P&L account in a systematic manner over the period of the time. That means matching concept. You follow matching concept. Bank account data to deferred government grant and this deferred government grant will be transferred to P&L account. In proportion to the cost what you are going to incur to fulfill the conditions attached to the grant. Suppose if there are no conditions, simply credit to capital. Sir, can I adjust to the asset cost? No. Non-depreciable asset, not possible. So bank to capital reserve. So this is relating to assets. So to put it simply, if you are receiving any grant relating to fixed assets, depreciable fixed assets, you have two options. Reduce from the cost of the asset or remaining value will be depreciated over the life. Second, you treat it as deferred government grant, credit to P&L account in a systematic manner over the life of the asset in proportion to the depreciation. If it is relating to non-depreciable fixed assets, simply you have to see whether conditions attached or not. If conditions are not attached, transfer to capital reserve. If conditions are attached, then whatever the grant you received, you transfer to deferred government grant and credit to P&L account in a systematic manner in proportion to the cost what we are going to incur to fulfill the conditions attached to the grant. Sometimes revenue grants we will receive. So to meet any expenditure, sometimes government will give you some grant. For example, government is giving you 10 crore rupees to spend for the employees' welfare or to provide awareness about AIDS or provide awareness about the sanitization, primary health care to the people. Like that, so many government CSR activities, corporate social responsibility activities. To fulfill that, government will give some kind of cash assistance to meet the revenue expenses. Then either you deduct from the concerned expenses. For example, government is given you 10 lakh rupees to pay the salaries of your employees. So you deduct this 10 lakhs from the concerned salaries or deduct from the related expenses. You have one option. When you receive something to meet expenses, revenue grants. Or you have another option is treat it as other income in the P&L account in a systematic manner. Whatever the grant you receive to meet the expenses, so revenue expenses, to directly adjust from that expenses, or you treat it as deferred government grant. That means bank to deferred government grant, and this deferred government grant will be created to P&L account over the life to meet the concerned expenses, whatever the expenses for which purpose you are receiving the grant. To meet that expenses, whatever the cost you are going to incur, in proportion to that you transfer to P&L account. This is monetary, sir. Suppose if I receive any non-monetary grants, sir, any non-monetary grants like assets, like for example land, buildings, if I receive anything freely or at a concessional price, simple. When they are given at free of cost, suppose government is given land freely or plant and machinery freely, then at nominal value. You recognize them at some nominal value. Suppose government has given at a concessional price, for example, 1 acre of land, okay, 10 CR. Government is giving you 5 CR. Therefore, 5 CR is what? Concession. What is the acquisition price? 5 CR. Now you recognize it that acquisition cost. So when government has given any non-monetary grant, you have to see whether that non-monetary grant is given at freely or at a concessional price. If it is given freely, some nominal value you assign it and you will recognize. Nominal value means some immaterial value, 100 rupees, 1000 rupees, like that. Suppose government has given anything at a concessional price, you recognize at a acquisition cost. At what price you acquired, at that price you need to recognize. And see, once you recognize the asset at an acquisition cost, later on any special problems arising from it, government grant, this standard is not applicable. That's why in scope we said any special problems arising from the accounting of government grants reflecting the effect of changing prices, inflation, this standard is not applicable. And refund of government grant. Suppose, sir, if an entity is failed to fulfill the conditions attached to the grant, then such grants may be refunded by the entity to the government. So what is the accounting treatment for refund? Simple. At the time of receiving of the grant, what entry you have written, just reverse it. For example, when you receive the grant, you created to capital reserve. Now debit to capital reserve. Suppose at the time when you receive the grant, you transfer to deferred government grant and you credit to P&L account, right? Now whatever the balance is there in the deferred government grant, first you cancel it. Okay. And the remaining balance you transfer it to P&L account. So what entry you have done at the time of receiving of the government grant, just you simply do the reversal. For example, grants relating to promoters contribution. When you receive something in relation to promoters contribution, what you have done? You credit to capital reserve, now the debit to capital reserve. Suppose relating to fixed assets, when you receive a grant relating to depreciable fixed asset, you might deduct it from the asset cost. Now add to the asset cost. So debit to fixed asset. When you receive, you credit to fixed asset, now debit to fixed asset. And depreciate the revised book value proportionately over the remaining useful life. Or debit deferred grant or capital reserve. For example, when you receive the grant, you might transfer it to deferred government grant. And the deferred government grant, you might transfer it to P&L account over a period of time. Now you are refunding it back, right? At the time of refund, whatever the balance is there in the deferred government grant, first you cancel it. The remaining amount of refund will be adjusted to P&L account. For example, you are refunding the amount of 10 lakhs. And initially when you receive the grant, you created to deferred government grant 10 lakhs. Suppose out of 10 lakhs, 5 lakhs is already transferred to P&L account. Only remaining 5 lakhs is there in deferred government grant at the time of refund. Now at the time of refund, what is the entry you will write? First you cancel this deferred government grant. So therefore deferred government grant account debit 5 lakhs. And how much you are giving refund back? 10 lakhs. So the balance will be debited to P&L account. 5 lakhs. That's it. Suppose when you receive the grant, you directly adjust it to asset. For example, bank account data to fixed asset. Now when you are refunding back, now fixed asset to bank. Suppose when you receive the grant, bank account data to capital reserve. Now you are refunding back capital reserve to bank. So what you have done initially, just reverse it. Okay. Suppose if you receive any grant relating to revenue, either you reduce it from the concerned asset, or you may treat it as deferred government grant and transfer to P&L account over a life, over the systematic manner over the period. Same manner, apply first against unamortized deferred government grant and balance, if any, debit to P&L account. So first apply towards unamortized deferred government grant. For example, when you receive the grant, you credit to deferred government grant, right? That you will transfer to P&L account. Now whatever the unamortized balance still not transferred to P&L account, that balance you first adjust. And the balance, if any, you debit it to P&L account. Just now I told the treatment, this treatment. So refund treatment, quite simple, sir. Once you have done, initially when you receive the grant, what entry you have done, just simple reversal of the same. And disclosure. So what disclosures we have to make in the financial statements? For example, what is the accounting policy we need to follow for accounting of government grants? So we need to write clearly in the notes to accounts that we have followed this policy. So like that. And what is the nature and extent of government grant received in financial statements during the year? So what is the nature and extent of government grants we received during the year? So this is the accounting standard 12. So very simple standard. So tell me, what is the object of this standard? Provide appropriate methods for accounting of government grants. Government grants may be in the form of subsidies, cash incentive, due to drawbacks. But this standard says government grant is assistance in the form of cash or kind for compliance of past or future conditions. And any government assistance which cannot have a reasonable value placed upon it, not covered under this standard. And what is the scope of the standard? Whether this standard cover all kinds of assistance? No. Three things are excluded. First one, government participation in the ownership of the enterprise. Government assistance other than in the form of government. That means anything which is received not in the form of cash or kind, not covered under this standard. Any special problems arising in accounting of government grants reflecting the effect of changing prices or supplementary information of similar nature, that is inflation accounting. After recognition of government, by following this standard, after recognition, whatever the consequences arises because of changing prices, this standard is silent, not applicable. And then recognition. When will you recognize government grant? Two conditions: reasonable assurance that the conditions attached to the grant will be fulfilled, and when the ultimate collection is reasonably certain. And what is the accounting treatment? Capital approach, revenue approach. Capital approach says you treat the grant as a part of owner's fund, and revenue approach says you treat the grant as an income. Okay. Now, if you receive grant relating in the nature of promoter's contribution, credited to capital reserve. If it is really relating to fixed asset, you have to see depreciable or non-depreciable. If it is a depreciable, you have two options. Either you reduce from the cost of the asset, or you transfer to deferred government grant, and this will be credited to P&L account in proportion over the life of the asset in proportion to the depreciation. In case of non-depreciable asset, whether conditions attached or not, if attached, then treat it as deferred government grant and credit to P&L account in proportion to the cost what you are going to incur over the period. Suppose no conditions are attached, transfer to capital reserve. If any revenue grant is received to meet any expenditure, either you deduct from the concerned expenses or you treat it as deferred income and credit to P&L account in a systematic manner over the period. And non-monetary grant, if you receive any asset concessional price, acquisition cost, freely, nominal value, and if you are giving refund to the government, if you are unable to fulfill any conditions, whatever the entry you passed at the time of receipt of the grant, same entry you reverse. Except when you receive the grant, you might have transferred to deferred government grant. Later on, you might have transferred some amount to P&L account. Now, at the time of refund, whatever the unamortized balance in the deferred government grant, first you need to cancel that. Remaining amount you adjust it to the P&L account. And according to AS11, what are the adjustments? What are the things we need to disclose? Accounting policy and the nature and extent of government grant recognized in the financial statements during the year. So I think hardly takes 3 to 4 minutes to revise the entire standard. Okay, that's it. This is accounting standard 12. I covered each and every point. Thank you. Okay. Problem number 1. You see, Z Limited purchased a fixed asset of 50 lakhs, which has the estimated useful life of 5 years. With a salvage value of 5 lakhs. On purchase of the assets, government granted it a grant of 10 lakhs. Pass necessary journal entries in the books of the company for the first 2 years if the grant amount is deducted from the value of the fixed asset. First of all, tell me what is this type of the question. See, we are purchasing a fixed asset. How much? 50 lakh rupees. And what is the life of the fixed asset? 5 years. What is the salvage value? 5 lakhs. Now, on purchase of the asset, government is giving grant of 10 lakhs. Now, pass the necessary journal entries in the books of a company. For first 2 years, if grant amount is deducted from the value of fixed asset, tell me, sir, in relation to fixed asset, if any grant is received, how you are going to do the accounting? I told you, in relation to fixed assets, when you receive grant, you have to classify first whether it is depreciable or non-depreciable. Now, in this case, tell me, is it depreciable or non-depreciable? Depreciable. Where it is said in the question? Simple. See, they said estimated life with a salvage value of 5 lakhs. So if it is non-depreciable, they would have definitely mentioned it. So based on the information given, definitely it is depreciable only. Now in case of depreciable fixed asset, there are two options I told. Here which option they selected? First one, they reduced grant amount from cost of the asset. Now they are asking entries for the first 2 years. Very simple, na? So what entries you will write here? Tell me. Problem 1. So date, particulars, debit rupees, credit rupees. Okay. Now first year. Sir, first when we receive the grant, sir, we purchase the fixed asset, sir. So what is the entry, sir? When you purchase a fixed asset account debit to bank account. This is the entry. General entry we will write. How much? 50 lakhs. 50 lakhs. Now, what happened next? We received the grant. How much? 10 lakhs. Now this grant amount we directly reduce it from cost of the asset. So when we receive grant, what entry we will write? We receive amount, bank account debit to fixed asset account. See, fixed account is reduced by grant. How much? 10 lakhs, 10 lakhs. So fixed asset to bank, bank to fixed asset. Now next, at the end of the first year, we need to provide what? Depreciation. Provide depreciation on the asset. What is the entry we will write? Depreciation account debit to fixed asset account. Depreciation to fixed asset account. How much depreciation you provide? Tell me. See, originally what is the cost of the fixed asset? 50. How much grant amount is reduced? 10. What is the salvage value? 5. Salvage value should be reduced from the cost of the asset. Now this is called depreciable amount. Divided by how many years? 5 years. So therefore 35 divided by 5. So the depreciation is 7 lakhs, 7 lakhs. And at the end of the year, what we do? This depreciation we will transfer it to P&L account. So P&L account debit to depreciation account. 7 lakhs, 7 lakhs. Over. First year entries over. So first we purchase the fixed asset. Fixed asset to bank. 50-50. Now next we receive the grant. Now the grant is adjusted to the cost of the asset. That's why see, bank to directly deducted from fixed asset. So fixed asset account is created. See, that means 50 minus 10. That means 40. That means grant is deducted from the cost of the asset. And then at the end I provided depreciation. How? Cost of the asset minus grant minus this one, salvage value, divided by life. You got the depreciation. What about second year, sir? They are asking entries for first 2 years. Second year also very simple. Second year, what we need to do? Is it required to again write fixed asset? No, fixed asset already recognized, and grant is also deducted from fixed asset. So second year, what is the entry we'll write? Depreciation entry. That is the only entry. Depreciation to fixed asset. What is the entry for this? What is the amount? 7 lakhs, 7 lakhs we calculated, na? Same amount. And then this will be transferred to P&L account. So P&L account debtor to depreciation account. How much? 7 lakhs, 7 lakhs. Very simple, sir. Very, very simple. Very, very simple treatment. This is problem number 1. And you can add narration also. Being asset purchase. Simple narration. Being asset purchase. Being grant adjusted to the fixed asset. See, this is very important here. Being government grant. Government grant reduced. Government grant reduced from fixed asset cost. Cost of asset. We reduce it from cost of asset. Okay, sir? This is problem number 1, sir. Very, very simple treatment, sir. Now come to problem number 2, sir. We completed problem number 1. Come to problem number 2. Z Limited purchased fixed asset again 50 lakhs, estimated like 5 years, salvage value also 5 lakhs. On purchase of the asset, we received a grant of 10 lakhs. Pass necessary journal entries in the books for the first 2 years if the grant is treated as deferred income. See here again, first question, second question actually same. What is the difference? In first question, grant is adjusted from cost of asset. Second, grant, instead of adjusting from cost of asset, what we are doing, we are treating it as deferred government grant, deferred income. Then what to do? Treatment. See this question, same if you follow the second method. What is the treatment? Simple, I will tell you. Problem number 2. See here, first we purchase the fixed asset na. Any change in entry? No. Fixed asset account debtor to bank account. Fixed asset to bank. How much is the cost of the fixed asset? How much is the cost of the fixed asset? 50 lakhs. No change. 50 lakhs, 50 lakhs. Now we received the grant. Is that grant is adjusted to fixed asset? No. So bank account debtor, when we receive the grant, bank account debtor to deferred, see deferred government grant account. Like this one account we need to open. Deferred government grant. How much grant we received? 10 lakhs, 10 lakhs. Observe the difference between the first question and second question. In first question, the grant is directly adjusted from the cost of the asset. In second question, instead of adjusting from cost of asset, we are transferring to deferred government grant. 10. Now, so you received the grant. So, being government grant received. Government grant received. So, we received the grant and we recorded it. We have not adjusted from the cost of the asset. Okay. Now see, at the end of the year, we need to provide depreciation. And also one more thing we need to do. What we need to do is, this grant, whatever we recognize now, this has to be transferred to P&L account every year over the life of the asset in proportion to the depreciation, because it's a depreciable fixed asset na. So what is the depreciation? See, first we calculate depreciation. So we need to provide depreciation. So can you tell me what is the depreciation here? Depreciation account debtor to fixed asset account. Depreciation to fixed asset. See here, what will be the cost of depreciation? You tell me. Suppose 50 lakhs is the cost of asset minus 10 lakhs you do na. No. Grant we should not adjust from the asset cost. Only salvage value 5. So divided by 5 years. So 45 divided by 5. So 9 is the depreciation. In first treatment, 7 lakhs is the depreciation. That's the difference. Here the depreciation is 7. Here the depreciation is 9. So depreciation account debtor to fixed asset. So fixed asset account debtor to bank. Bank account debtor to deferred government grant. And this depreciation to fixed asset. Now see, important. See here. This deferred government grant, what we need to do is grant account debit, because it is already created. Now to see P&L account, or you can write deferred government grant account debtor to deferred income to P&L, whatever, right? That means see proportionate amount. How much? See, actually grant 10 divided by every year depreciation 9 equal. So therefore divide by 5 you can do. So that means 2 lakhs will be credited to P&L account. So here net effect you see. Here again this depreciation we will transfer to P&L account na. So P&L account debtor to depreciation account. P&L account debtor to depreciation account. How much? P&L to depreciation. P&L account debtor to depreciation. How much, sir? 9 lakhs. 9 lakhs. So you see, 9 lakhs depreciation debited to P&L, 2 lakhs government grant created. That means net how much? 7 lakhs. What happened to the 7 lakhs? This 7 lakhs is debited to P&L account. In method 2. In method 1, see, total depreciation debited to P&L account. Debit to P&L account 7 lakhs. Debit to P&L account 7 lakhs. Total happened. So the point to understand is here either you follow method 1 or method 2. Ultimate net effect is same. The only difference is the treatment. See, concentrate on problem number 2. So in problem number 2, you receive the grant, you transfer it to deferred government grant. Now this deferred government grant will be credited to P&L account. See, proportionately, out of this 10 should not be transferred to P&L account at a time. In proportion to the depreciation. Actually, the proportion is 9 lakhs depreciation. First year 9 lakhs, second year 9 lakhs, third year. That means equal, na? That's why 10 divided by 5. In proportion to the depreciation, this deferred government grant is also transferred to P&L account. Like 2. So that means every year from deferred government grant, we need to transfer 2 lakhs to P&L account, credited to P&L account. And remember the depreciation. Here depreciation is provided on cost of asset. 50 minus 5, 9 lakhs is the depreciation. There the grant is directly adjusted from the cost of asset. That's why depreciation is less. 7 only. Here 9. Because the grant amount we are treating separately. We are not adjusting to the cost of the asset. Hope you understood the difference between the first problem and second problem. Okay. Next. Santosh Limited, problem number 3, you see. Santosh Limited received a grant of 8 crores from government for setting up a factory in a backward area. We have seen just now. In CMA matter also the same question is there. When you receive any grant relating to setting up of a factory, what is the nature of the grant? Promoter's contribution. It is credited to capital reserve. Out of this grant, the company distributed 2 crores as dividend. No, yesterday I told you. Sir, when government has given some grant, it is not a divisible profit. We cannot use it for a distribution of dividend. This is wrong thing done by the company. Also, Santosh Limited received a land free of cost. Free of cost. So tell me, when you receive any non-monetary asset free of cost, we will record it some nominal value from the state government. But it is not recorded at all in the books as no money has been spent. In the light of AS12, examine whether the treatment of both the grant is correct. Both are not correct. One, they have distributed the government grant, which is not correct. As per AS12, government grant cannot be distributed as dividend. Second, when non-monetary asset received free of cost, even then you have to recognize it at nominal value. But they have not recognized this land in the books, so which is also correct. So both the grants is correct. So not correct. Not correct. Both are not correct. So you have to write both are not correct. You have to justify as per accounting. You just write one line. As per AS12, whenever government grant is not to be distributed to the shareholders as a dividend. In the given case, company distributed, so it is not correct. First thing. Second thing, whenever as per AS12, whenever any non-monetary asset is received freely, it has to be adjusted to the cost of asset. It has to be adjusted to the cost of the asset. Sorry. When non-monetary asset received freely, we have to recognize at some nominal value. But here we are recognizing it. We are not at all recognizing. So this is also wrong. So both the cases are not correct. Okay. Next. Next, see question number 5, sir. How would you treat the following in the accounts in accordance with AS12? Rupees 35 lakhs received from the local authority. Local authority means municipality for providing medical facilities to employees. What is the nature of the grant? Revenue grant. Because to meet the medical facilities, to providing medical facilities to employees, government is giving some amount to you, 35 lakhs. I told you, when government has given something to meet any specific expenses or to meet any specific programs expenses, definitely we have to treat it as revenue grant. What is the treatment of this 35 lakhs? Can you tell me? Simple. Either you treat this 35 lakhs as other income in P&L account, or alternatively, the medical expenses, whatever the welfare expenses to employees, from that you deduct this 35 lakhs. So here these are revenue grants. Second thing is 100 lakhs received as a subsidiary from central government for setting up of unit in notified backward area. Same point we know. For setting up of any unit in the backward area. So this subsidy is in the nature of promoter's contribution. What we need to do? We need to transfer it to capital reserve. So therefore, first bit answer, So other income means credited to P&L account. Credit to P&L account. Credited to P&L account. We have to credit to P&L account or reduce from concerned expenses. Reduce from concerned expenses. This is the first bit treatment. What is the second bit treatment, sir? Second bit treatment, grants in the nature of promoter's contribution transfer to capital reserve. Transfer to capital reserve. That's a simple treatment. Transfer to capital reserve. Next. Problem number 6. Z Limited purchased a fixed asset for 50 lakhs, sir. Estimated life 5 years with a salvage value of 5 lakhs. On purchase of the assets, government granted it a grant of 10 lakhs. This amount was reduced from the cost of the fixed asset. See, we received 10 lakhs grant. At the time of receipt of the grant, we reduced it from the cost of the asset. Now the grant was considered as refundable. Now we need to refund it. Maybe we failed to fulfill some conditions. When we need to refund? In the end of year 2. To the extent of how much? 7 lakhs we need to refund. Sir, tell me, when you receive the grant, you deduct it from the cost of the asset. When you refund, I told you, add to the asset, debit to the asset. Pass the journal entry for the refund of the grant as per the first method. So tell me, what is the entry you are going to pass for the refund of this grant? You need to refund it to the government. How much you need to refund? 7 lakhs. You need to refund how much, sir? 7 lakhs you need to refund to the government. So, see, we purchased an asset. Government has given some grant. Now we fail to fulfill the conditions. Government is now asking the refund. What is the entry we will write? So when we receive the grant, we adjusted from the cost of the asset. So when you refund, same adjusted to the cost of the asset. So therefore, at the time of refund, what we do? Fixed asset account debtor, machinery account debtor, fixed asset account debtor. Because you already reduced the grant from the fixed asset. Now you debit. So fixed asset account debtor, 7 lakhs. To bank account, 7 lakhs. That's it. So very simple entry na. What is the journal entry for the refund of the grant? Simple fixed asset account debit to bank account. How much you are refunding? 7 lakhs. So 7 lakhs added to fixed asset. Bank account will be created to 7 lakhs. Because when you refund, the amount is going out. Okay. So this is one very simple question, sir. We receive the grant, now we are refunding it. How much? 7 lakhs. So fixed asset account debtor to bank account. Now see question number 9 you see, sir. Very good question. Actually question number 9 covers all the refund cases. See question number 9. See problem number 9, sir. Important sum. Please carefully observe this. A Limited purchased a machinery for 40 lakhs. Okay. Useful life 4 years. Residual value 8 lakhs. So they purchased a machinery, sir, 40 lakhs. Useful life of the asset 4 years, sir. Residual value 8 lakhs. What is residual value? What is that? Salvage value, residual value means, see, once the life is over, at what value we can sell it? So how much amount it is going to get if you sell it? So that is called residual value or salvage value. We received a government grant 16 lakhs. So this is grant related to what? Depreciable fixed asset. Now show the journal entry to be passed at the time of refund of grant. In the third year, see when we are going to refund? Third year, and the value of the fixed assets. If grant is created to fixed asset, suppose grant is created to fixed asset means the grant is reduced from the fixed asset. When initially it is received, it is deducted from the fixed asset. Now you are going to give refund. What is the treatment you do? What is the entry for refund? Suppose second case, if the grant is created to deferred grant, instead of reducing from the cost of the asset, if it is treated as deferred government grant, now at the end of the third year, when you are refunding, what is the treatment you are going to give? So see, they are asking us the entries for what? At the time of refund of grant. When we are refunding? Third year. So at the end of the third year, when you give the refund, what entry you are going to pass? If the grant is created to fixed asset, one thing. If the grant is created to deferred grant. Now tell me how much grant we received? 16 lakhs. Okay. See, first when we receive the grant, what entry we might have passed it? Tell me. Problem number 9. Very simple. See, when grant received, what entry we might have passed in the books? When we receive the grant, what entry we might have passed? Simple. Grant is adjusted from the cost of the asset. So bank account debtor to fixed asset. Bank to fixed asset. Now the same entry is reversed at the time of refund. So when grant is received, you bank account debit because you are receiving the amount in the form of grant and you adjust it to the cost of the asset. Machinery. How much? 16 lakhs. 16 lakhs. This is the entry when you receive it. Now at the time of refund, so refund of grant. Tell me what entry will write? Just opposite I told. So same entry will be reversed. That is machinery account debit to bank account. Simple. Over. 16 lakhs. 16 lakhs. Of course, in exam, if you write directly this entry, more than sufficient. You are not required to write this entry. For your understanding, I told. See, this is when you received the same entry reversed at the time of refund of government grant. This is when, sir, initially, this is the answer for first bit. When grant is created to deferred, when grant is created to fixed asset, that means it is debited, it is reduced from the cost of the fixed asset. Suppose the grant is created to deferred grant, what will you do? Second bit. See, suppose instead of adjusting from the cost of asset, suppose if you treat the grant as deferred income, deferred grant, what is the treatment? See, when grant received, what entry you might have passed? Bank account debit to deferred grant or deferred government grant also you can call it. Deferred government grant or deferred grant. Deferred grant account. This is when you receive the grant of 16 lakhs, 16 lakhs. And what you do next, tell me? We know when grant is credited to deferred grant, this we will credit to P&L account in proportion to the depreciation, because it's a depreciable fixed asset. We are receiving grant related to depreciable fixed asset. So that means, see, we are giving refund at the end of third year. So this 16 lakhs, what is the life of the asset actually? 4 years. So therefore 16 divided by 4. That means 4 lakhs every year. We will credit to P&L account. So that means first year how much we credited to P&L? 4 lakhs. Second year 4 lakhs. So that means in the third year how much balance is there in this deferred grant? 8 lakhs. Now that we need to cancel. See, actually this is first year. And next 2 years what you write? This grant you credit to P&L account. Deferred grant to P&L. Deferred grant to P&L. See, like this you write. Deferred grant account debit to P&L account. How much? 16 lakhs divided by 4. Because depreciation is same. In that proportion we are transferring. How much? 4 lakhs. Second year also we done the same thing. This is first year. Second year also, from this deferred grant we will transfer 4 lakhs to P&L account. 4 lakhs. Now you are third year. In third year, what is happening? Tell me. You are giving the refund. Now see, when you refund the amount, you know that to bank, because funds are going from you. So one is fixed, 16 lakhs you need to refund. So bank account is created. Which accounts will be debited? See, when you refund the grant should be removed from the books. Already how much is there in the deferred government grant? Deferred grant account, how much balance is there? Actually total deferred government grant is how much? 16 lakhs. Out of 16, first year 4 lakhs, second year 4 lakhs is transferred to P&L. Therefore remaining 8 lakhs and unamortized balance is there. That you need to cancel. See, you are refunding 16 lakhs and deferred government grant is having 8 lakhs. So the difference adjusts to P&L account. P&L account. So this is the treatment for what? Refund of government grant. So the second bit answer is this. So in exams you write directly this. How, sir? See, simple. How much grant received? 16 lakhs. Divided by 4 years. That means every year 4 lakhs. First year 4 lakhs, second year 4 lakhs gone. How much balance is there? 8 lakhs. That you cancel it. So deferred grant 8 lakhs. Unamortized balance. See, always remember when you give refund, unamortized balance. The balance still there in the deferred grant has to be cancelled. Because you are giving away the grant, refund. So therefore that has to be closed. And the difference is adjusted to P&L. So this is the treatment for the second bit. So the first bit and the second bit I solved. Okay. So this is problem number 9. Hello my dear students. Now let us revise Accounting Standard 16 borrowing cost. See, basically what are the contents of this Accounting Standard 16, what we are going to cover in this standard. So first, the objective of the standard, we should learn why Accounting Standard 16 came, what is the main reason behind Accounting Standard 16. Then scope of the standard. So there are certain limitations to AS 16. What are those limitations? What is the areas of coverage we are going to discuss? The most important thing in AS 16 is the definition of borrowing cost, because the standard name itself is borrowing cost. So what to do with that borrowing cost? For that, first we should understand what is borrowing cost, what included in borrowing cost. So that definition we need to understand in the language of Accounting Standard 16. And what is the recognition principle of borrowing cost? So whether the borrowing cost is capitalized or charged to P&L account. So what is the recognition principle? Suppose if you want to capitalize the borrowing cost, when we need to capitalize the borrowing cost? And then 3 things. When to commencement of capitalization, suspension of capitalization, cessation of capitalization. That means 3 things. When to start capitalization of borrowing cost, when to suspend capitalization of borrowing cost, when to stop capitalization of borrowing cost. So 3S we need to learn. Next, amount of capitalization. How much amount we need to be capitalized. And there is a small concept called excess of carrying value of the asset over recoverable amount. Suppose because of capitalization of borrowing cost, if the carrying amount of the asset exceeds its recoverable value, then what to do with that? So, and then disclosures. See, basically, this is what we are going to cover in this Accounting Standard 16. See, first of all, why A16 came? See, simple. Generally, borrowing cost means interest. Whenever we made any borrowings, definitely there will be some cost on those borrowings. Now, that cost will be our expenses. We debit to P&L account. Suppose when you take a loan from a bank, you will pay interest, right? So, interest is our borrowing cost and we will debit to P&L account. Isn't it fair to say that always this interest will be charged to P&L account? I mean, is it debited to P&L account as an expense? what about a situation where this loan proceeds we utilized for one asset, and anyway when you spend the amount for a particular asset, you are capitalizing to that asset now, that amount. What about the interest? Because this interest, the amount you spend is borrowed amount, and the borrowed amount you are utilizing for asset. Now the amount what you are spending on the asset, you are capitalizing. What about the interest on this fund? So interest on the borrowings. So borrowed funds you are using for qualifying asset, you are using for an asset. Now, when the principal amount or the amount of expenditure you are capitalizing to the asset, what about the interest on that amount? Is it also be capitalized or charged to P&L account? So that is what the main criteria of this standard. In the normal course of the business enterprises will take a lot of borrowings. For example, business enterprises may issue debentures, may take deposits, or may issue may issue bonds, or may take bank loans in the form of term loans, working capital loans. For different purposes, different loans they will take, right? And these loans they will use for different purposes. Now whether the interest generated on these borrowings, whether that interest component will be capitalized or charged to P&L account. Now that question will come. So what is the appropriate treatment of the borrowing cost? See, here I'm telling interest. Interest is one of the predominant borrowing cost. I'm not saying interest is the only borrowing cost. There are certain other cost also comes under borrowing cost. We will see in the definition of borrowing cost. So this is the main criteria of this standard. So if somebody asks you what is the objective of this standard, see, the object of this standard is to provide the accounting treatment of borrowing cost. Here accounting treatment means whether borrowing cost will be capitalized. Is it capitalized or is it charged to P&L account? So whether borrowing cost is capitalized or charged to P&L account, that simple question will be answered by accounting standard 16. Whether borrowing cost will be included in the asset cost. Capitalized means it is included in the asset cost, or is it charged to P&L account? That means is it a capital expenditure or revenue expenditure, interest cost? In general, whenever we see interest now, we will treat it as a revenue expenditure, we debit to P&L account. But after learning this standard, you will understand sometimes it is absolutely necessary to capitalize the interest cost rather than treating it as a borrowing cost. And what is that situation when we are going to capitalize? So what is the objective of accounting standard 16, sir? The basic object of accounting standard 16 is to provide accounting of borrowing cost, whether the borrowing cost will be capitalized or charged to P&L account. This question is addressed by accounting standard 16. Now see, first of all I will tell you what is the definition of borrowing cost, because this is very important definition. Because the standard itself talks about borrowing cost, you should understand what is borrowing cost. See, the standard says borrowing cost is nothing but interest and any other cost which is incurred in connection with borrowing of the funds. If you see the original definition of the standard, they say borrowing cost is interest and any other cost which is incurred in connection with borrowing of the funds. For example, any other cost which is incurred in connection with borrowing of funds. For example, I applied for bank loan, application fees I paid. Now that is also cost incurred in connection with borrowing of funds. For example, I am going for a bank loan. I appointed one consultancy firm. So for that I paid some amount. That is also cost incurred in connection with borrowing of funds. Suppose for example, we paid any brokerage, we paid any commission, or we paid any processing fees. See, once you make the application, the bank will process your loan. So for that they will charge some processing fees. That processing fees is also what? Amount incurred in connection with borrowing of funds. So borrowing cost is not just interest, any other cost which is incurred in connection with borrowing of funds. But you cannot, you should not make an effort to put everything as this is in connection with borrowing of funds, so therefore I will capitalize it. See, this standard will give you the legitimate benefit of capitalization for the eligible expenditure, but don't try to make an effort that everything is borrowing cost, I will capitalize. No, that is not the case. Okay, because see, once you start capitalizing borrowing cost to the asset value will increase. So that means your total assets will increase. So therefore unnecessarily you are doing overvaluation. That's why this standard put a limit. See, when to start capitalization, when to stop capitalization, when to suspend capitalization, how much amount to be capitalized. So for that, first of all, that expenditure should fit into the definition of borrowing cost. So therefore, you cannot take all expenditures as borrowing cost. Of course, predominantly interest is the borrowing cost. Not only interest, any other cost you incurred in connection with the borrowing of the funds is also borrowing cost. See here, borrowing cost, interest and other cost. What is other cost? Cost incurred in connection with, see, in connection with the borrowing of the funds. In connection with the borrowing of the funds that you have to take. And so if you see accounting standard 16 here, they said borrowing cost is interest and any other cost incurred in connection with borrowing of funds. But again, in separate paragraph, they are saying borrowing cost may include. That means this is not the only definition. They have said interest and other cost. They said borrowing cost may include, like that they have told 5 points. Now these 5 points are also part of borrowing cost. Very, very important. You may get one question or you may get one MCQ. Okay, so first understand what is borrowing cost, what is the basic definition, interest and other cost. Other cost is what? Cost incurred in connection with borrowing of the funds. So whenever I have taken a borrowings, on those borrowings I will pay interest, that is borrowing cost. Plus in connection with the borrowings, in arrangement of borrowings, whatever the cost I incurred, that is also borrowing cost. But apart from that, in a separate paragraph, the standard says borrowing cost include the following. So they told 5 things. Now these 5 things are very, very important. Understand what is that. First, they are saying that interest and commitment charges. See, interest and commitment charges. Interest and commitment charges on bank borrowings and other short-term, long-term borrowings. Whatever borrowings, short-term borrowings or long-term borrowings are, so you taken on bank borrowings are, whatever the interest you are paying, we know interest is always a borrowing cost. And again, this is also confirming that interest is the borrowing cost on bank borrowings and any other short-term, long-term borrowings. Suppose for example, I have taken a term loan, long-term borrowings, maybe cash credit, short-term borrowings, any short-term borrowings, long-term borrowings, on that whatever the interest, that is borrowing cost. Second, most important thing is commitment charges. Sir, what is commitment charges? See, commitment charges or commitment fees is charged by the bank which is giving the loan from the borrower for the commitment it has given. See, for example, bank has given you a commitment that we will process this much amount of loan. For example, we process a loan of 100 crores. Now, suppose if you are not utilizing it properly, or if you are not utilizing as per the limits which is specified by the bank, then obviously you have to face certain commitment fees. So it is a fees charged by the bank for the commitment given to the borrower. So whenever you see any commitment charges in the question, treat it as part of borrowing cost. So commitment charges are fees which is charged by the bank. Okay, that is also part of borrowing cost. Next, any amortization of discounts or premium relating to borrowings. See, amortization or discounts relating to borrowings. For example, we issued debentures at a discount. Debentures issued at discount. Debentures is what? Borrowings now. Debentures is a kind of a loan, borrowings. Now suppose if you issue debentures at discount, so that discount is your loss. Now that we will amortize over the period of debentures, right? Now that is also borrowing cost in the language according to A16. So when debentures is borrowings, so on the debentures you pay interest, that is borrowing cost. Interest is a borrowing cost. Not only that, when you issue debentures at a discount, that amortization of discount over the life of the debentures, that discount portion is also borrowing cost, important. And sometimes we will redeem debentures at a premium. We redeem debentures at premium. For example, we take debentures 100 rupees face value, but we agreed to repay it at a premium. For example, so agreed to pay at 110. So face value 100, we agreed to pay at 110. That means 10 rupees extra we are paying now. That is called premium on redemption of debentures or premium on redemption of borrowings. That is also borrowing cost. So any discount on issue of debentures, Any premium payable on redemption of debentures or other borrowings, always a borrowing cost. So what is the second type of borrowing cost, sir? Any premium, any discount or premium relating to borrowings is also borrowing cost. Remember the example of debentures, you will easily get it. So debentures issued at discount. The discount, see, generally discount on debentures we will return off over a period of time. So that amortized portion, how much hour you debited to P&L account this year, that is this year borrowing cost. Similarly, when you pay premium on redemption, that premium portion is also your borrowing cost. And third one, any amortization of ancillary cost incurred in connection with arrangement of borrowings. See, ancillary cost, that means related cost in connection with arrangement of borrowing. See, arrangement of borrowing, in connection with arrangement of borrowings, arrangement. See, when you are arranging the borrowings, in that process, whatever the related cost you incurred na, that related cost is also amortized to the P&L account over a period of time. That cost is also borrowing cost. For example, any consultancy fees you paid, any brokerage you paid, any commission you paid, or any other expenditure you incurred for arrangement of borrowings, so all those costs should be included as a part of cost of borrowing cost. That is third one. And fourth one, finance charges in connection with finance charges in respect of assets acquired under finance lease. See, finance lease or similar arrangement as per accounting standard 19. See, whenever any asset is taken on lease, and if it is a finance lease as per AS 19, now according to that loan lease, you pay lease payments na. In that lease payment, whatever the interest component is there, that is also borrowing cost. So standard says whenever any asset is taken on finance lease, whenever you acquire any asset on finance lease basis, now according to that lease, whatever the lease rents you are making payment to the owner, now in that lease rents there is a two component, principal component, interest component. That interest component is called finance charges. That is also borrowing cost. That is also borrowing cost. What if, for example, if I acquired an asset on an operating lease? In case of operating lease, see, the whatever the lease rents you are paying, on that lease rent, whatever the interest component is there, see, that is not borrowing cost. Because the finance lease, operating lease, both are technically different. See, finance lease is nothing but what? Nothing but the risks and rewards of the leased assets is transferred to the tenant, lessee. So therefore, it is like acquisition of asset only. It is like normal acquisition of the asset. So I acquired the asset on credit basis and I am making the payment to you in the form of lease rents. So therefore, whatever the lease rents I am making, so lease rents payments I am making, in that whatever the interest component is there, that is nothing but I am taking the loan and making the repayment. So therefore, the standard says whatever the finance charges include in the lease rent, when you acquired any asset on finance lease is borrowing cost. So they may ask you one MCQ. For example, an asset is acquired under finance lease. You paid a lease rent of this much. So lease rent of 5 lakhs. In that 5 lakhs, for example, the interest component is 1 lakh. 4 lakhs is the principal component. What is borrowing cost? Borrowing cost is 1 lakh. 1 lakh is the borrowing cost. Okay. And the most important thing is the fifth one. What is the fifth one, sir? Any exchange difference arising from foreign currency borrowings to the extent they are regarded as adjustment to interest cost. To the extent they are regarded as adjustment to interest cost. To the extent they are regarded as adjustment to interest cost. Sir, what is this? Listen. Any exchange difference arising from which borrowings? Foreign currency borrowings. See, exchange difference arising from which borrowings, sir? FC, foreign currency borrowings. So when you take any loan from foreign country, on that loan, whatever the exchange difference arises, to the extent they are regarded as adjustment to interest cost, will be treated as borrowing cost. Sir, generally AS 11 talks about foreign currency transactions. Whenever we take any loan outside India, that is a foreign currency transaction. On that loan, whatever the exchange differences arises, generally we will treat it as per AS 11. But accounting standard 16 says, see, the exchange difference which is arising when you take any loan from outside India, out of that certain portion, you need to treat it as borrowing cost. Sir, how much portion? To the extent it is regarded as adjustment to interest cost. To the extent it is regarded as adjustment to interest cost. Actually, this is very wonderful concept, sir. I will tell you. See, for example, you have taken a foreign currency loan. With example, I will tell, foreign currency loan you have taken. Now, on that loan, during the year, there is an exchange difference arises. You know, AS11 exchange difference arises. When you take a loan, $1 is equal to, for example, 100 rupees. Now, by the end of the year, $1 is equal to 110 or maybe 90. So, there is an exchange difference. So, for example, on this foreign currency loan, there is an exchange difference scale. Now, suppose the exchange difference in Indian rupees is 10 lakh rupees. Now, generally, what you do, tell me, this 10 lakh rupees, as per accounting standard 11, this 10 lakhs will be transferred to P&L account. This 10 lakhs will be transferred to P&L account. But now A16 is coming into the picture and says, hold on for a second. When you take any loan from outside India, yes, sir. And if this loan is utilized for any asset, yes, sir. Then the exchange difference arising on this loan may not be totally transferred to P&L account. Maybe certain portion we will transfer it, we will capitalize to the asset. So that means this exchange difference, to the extent they are regarded as adjustment interest cost, we will capitalize rather than charging to P&L account. Suppose what is this, sir? See, suppose I have taken loan from USA. So the interest is, for example, 20 lakhs. Indian rupees, interest is 20 lakhs. I have taken a loan from USA, US bank. 20 lakhs is the interest. Suppose if the same loan if I taken in India, my interest could be, for example, 27 lakhs. Possible? Sir, why I am going to foreign loan, sir? Because of less rate of interest. Suppose in India, the rate of interest is low, why I will go for foreign borrowings? Logical. So, the point is, why I will go to the foreign borrowings? Only when the rate of interest is less. So, I went to loan in US bank. I have taken a loan from US bank and the interest per annum is 20 lakhs. Now, the same loan if I take in India, with the interest rate prevailing in India, it could be 27 lakhs. More interest I need to pay. That's why I went to foreign loan. Now, standard says, you are an Indian enterprise, right? Now, you have taken a loan from outside India. The interest is 20 lakhs. Okay. The same loan if you taken in India, your interest could be 27 lakhs. Therefore, what we do is, the difference between the interest cost, 7 lakhs. Out of 10 lakhs, 7 lakhs, we will treat it as borrowing cost. Why, sir? See, you are an Indian enterprise. We will not deny the benefit of capitalization to you. Since because you have approached the foreign bank, you have taken loan from outside India, because of that reason, we can't deny the benefit of capitalization. Suppose, for example, you have taken a loan from outside India and you utilize it for qualifying asset. And how much interest will be capitalized? 27 lakhs. So, suppose you have taken the loan from outside India and you paid interest of 20 lakhs and we will allow you to capitalization only 20 lakhs. That is not fair. So that's why, see, in order to encourage the Indian enterprise, in order to give the true benefit of capitalization, see, this standard is all about giving the benefit of capitalization. We allow you to capitalize interest cost to the asset. How much? 27 lakhs, because you are an Indian enterprise. If the same borrowings is taken in India, you might end up in paying 27 lakhs. Because you have taken loan from outside India, you paid only 20 lakhs. Therefore, that difference of 7 lakhs in the exchange difference, whatever the exchange difference arises, in that, to the extent the difference between interest cost, to the extent they are regarded as adjustment to interest cost, we will treat it as borrowing cost. Therefore, we will allow you to capitalize. Therefore, out of this 10 lakhs, 7 lakhs is borrowing cost. That's why they said this is also part of borrowing cost. Borrowing cost includes any exchange difference arising from foreign currency borrowings to the extent they are regarded as adjustment to interest cost. So this is a very, very interesting point. Hope you understood. So once again, I'm telling, suppose you have taken a loan from outside India. What is the interest you are paying? The same loan if you taken in India, what is the interest you are going to pay? So the difference from the exchange difference will be treated as borrowing cost. Because you are an Indian enterprise, we will allow you the benefit of capitalization as if you have taken loan in India. Suppose if you take loan in India, you will be end up in paying 27 lakhs. So your borrowing cost will be 27 lakhs. Suppose because you have taken a loan from outside India, your interest is only 20 lakhs. Therefore, that 7 lakhs also we will allow, but from exchange difference. From exchange difference. What about remaining 3 lakhs? Remaining 3 lakhs will be charged to P&L account as per accounting standard 11. So therefore, this is the point. So these are the borrowing cost. So tell me, what is borrowing cost? Interest and other cost incurred in connection with arrangement of borrowings. Borrowing cost includes 5 things. What is? Interest and commitment charges on bank borrowings, short-term, long-term borrowings. Second, amortization or discounts relating to borrowings. So third one, amortization of ancillary cost in connection incurred in connection with the arrangement of borrowings. Next, finance charges whenever an asset is acquired under finance lease basis. And last one, any exchange difference arising from foreign currency borrowings to the extent they are regarded as adjustment to interest cost. To the extent they are regarded as adjustment to interest cost. Now we understood what is borrowing cost. Now this borrowing cost, whether it will be capitalized or charged to P&L account. Whenever you take in a loan, on that loan we paid interest. Whether that interest will be capitalized or charged to P&L account. That is what the standard object is. Now scope of the standard. Sir, this standard deals only with borrowing cost, sir. Only with borrowing cost. Sir, what about the cost we are incurred on capital? For example, we issued equity shares, we issued preference shares. Now we got the capital. On that capital, we pay dividend. So some bonus shares we will issue at a free, right shares we will issue at a concessional rate. All these are costs we are incurring in respect of capital. Whether that is also covered under the standard? No. This standard does not deal with actual or imputed cost on owner's equity, including preference share capital. So owner's equity, see, owner's equity means share capital, including preference share capital. Of course, preference share capital may look like debentures, look like borrowings only, loans only. But according to Schedule 3, it will be classified under share capital. So therefore, we should not take preference share capital as a part of borrowings, even though it is satisfying the definition of liability. Okay, so MCQ possible, scope, it does not deal with what? Actual or imputed cost. What is imputed cost? Notional cost, opportunity cost. So any actual cost or imputed cost on owner's equity, including preference share capital, this standard does not deal with. See, this standard does not deal with. Does not deal with. That means it is not covered the cost on equity. So cost on equity is not covered by A16. So that means A16 basically covers what? Only the cost on borrowings. So owner's equity, like equity share capital, for example, dividend we pay, bonus issue, right shares also we issue at a concessional price now. So that is also cost we are incurring in respect of shares. But is it covered in accounting standard 16? Answer is no. Now, so next, recognition principle, very, very important. So, okay, we understood that whether borrowing cost will be capitalized or charged to P&L account. Now, standard says there is a one principle. If the borrowing cost is directly related to, see, the word is directly related to, see here, directly related to. If the borrowing cost is directly related to what? Acquisition, construction, production. Three things. Acquisition, construction, production of what? A qualifying asset. So they brought the concept of qualifying asset is capitalized along with the asset. That's it. Simple principle. If the borrowing cost directly related to acquisition, construction, production of which asset? Qualifying asset, capitalized. Otherwise, charge to P&L account. If the asset is not a qualifying asset, charge to P&L account. Charge to P&L account. If the asset is not a qualifying asset, not a qualifying asset. So remember, what is the principle of A16? Borrowing cost directly related to. Borrowing cost directly related to what? Acquisition, construction, production of qualifying asset. So therefore, first of all, this borrowing cost, we understood what is borrowing cost. Next, it is directly related to. See, when we say it is directly related to, for example, you taken a loan. Now that loan you applied for this qualifying asset, we say directly related. Directly related to either you acquire the asset or you construct the asset or you produce the asset. That means even inventory is also covered. Inventory. Production, inventory will be produced now. Therefore, interest cost, borrowing cost directly related to the production of qualifying asset. If inventory is a qualifying asset, then interest cost will be capitalized to the inventory cost. That's why you see accounting standard 2 says interest will be capitalized to the inventory only if the inventory is a qualifying asset. So there is a link between 2 and 16. So if the borrowing cost directly related to acquisition, construction, production of qualifying asset, it will be capitalized. Otherwise, it is charged to P&L account. Okay, sir, then what is qualifying asset? Because they are saying that if the borrowing cost is directly related to acquisition, construction, production of qualifying asset, we will capitalize. So that means you have taken the borrowings and those borrowings you utilize it for acquisition, construction, production of qualifying asset. For example, you've taken a bank loan. Now this bank loan you spend for the construction of a building, office building or factory building. Right? Now, if this borrowing cost, bank loan directly utilized for qualifying asset. So borrowing cost is also directly related because borrowing cost incurred on borrowings, right? If the borrowings are directly spent on the qualifying asset, the borrowing cost is directly related. So borrowing cost directly related to acquisition, construction, production of qualifying asset is capitalized. Now the question is, sir, what is qualifying asset? What is qualifying asset? Because the main theme is what? If it is related to qualifying asset, we will allow capitalization. Otherwise, charge it to P&L account. Now, listen. What is qualifying asset? Standard says qualifying asset means an asset which necessarily takes substantial period of time to get ready for its intended use or sale. Look at the wordings of the standard. How beautifully they drafted. They said qualifying asset is an asset. See, qualifying asset, an asset that necessarily, see, the word is necessarily takes substantial period of time. It is not that you intentionally prolonged it. It necessarily takes substantial period of time. For what? To get ready. For what? For its use or sale. That's why I said inventory. Inventory is produced for sale. So therefore, anything you acquired, constructed, produced for sale or use, if it takes substantial period of time, necessarily takes substantial period of time, it's a qualifying asset. So standard says, look at the interlinking. Borrowing cost directly related to acquisition, construction, production of qualifying asset, capitalized. What is qualifying asset? An asset necessarily takes substantial period of time to get ready for its intended use or sale. Necessarily takes substantial period of time. Now the question is, sir, what is substantial period of time? Substantial period of time they have not defined in the standard. What is substantial period of time? They said depends on facts and circumstances of each case. See, primarily depends on the facts and circumstances of each case. Generally, they say it is 12 months. Generally, it is 12 months. Suppose any asset has taken 12 months time to get ready for use or sale. That is qualifying asset. But this 12 months is not the benchmark. This is not a conclusive yardstick to say that if this item taken 12 months, that means it's a qualifying asset. No, even less than 12 months can also be substantial period of time. That's why they said it depends on facts and circumstances of each case. It can be shorter than 12 months also if justificable. I will tell you one example. For example, company is constructing a factory. Tell me, is qualifying asset? Definitely, because it will take substantial period of time. What is substantial period of time? That depends on facts and circumstances of each case. Definitely, in order to construct a factory, more than 12 months it will take. Definitely. Suppose by using latest technology, latest machinery, more labor, we could able to complete this by 10 months. Possible? More labor, more technology. We complete it by 10 months. Now, can you tell me, is it a qualifying asset or not? Still, it is a qualifying asset because 12 months is not a conclusive yardstick. Simply because you utilized the latest technology, utilized more labor, we will not deny the benefit. Here we will see in general, is this asset take substantial period of time or not? Not particularly for you. So in general, is this a qualifying asset or not? Is it take substantial period of time to get ready for intended use or sale? Sir, we used latest technology, sir. That's why we able to complete it 10 months. Okay, that's fine. We will not deny the capitalization. We will continue. You can continue the capitalization. Still, it is a qualifying asset. Understand the intention of accounting standard 16. They don't want to classify qualifying asset based on the time period. That's why they have not defined substantial period of time is this. Generally, they are saying 12 months. But even less than 12 months also, see, just because it has not taken 12 months, you should not reach to conclusion that it is not a qualifying asset. You have to see, in general, is it takes a substantial period of time to get ready for intended use or sale. Even less than 12 months can also be substantial period of time. That's why you have to see the circumstances and facts of each case. So look at the interlinking. Borrowing cost directly related to qualifying asset, capitalized. Qualifying asset means an asset which takes substantial period of time to get ready for intended use or sale. And what is qualifying asset? An asset which necessarily takes substantial period of time to get ready for intended use or sale. What is substantial period of time? Depends on facts and circumstances of each case. We will not say this period is the substantial period of time. They have not said that. They said whatever substantial period of time is primarily depends on facts and circumstances of each case. Generally, it is 12 months. It can be shorter than 12 months also if it is justificable. So, generally, for example, see, construction of a building, which asset, qualifying asset, it will take substantial period of time, generally more than 12 months. Manufacturing of plants, power generation utilities, dams, bridges, roads, ships construction, wines. See, in order to manufacture a wine, produce a wine will take substantial period of time to get ready for sale. Because the wine manufacturing industries, the wine has to be preserved under prescribed circumstances for substantial period of time. Seeds, for example, you are a hybrid seed manufacturer, genetically modified seeds. You keep the seed in a prescribed conditional environment for certain period of time. It can be more than 12 months also. So therefore, you should understand. Nana, you should understand. So many students I observed that they are unable to understand what is qualifying asset. They are linking always the qualifying asset with the time. No, that is not the intention of the standard. So in order to becoming a qualifying asset, time is not the benchmark. Whether in general it will take substantial period of time or not. Sir, what is substantial? I told you, facts and circumstances. In general, 12. Even less than 12 months, if it is justificable, we will treat it as substantial period of time and it is a qualifying asset and we will allow capitalization. See, look at the linking. If it is a qualifying asset, then only we allow capitalization. So in order to become qualifying asset, it necessarily takes substantial period of time. For example, there is one asset, it will take only 6 months time. But in order to take the benefit of capitalization, I prolonged it for 12 months. That means necessarily it will not take 12. But I made it 12. Then capitalization benefit is denied. So it necessarily takes substantial period of time. Unnecessarily you could drag it for the benefit of capitalization. You should not do it. I think you understood the principle of capitalization. So tell me, what is the principle of capitalization? Borrowing cost, what is the recognition principle as per accounting standard 16? If the borrowing cost directly related to acquisition, construction, production, what we do? If it is a qualifying asset, capitalized. Otherwise, charged to P&L account. What is qualifying asset? An asset which takes substantial period of time, necessarily takes substantial period of time to get ready for intended use or sale. That means even if in inventory takes substantial period of time to get ready for intended use or sale. For example, I am a manufacturer of buses, or I am a manufacturer of rockets, or I am a manufacturer of airplanes. So for example, aircraft manufacturing. It will take substantial period of time to get ready for sale. Therefore, it is qualifying asset for me. Therefore, if I got the borrowed funds and utilized it for manufacturing of inventory, and inventory is a qualifying asset, then interest cost will be capitalized because it's a qualifying asset. Okay. Okay. So we understood the principle. Okay. When we need to capitalize. Okay. So we understood what is borrowing cost and what is the principle. This borrowing cost directly related to qualifying asset, capitalize. Otherwise, charged to P&L account. What is qualifying asset? We understood. It takes substantial period of time to get ready for intended use or sale. Now, sir, okay. Capitalization of borrowing cost will be done to the qualifying asset. So from which date onwards we need to capitalize, sir? See, standard says for commencement of capitalization, there are 3 conditions. So A, B, C, cumulative, all these 3 conditions must be satisfied. Then you can start capitalization of borrowing cost. What are the 3 conditions? First, expenditure on qualifying asset being incurred. See, expenditure on qualifying asset being incurred. Some expenditure you incurred on qualifying asset. For example, you are constructing a building. Now, on the construction of the building, some expenditure you need to incur. For example, you purchase the sand, bricks, iron, or you are making site development for construction of the project. Anything, if expenditure on qualifying asset being incurred, first condition. Second condition, borrowing cost being incurred. That means you've taken the borrowings, on that borrowing some cost is incurred. For example, you went to a loan, you paid application fees, processing fees, now loan generated, the loan sanctioned, on that loan interest you paid, EMI you are paying, so borrowing cost being incurred. Now the most important condition is the third condition is activities are in progress. Activities are in progress. So what activities are in progress? Activities which are necessary to make the asset ready for its intended use or sale are in progress. So for example, you are constructing a building. The first condition is some expenditure must be incurred on qualifying asset. Second condition is you incurred some borrowing cost. Third condition is activities relating to the construction of the building are in progress. Which activities? The activities which are necessary to make the asset ready for its intended use or sale. Necessary activities must be in progress. See, necessary activities to make the asset ready for intended use or sale. Suppose for example, if any activity you are doing which is no way connected with qualifying asset. For example, you are constructing a building, okay? Now you stopped the construction, you are not doing anything. So because you went to a foreign trip. Now is foreign trip is necessary to make the asset ready for intended use or sale? No. Therefore, the activities are not in progress. Therefore, we will not allow you to commence capitalization. So from which date onwards we will allow commencement of capitalization? We will see three things. First, you incurred expenditure on qualifying asset, yes sir. You incurred borrowing cost, yes sir. Third, is activities in progress? Which activities? The activities which are necessary to make the asset ready for intended use or sale are in progress. Now the standard says here activities in progress include the following. Either physical construction of the asset is going on, physical construction must be going on, or technical and administrative work prior to the commencement of physical construction must be going on. Either physical construction must be going on or some technical and administrative work. For example, technical and administrative work. Suppose you want to construct one factory building, you applied for local municipal authority for permission. No, that is also technical and administrative work is going on. No problem. So obtaining a permission for construction from local authority, designing, for example, you approach an engineer for give the design of the factory. So that is also substantial technical and administrative work is going on. So tell me, when to commence capitalization of borrowing cost? Capitalization of borrowing cost will be commenced when three conditions are satisfied. First one is borrowing cost being expenditure incurred on qualifying asset. Second one, borrowing cost being incurred. Third, activities are in progress. Which activities? Activities which are necessary to make the asset ready for intended use or sale are in progress. Now, activities in progress includes what? Either physical construction of the asset must be going on or some technical and administrative work prior to the commencement of the physical construction is going on. Okay. Now, suspension of capitalization. So, you started capitalization of borrowing cost. Is there any situation you will suspend capitalization of borrowing cost? Yes. The standard says whenever there is an interruption in active development of the qualifying asset or there is no active development, you stop capitalization of borrowing cost. See here. When there is no active development or active development is interrupted, you stop capitalization of borrowing cost. But there are some exceptions. Two exceptions are there. First exception, when there is a temporary delay which is necessary to make the asset ready for intended use or sale, then you are not required to suspend capitalization. You can continue capitalization of borrowing cost. What is the first situation? When temporary delay is necessary to make the asset ready for intended use or sale. For example, a genetically modified seed, hybrid seeds. For example, you are manufacturing hybrid seeds. Now, you thought it will take 1 year time to, to get the desired result. Maybe it will take 15 months. That means more than 12 months it has taken. That means there is a temporary delay, but which is necessary to make the asset ready for intended use or sale. Or for example, you are constructing a bridge on the river. Now there are high water levels. So because of that, you stopped construction. Now there was a temporary delay which is necessary to make the asset ready for intended use or sale. So when the high water levels are going on, how you are able to continue the construction? Even if you continue the construction may got damaged or so anything can happen. So that's why there is a temporary delay and that delay is necessary. Then we won't stop you to suspend the calculation. You can continue the calculation of borrowing cost. Second, when substantial technical and administrative work is being going on, carried on. For example, you are constructing a qualifying asset. Now, because of some technical reasons or because of some administrative reasons, if the work is suspended or work is stopped, then also no need to suspend capitalization. You can continue capitalization. For example, labor went for strike. For example, 20 days labor went for strike and the construction stopped. Qualifying asset construction stopped. Will you allow capitalization or will you suspend? Will suspend because labor strike is not necessary. It is not a substantial technical and administrative work or it is not a temporary delay which is necessary to make the asset ready for intended use or sale. So suspension of capitalization. When will you suspend? When there is no active development. when there are two exceptions. When there is a temporary delay which is necessary to make the asset ready for intended use or sale. Second thing is when substantial technical and administrative work is being going on. Now the next, so you started capitalization, you suspend for some period if there is an active development, interrupted. And third one is when will you stop capitalization of borrowing cost? So what is the point you will stop capitalization of borrowing cost? For example, you started constructing an asset. So for which period you will stop the capitalization? What is the end point? Because if you keep on capitalizing, asset will not be there, but it will be there in the books as an asset. Because every asset has physical life 10 years. But if you allow you to capitalize forever, so it will not correct. Therefore, the standard says when substantially all necessary activities to make the asset, see, substantially all necessary activities to make the asset ready for intended use or sale are completed. That is the point you need to seize the capitalization of borrowing cost. When that asset substantially all necessary activities to make the asset ready for its intended use or sale are completed. For example, you constructed a building. Now the building substantially completed. All necessary activities to call it as building, intended use or sale are completed. Sir, for example, painting not done, sir. No problem. Even without painting also, it will not change the character. Intended use or sale are completed. You stop the capitalization. So some decoration not yet completed, sir. No problem. So decoration, painting, all these things are not substantially necessary. Substantially necessary activities to make the asset ready for intended use or sale completed, you stop capitalization. So even though some routine administrative work might be still exist and it can be treated as substantially complete, like decoration, painting, etc. or pending. No need to, see, some decoration pending, some painting pending, still it is substantially completed, you stop capitalization of borrowing cost. Now the most important thing is, sometimes you are able to construct an asset in parts. Then in such situation, what we need to do, sir? See, when a qualifying asset is capable of being completed in parts, and each completed part can be used separately, then you can cease capitalization of borrowing cost part wise also. For example, you are constructing a 5-floor building. Okay. Now this 5 floors building you constructing by using loan funds. So this is qualifying asset. Now suppose first floor completed. Can I cease capitalization of borrowing cost for this first floor? Yes, answer is yes. Because you are capable of being completed in parts. Yes, part wise I can complete. And each completed part can be used separately. Yes, first floor completed, I can use it for business first floor. Now in such a situation, standard says when a qualifying asset is capable of being completed in parts and each completed part can be used separately, then you can cease capitalization of borrowing cost relating to that part when substantially all necessary activities relating to that part is completed. For example, all substantially necessary activities relating to part 1 is completed, then borrowing cost proportionate relating to part 1, floor 1, you can cease, while construction for remaining parts are going on. So that is what they're saying. See, when a qualifying asset is capable of being completed in parts and each completed part can be used separately, then borrowing cost in relation to that part will be seized for capitalization, provided substantially all necessary activities to make the part ready for intended use sale are completed while construction for other parts are going on. For example, construction of a 5-floor building. Now sometimes what happens, you are able to construct the asset part wise, but completed part cannot be used separately. Then in such a situation, standard says you should not cease capitalization of borrowing cost part wise. Only when the entire asset is completed, you should cease the capitalization of borrowing cost. For example, steel plant, cement plant are the best example. For example, I am constructing a steel plant. One planted machinery I am constructing. Okay. So suppose for example, this is one asset. Now first part is completed. Whether the part which is completed can be used separately? Answer is no. Therefore, you should not cease capitalization of borrowing cost. Sir, when part wise capitalization of borrowing cost will be seized? Only when you are able to complete the asset part wise and each completed part can be used separately. When you are unable to use part wise, then you should not cease capitalization part wise. Only when the entire asset is completed, you should cease the capitalization of borrowing cost. So, commencement, suspension, cessation. When substantially all necessary activities to make the asset ready for intended use or sale are completed, you cease the capitalization of borrowing cost. Now the main thing is, what is the amount of capitalization? Sir, how much amount I need to capitalize, sir? You said when to start capitalization, when to stop capitalization, but how much amount? See, for a particular qualifying asset, either you take specific borrowings are specific. That means these borrowings will be used only for this qualifying asset. Or sometimes you take general borrowings. Out of general borrowings, some amount you may spend for this particular qualifying asset. For example, you have to divide the borrowings into two types: specific borrowings, general borrowings. What is specific borrowings? The funds are specifically borrowed for obtaining a qualifying asset. What is general borrowings? The funds are borrowed generally and used for obtaining a qualifying asset. See, if the funds are specifically borrowed for the qualifying asset, simple. Whatever the borrowing cost incurred on the specific borrowings minus any temporary income from investment of these borrowed funds. So the difference will be calculated. For example, we have taken a 50 crores loan from the bank, 100 crores loan from the bank. Now on that 100 crores, for example, 10 crores interest generated. Now that 10 crores, so minus, suppose for example, you invested this amount somewhere outside. So for example, see, you taken a loan of 100 crores, but it is not that you have to utilize this entire 100 crores at a time in the construction. So whatever the funds available right now, so we will invest somewhere. And whenever we require, we will take back and we will use it for qualifying asset. So whatever the borrowing cost we incurred, that minus temporary income from investments will reduce, and whatever the balance is there, that will be capitalized. In case of specific borrowings, so in case of specific borrowings, the funds are borrowed for a particular qualifying asset. So whatever the borrowing cost incurred on the specific borrowings, that interest minus any income from temporary investment of the borrowed funds will reduce, and balance we will capitalize. Sir, what about general borrowings? See, in case of general borrowings, we will find out one capitalization rate. What is capitalization rate? Nothing but average rate of interest. For example, you may take debentures, you may take bonds, or you may take bank loan, or you may take public deposits. See, from different sources you collect the amount and you utilize it for qualifying asset. In such a situation, for each borrowing, so separate interest rate will be there. So do one thing, you find out one common average rate of interest. We call it as weighted average rate of interest. We call it as capitalization rate. How to get capitalization rate? Simple. Whatever the average borrowing cost incurred during the year divided by aggregate outstanding borrowings. So what is the aggregate outstanding borrowings of general borrowings? And what is the average borrowing cost incurred? So take that. So that capitalization rate you apply. So amount of borrowings into aggregate of outstanding borrowings. What is the amount of borrowings into number of months of outstanding divided by 12 you will get the interest. So how to find out the amount of capitalization, sir? Specific borrowings, general borrowing. If it is a specific borrowings, total interest cost minus any income from temporary investment. If it is a general borrowings, find out one capitalization rate. How to find out capitalization rate? What is the borrowing cost for all the borrowings divided by what is the average aggregate outstanding borrowings into 100? You will get one rate. That rate you apply. And because see, general borrowings are not for a particular purpose. So they are borrowed for multiple purposes and you utilize it for qualifying asset. But specific borrowings, it is not like that. You borrowed these funds only for this particular qualifying asset. So on these specific borrowings, whatever the interest generated entirely will be capitalized after reducing any temporary income from investment of those borrowed funds. So that's why in case of specific borrowings, so we are not bothered. We will try obtain the what is the total interest minus income from temporary investment, that will be capitalized for whatever the asset we have utilized these specific borrowings. In case of general borrowings, we will find out one common rate, capitalization rate, because multiple sources we utilize it for one particular qualifying asset, and those are all general borrowing. Now find out one capitalization rate. What is the average, what is the borrowing cost incurred during the year divided by total borrowings? Then you will get rate. That rate you apply on the amount you spend for the qualifying asset of general borrowing. And the last topic is, see, because of capitalization of the borrowing cost, if the carrying amount of the asset exceeds its recoverable value, for example, see, cost of the qualifying asset 50 and you capitalize borrowing cost 10 lakhs because of this standard, because borrowing cost directly related to qualifying asset will be capitalized. So you capitalize 10 lakhs. Now it will become 60 lakhs. But in the market, the value is only 55 lakhs. So your NRV is 55. Because of capitalization of borrowing cost, your carrying amount exceeds the recoverable value. Then the standard says you should reduce the value. You should not show asset value beyond carrying recoverable value. Because in the market, if the asset value is 55 lakhs, how can I show 60 lakhs, sir? Therefore, I need to reduce this 5 lakhs, written off by 5 lakhs. So this is the concept. Excess of the carrying amount of the qualifying asset over recoverable amount. Recoverable amount means NRV. So after capitalization of borrowing cost, if the qualifying asset value exceeds the recoverable value, then that excess should be written off. Okay, so that is what they are saying. If the carrying amount of the qualifying asset exceeds the recoverable amount after calculation of borrowing cost, then the carrying amount is written off as per the accounting standard. Okay, this is the example. So I think this is the accounting standard 16, sir. Entire standard I have revised. So please listen it carefully. Thank you. Illustration 11. T&L Limited is a large construction company. See, before solving the questions, first you complete the theory. So I already uploaded AS16 theory. Now these questions will become easy for you. So TL is a large construction company. Generally, construction company means they are doing long-term projects. So they will take substantial period of time to get ready. So that means they are all doing qualifying assets. So the borrowing cost directly related to acquisition, construction, production of qualifying asset is capitalized. We know that. Which is presently involved in the construction of railway bridge. Sir, they are constructing one railway bridge, sir, over the Ganga river at Patna. So in Patna, so over the Ganga river, they are constructing one railway bridge. You tell me, construction of railway bridge by nature, is it take substantial period of time or not? Definitely it takes substantial period of time to get ready for intended use or sale, intended use. So therefore definitely this is what construction of railway bridges is a qualifying asset. See, first you decide whether it is qualifying asset or not. Then the borrowing cost you find out and capitalize it. The project cost is 125 crores. Okay. 40% of which is financed by, see, borrowing from Asian Development Bank at an interest of 3%. So that means, see, what is the cost of the project, sir? 125 CR. Out of 125 CR, 40% is borrowings. So borrowings, how much, sir? 125 into 40%. That means 50 CR borrowings. From where? Asian Development Bank. Asian Development Bank. What is the rate of interest? 3% loan we have taken. Remaining we arranged through other ways, other sources. We are not bothered, because here we are bothered only about borrowings. There has been a delay in completion of the project. So they are saying that there is a delay, sir. There is a delay in completion of this project. And the project, see what happened, and the project manager of the railway bridge construction site has identified that delay construction of the railway bridge has happened due to high water levels during monsoon months of July to September. Sir, they are constructing a bridge. See, suppose there is a river here. Okay. Now they are constructing one bridge over the river, railway bridge. Now what the manager observed is, this monsoon season, July to September, in 3 months, because of the monsoon, these are the monsoon months, there is a high water levels. Sir, you are constructing a bridge, but water levels are increasing. So when water levels are increasing, so you cannot, it is very difficult to construct. So Miss Sonal Mathur, the accountant of TL&, has not suspended the capitalization of borrowing cost. See, this 3 months, like July to September. So what happened? Because of the heavy rains, monsoon season, the water levels increased. Now that means 3 months there is no active development. But our accountant, Sonali, so what she done is, she continued the capitalization. She does not suspend the capitalization of borrowing cost and reflected the same in the cost of the qualifying asset. This 3 months interest also she included in the cost of the bridge qualifying asset. You are required to comment on the treatment. Tell me, first of all, this question is relating to suspension of capitalization. Suspension of capitalization. Tell me what we discussed about suspension of capitalization. When borrowing cost will be suspended, capitalization of borrowing cost will be suspended. See, I told you capitalization of borrowing cost is suspended when there is an interruption of active development. When there is no active development, you should not capitalize. But however, there are exceptions. If the delay is because of reasons not in our control, and see, it is not because of our negligence, and that delay is necessary for completing the further process. The delay is necessary. Then I told you that you should not stop capitalization. You should continue the capitalization. Only because of our, yesterday we discussed, see in last class, for example, workers went to strike. So maybe that is not necessary. The temporary delay is not necessary for further processing. So maybe, see, for that period we can suspend the capitalization. But here, during monsoon season, there is high water levels. Definitely you should stop the construction work. So it is necessary for further processing. So therefore, for this period you should not suspend the capitalization. You can continue the capitalization of borrowing cost. So the answer should be like this. So you have to write, according to A16, borrowing cost capitalization will be suspended when there is a interruption of active development. However, if there is a temporary delay which is necessary and which is not due to the negligence of the organization, and which is the natural, because of the natural reason there is a delay in construction which is not in the hands of the company, and therefore company can continue the capitalization, no need to suspend, and the accounting treatment done by the accountant is very correct. Like that you have to write. See, always make sure that your answer should have the proper, first of all, proper principle. So what is the topic, you write first, and then give a brief explanation about what happened in the question. Brief explain, this is what happened, this is what happened, this should be done, this happened, like that, and give proper conclusion that this is actually the accounting treatment of the accountant is correct, not correct, like that. So you see the answer. In this case, the work got suspended due to temporary delay, which is necessary part of the construction process. Necessary. The delay is necessary. You are not making the delay unnecessarily. The delay came and it is necessary. Necessary doesn't mean that I want to take it. See, July to September monsoon season, high water levels came. Necessary delay we have to give. No, you have to come and you construct now. So nobody will come because they don't want to risk their lives. So the capitalization of borrowing cost would continue during the extended period during which the high water levels delay the construction of the railway bridge. As such, high water levels are common during the monsoon period in the geographical region involved. See, these are the common, so high water levels in that season. So therefore, definitely you should delay it. It is necessary. So the treatment done by Mrs. Mathur, the company accountant, is very much correct. Okay. So this is one important question, sir. One more question which is there in the study material is illustration 12, sir. You see it. On 14th August 2021, Pushkar Limited obtained a loan from RBC Bank of 65 lakhs to be utilized as under. See, this RBC Bank has taken a loan of 65 lakhs. And what they have done with this 65 lakhs? Purchase of equipment 19 lakh 50,000. Construction of factory shed. They constructed one factory shed 26 lakhs. Advance for purchase of delivery vehicle. See, they purchased one delivery vehicle. The cost is 6.5 lakhs. Working capital 13 lakhs. See, actually they have spent like this. Total 65 lakhs they have spent like this. Next, what happened? In March 2022, installation of the machinery was completed. See, this machinery, construction of purchase of equipment. March 2022 installation was completed, and also the construction of the factory shed was completed and the machinery installed. Okay. However, the truck was not delivered within 31st March 2022. See, we ordered the truck now, we paid advance, but not delivered. The total interest charged by the bank for the year ending 31st March 2004 was 11.7 lakhs. Wrong. The total interest charged by the bank for the year ended 31st March 2022. How it suddenly becomes 2004 year? The question is relating to 2022, 21, 22. So make it 2022 is 11.7 lakhs. So total interest on the 65 lakhs. Discuss how the interest amount should be treated in the financial statements of the company for the year ended 31st March 2016. See here, actually what they are telling is, see, they have taken a loan from the bank. So what is the bank loan they have taken, sir? Loan from bank 65 lakhs, correct? Now what they have done with the 65 lakhs? 4 things. First, purchase of equipment they have done. One asset, purchase of equipment. Second one is they constructed factory shed. So they constructed the factory shed, and then they have given the advance for purchase of truck, one asset, and then working capital. Now you tell me, by looking at these assets, first of all, out of the 65 lakhs, what will be the total interest charged by the bank during this year? 11.7 lakhs. 11.7 lakhs interest cost. Now what is the accounting standard 16? Accounting standard 16 says borrowing cost directly related to acquisition, construction, production of which asset? Qualifying asset will be capitalized. So first of all, is it a qualifying asset or not? So qualifying asset, yes or no, we need to decide first. Is it a qualifying asset or not? Tell me. So first of all, is it a qualifying asset or not? First of all, I can tell that working capital is not a qualifying asset, sir. How working capital will be an asset, sir? Not a qualifying asset. Second thing is, purchase of truck is not a qualifying asset. Why? Why purchase of truck is not a qualifying asset? Because we discussed the definition of qualifying asset. Qualifying asset means an asset which takes substantial period of time to get ready. It takes substantial period of time to get ready. Here truck, is it take substantial period of time to get ready? No. It will not take. Immediately you can use it now. Sir, but in the question they said there is a delay in delivery of truck. See, delay in delivery, okay. The asset should be immediately usable. That you have to see. It takes substantial period of time to get ready for use, they said, or sale. So truck, maybe the supplier will give you delivery lately. That is not the matter. Once you receive the truck, you can use it now, immediately. So this is not a qualifying asset. Okay. And then construction of factory shed. Sir, actually, if you read the question properly, they said regarding construction of the factory shed, when they have started construction, they have not given, but they said here in March 2022, construction of the factory shed is completed, and 14th August 2021, actually they have taken the loan. See, 14th August 2021, loan is taken, and 31st March 2022, construction is completed. Tell me how much period actually? Approximately, suppose August 15 days. September, October, November, December, January, February, March. 7 months, 7.5 months I can say. 7.5 months. August month, half month, remaining 7 months. September, October, November, December, January, February, March. So 7.5 months it has taken, sir. For what? For what? For construction of this factory shed. Because see, construction of factory shed, they use 26 lakhs. Now tell me whether this construction of factory shed is qualifying asset, because it has taken only 7.5 months. See, I told you generally qualifying asset means an asset which takes substantial period of time to get ready for its use. Here generally construction of factory shed, they have taken only 7.5 months. So frankly speaking, 12 months, they have not taken 12 months. But in general, you think about it, factory shed, you want to construct a factory shed, definitely it will take substantial period of time to get ready for intended use or sale. So I can say that it is a qualifying asset, even though it has taken less than 12 months. I can't deny the benefit. Now coming to purchase of equipment, we purchased 19,50,000 equipment. See, in March 2022, installation of the machinery was completed. That means, see, equipment we purchased and we will use it. How it will take substantial period of time. So machinery can be readily usable, na? It is not that something we will wait for machinery to ready. See, that's why here institute has taken a assumption that this is qualifying asset, remaining all non-qualifying assets. See here, they are saying that the purchase of equipment, it is not a qualifying asset, but this is, yes, this is a qualifying asset. Construction of factory shed is a qualifying asset. Sir, This is only 7.5 months. How can it be a qualifying asset? See, 12 months is not the criteria. Even is less than 12 months can also be considered a substantial period of time. Just because you constructed the factory in 7.5 months, that doesn't mean that we are take away the benefit of capitalization from you. You might construct the factory shed within 7.5 months, maybe by using latest technology, by using more labor. See, the assumption is here the company constructed in less than 12 months. Actually, 12 months is not the yardstick here. In general, they said. What about purchase of equipment? See, equipment is readily usable. So, where is the question of, qualifying asset? It can be used readily. Sir, in the question they said, see, in the question they clearly mentioned that in March 2022 installation of the machinery was completed. That means, see, suppose 14th August 2021 we taken a bank loan. Suppose on that date we purchased it, and installation is completed in March month. That means approximately 7.5 months taken from purchase date to the installation date. Can I say, is it also qualifying asset? And we, by using latest technology, by using more labor, we installed it very quickly. See, by nature, whether an equipment is a qualifying asset, is it something to be constructed? No, it is purchase. Purchase means readily it is available. Only for installation you have taken 7.5 months. No, that is not the case here. Maybe, see, you purchased on 14th August, but it should come from supplier's factory to your factory. Definitely all formalities must be completed. For example, this machinery you are importing from outside India. Is it possible that on the same date they will give the delivery? So from purchase till the date of installation, there may be a gap. That gap is because of the formalities. See, it is not that big machineries you ordered and next day they will deliver. It is not possible. Generally they will be customized. Once you give the order, they will make it. According to your requirements, they will manufacture it. According to your production requirements. So therefore, when you see the word purchase, generally don't be under the impression that I purchased equipment on 14th August and installation I have done in March month, 7.5 months I take. So it is also qualifying asset. No way. Here construction is entirely different from purchase. So here you are purchasing the equipment, but here you are constructing something, a long-term project. So factory shed is generally qualifying, even though it has taken less than 12 months, but still it is a qualifying asset. So this is the thing. Okay, sir, then next what, sir? Simple. See, if it is a qualifying asset, interest will be capitalized. Non-qualifying asset, charged to P&L. So see here, actually this is capitalized, and this is charged to P&L, P&L account. So see, it's 11.7 lakhs total. Now for purchase of equipment and advance for purchase working capital, you charge to P&L. Remaining it will capitalize. So only item to be capitalized is this. How much you will capitalize, sir? Simple. 11.7, sir, total, into what is the total borrowings? 65 lakhs. How much you spend for construction? 26 lakhs. So 11.7 into 26 divided by 65. It will be 4.68 lakhs. So 4.68, that means 4,68,000. 4,68,000, what we need to do? Capitalize. So 4,68,000. So 11.7 into 26 divided by 65. It is 4.68 will be capitalized. Remaining out of 11.68, 4.68 is capitalized. 11.7. Out of 11.7, 4.68 is what? Capitalized. So remaining will be charged to P&L account, 7.02. But asset wise, if you see, same manner. For example, 11.7 into total borrowing 65 lakhs. Out of that, how much we spend for purchase of equipment? 19.5. So proportionately you take. Similarly, 11.7 into 65 lakhs total borrowings. How much we spend for purchase of vehicle? 6.5. And working capital also 11.7 into, so 13 divided by 65. That's it. So you will get how much amount will be charged to P&L account. So this is one question, sir, they have given in the study mat. See here, in this case only factory shed is a qualifying asset, and the amount of and its interest and its presentation is this. So what is the nature of asset? Interest capitalized, charged to P&L account, you decide. Proportionately you take. What will be your total borrowings? 65 lakhs. What will be your total interest cost? 11.7. Now this 11.7 you have to apportion. If it is a qualifying asset, capitalize. If it is a non-qualifying asset, charge to P&L. That's it. That's the treatment you have to do. Okay. So these are the two study. Now let us discuss accounting standard 22, sir. So accounting standard 22, the name of the standard is accounting for taxes on income. Accounting for taxes on income. So in this standard, the main focus is on taxes on income and its accounting treatment. As per accounting standard 22, there are two types of taxes on income. One is current tax, another one is deferred tax. Now our main focus is on deferred tax. So basically AS 22 talks about taxes on income, current tax as well as deferred tax, but here the main focus is on deferred tax. Okay. Now before going into the standard, first let us discuss what is the background behind AS 22. Why accounting standard 22 came into the picture? What is the main object of accounting standard 22? So in this discussion we will understand deferred tax itself, deferred tax concepts itself. We will understand it. Once we know the purpose why this standard is introduced, so we will come to know about deferred tax. Okay. Sir, before you want to learn about the concept of deferred tax, first you need to understand two things. One is accounting income. This standard uses the word accounting income, and there is taxable income. Accounting income, taxable income. Sir, what is accounting income? See, accounting income is nothing but net profit or loss from profit and loss account. See, every year we prepare P&L account. From P&L account we arrive net profit or loss. And next, what is taxable income? See, in order to determine the current year tax liability, we need to calculate taxable income. On the taxable income, we will apply tax rate and we will get current year tax liability. So on one hand, there is accounting income. On the other hand, there is taxable income. Accounting income is nothing but net profit or loss derived from preparation of P&L account. Taxable income is nothing but the income which is determined by following the provisions of Income Tax Act, and by using the taxable income we calculate the current year tax liability. See, generally how P&L account is prepared? P&L account is prepared by following Companies Act provisions, by following generally accepted accounting principles, by following accounting standards. But how to arrive taxable income? By following provisions of Income Tax Act. So accounting income is nothing but net profit or loss. Net profit or loss arrived from P&L account. This P&L account we prepared by following the provisions of Companies Act, Schedule 3, company rules, we have accounting standards, we have generally accepted accounting principles. All these things we apply in the preparation of P&L account, and by following these rules and regulations we prepare P&L account and we will get net profit or loss. But this taxable income is arrived by following what? By following the provisions of Income Tax Act. We have Income Tax Act. According to that act, there are so many provisions. See how to get a taxable income. See, those 5 heads of income is there now. For example, in case of a company you take profits or gains from business or profession, capital gains, income from other sources. Then you will get gross total income. From that you reduce chapter 60 deductions. Then you will get taxable income, that is total income. On the taxable income you calculate the tax liability, right? So to determine the current year tax liability, we need to determine the taxable income, and the taxable income is calculated by following the provisions of Income Tax Act. That means every company, if you see, they are preparing every year P&L account. Every year they need to calculate taxable income and thereby they need to determine the tax liability. But this tax liability, whatever we decided by following the provisions of Income Tax Act, they are also part of P&L account. See, in P&L account we need to show the tax expenses also, but the tax expenses we are determining by following the provisions of Income Tax Act. That means whatever the net profit we arrived in P&L account, that net profit is not the base to calculate current year tax liability, but whatever the taxable income we calculated by following the provisions of Income Tax Act, that taxable income, based on that we are determining the current year tax liability, and that tax liability we are recording in the books of, we are and showing as a part of P&L account. See, suppose when I prepare P&L account, I will get net profit generally before tax. Suppose I got a net profit of 100 before tax. Now will I calculate my tax liability on this 100? No. Why? Because this 100 is from P&L account, but I need to calculate taxable income by following the provisions of Income Tax Act. Suppose my taxable income, if I follow the provisions of Income Tax Act, it may be different from 100. For example, maybe it is 80, maybe it is 120, maybe it is 150. Sir, why there is a difference between this net profit before tax and taxable income? That means this accounting income and taxable income, why there are differences? See, the main reason for difference is the provisions of the Income Tax Act. See, in order to give deductions, income tax will prescribe different conditions. Sometimes the benefit is given in the first year itself. Sometimes the benefit is given over a period of time. So sometimes the deductions are not at all allowed. Like that, there are provisions in the Income Tax Act. By following the provisions of the Income Tax Act, you are determining the taxable income. On the taxable income, you are calculating the tax liability. But whereas whatever the net profit which is there in the P&L account is prepared by following the provisions of Companies Act accounting standard, we are not following Income Tax Act provisions, because income tax provisions are applicable only for calculation of taxable income and determine the tax liability. So therefore, definitely this net profit before tax, whatever you arrived by following the Companies Act, and this taxable income you determined based on the provisions of income tax, maybe they are not matching. Suppose for example our taxable income is 150. So on this 150 you determine the tax. Suppose tax at the rate of 30%. So 150 into 30%. So it will be 45. This is my tax liability. And this tax I will write as a part of P&L account as current year tax is 45. But your income is only 100 as per the P&L account, but you are showing tax expenses of 45. So these two are not matching. Why they are not matching? Because there is a difference between accounting income and taxable income by 50. Because of that, these two are not matching. That means whatever the income you earned in the current year, the tax liability you are recognizing in the books, these two are not matching. So suppose for example, ideally speaking, if your income is 100, okay, on that if you apply 30% tax liability, so it will be 30 only. The tax should be 30, but you are recognizing 45 tax expenses. You're recognizing 45. That means these two are not matching. So there is a violation of matching concept. What is matching concept, sir? In a particular year, what is the profit you are earning and the corresponding tax expenses must be recognized in the same year. Suppose you are paying 45 rupees tax, correct? So this 45 rupees you are paying to earn current year profit of 100 rupees. But on 100 rupees, the tax should be 30 only, but you are paying 45. That means that extra 15 rupees, whatever your tax liability you are showing in the current year, is because of some difference between accounting income and taxable. Now on that difference, we need to calculate deferred tax in order to match the tax expenses with the current year accounting income. Okay, so the point is very simple. Once again, step by step, if you learn, there is no confusion. See, there is accounting income, there is taxable income. Accounting income means net profit or loss from P&L account. Taxable income means by following income tax provisions, you determine the tax liability. So this accounting income 100, taxable income 150. So there is a difference of 50. First point. Second point, on this taxable income, you determine the tax liability 45 came. Now this 45 you are showing it as a part of P&L account. Now what they are saying is, if you earn 100 rupees net profit, ideally the tax should be 30 only na, but you are showing 45. So these two are not matching. Sir, why they are not matching, sir? See, because tax you are bringing it from Income Tax Act and you are showing it as a part of P&L account, but in P&L account you would show only 100 rupees profit. If suppose here also 150, then this is correct. Whatever the tax liability you are showing and whatever your income, both are matching. Then this concept will not arise. This concept of deferred tax will not arise. Why this concept of deferred tax is arised? Because whatever the taxable income, whatever the net profit, accounting income you are showing, but whatever the tax liability you are showing in the books, both are not matching. In a particular year, whatever the income you earned, whatever the profit you earned, it must be taxed in the same year. Suppose if you earn 100 rupees profit, this 100 rupees must be taxed in the current year itself. Because this 100 is arrived because of what? Income minus expense, right? So when the incomes and expenses belongs to particular year, the profit is also belongs to that year, and the tax expenses must match with that profit in the same year. This is the matching concept now. So profits belongs to this year, tax expenses must also belongs to this year. So you should match the taxes with accounting income. So how can we match these two? See, first of all, why there is no matching? Because of difference. Because of this difference only na. Here we are taking 100, but there we are taking 150. 50 rupees difference. Because of this difference, these two are not matching. Your taxes and your accounting income are not matching. So now standard says, okay, you identify the difference first, okay, and then see, is this difference is a temporary difference, permanent difference, or they call it as, is this difference is the timing difference or permanent difference? Sir, what is timing difference? See, the difference is only in time. Ultimately, either you follow Companies Act or you follow Income Tax Act, overall benefit, overall same. But the difference is only the time. In that situation, so even though difference arises in this year, this is going to reverse in future. This is going to reverse in future. So when the difference arises, and this difference is only a timing difference, it is going to reverse in the future years. Now, why can't you recognize deferred tax relating to that difference? And because of that difference only, now they are not matching. So do one thing, if 100 rupees is your net profit, 45 rupees is the current tax, on the difference of 50, so if I apply 30%, so it will be 15. You recognize deferred tax of 15. Deferred tax 15. So the total tax expenses is 30. Now it is matching. Now it is matching. 45 is your current tax. Deferred tax is 15. Sir, when you say tax 45 plus 15, it will be 16, sir. Why you are writing 30? See here, I have recognized deferred tax asset. Asset. So what is the entry? Deferred tax asset account debtor to deferred tax. Then this deferred tax will be created to P&L. Deferred tax to P&L. So this 15 I created to P&L account. Sir, why you credited to this to P&L account? Why you reduced income tax expenses? Total tax expenses from 45 to 30. Why you reduced 15? Because current year my taxable income is 150, but my accounting income is 100. That means I paid tax on more income. So this deferred tax asset and liability concept, very simple, sir. Simple. Pay now, save later. Okay, or save now, pay later. Pay later. Now you tell me, are you paying now or saving later? You are paying on 150. Tax is paid on 150, but your account income is only 100. That means you are paying tax on excess amount 50. So definitely there is a deferred tax asset. In future, definitely your liability will be less. This 50 is going to be reversed in future. Next year, as per income tax, this will be allowed. So if it is allowed, in the future years, your taxable income will reduce by 50. If it is reduced by 50, your tax liability will reduce. So therefore, there will be economic savings in the tax expenses for future. So that will be your asset, deferred tax asset. So same could be the reverse situation also. There will be deferred tax liability also. Okay. Okay. Now I will take one complete example, sir. I will try to explain the concept once again. So this is just a brief idea about this. So first you identify. So we are preparing P&L account, and in P&L account we are showing tax expenses, but the tax expenses we are arriving by following the provisions of Income Tax Act. Obviously in Income Tax Act, whatever the taxable income we are arriving, and here whatever the net profit we are arriving, both are not matching. There will be differences because of the provisions of the Income Tax Act. Therefore the tax expenses and the current year accounting income are not matching. But the matching concept says in P&L account, if any income, if any revenue or expenses, like in profits, if you show profit in a particular year, the tax expenses must also relate to that year. That the expenses, the tax expenses relating to that profit must also reflect in that year. Suppose if I earn 100 rupees profit, so 100 into 30%, so 30 rupees tax expenses. This current year income must be taxed in the current year itself. This current year profit will be taxed in the current year itself. So, but you are taxing on 150. So therefore the extra 50 may be because of which reason. That difference I need to identify, and I need to recognize it as deferred tax asset or liability. And I will do one more example, sir. I think with this example, you will understand this concept. For example, there is a company, A Limited. Suppose they purchased one machinery. Suppose this company net profit before depreciation and tax. This company net profit before depreciation and tax, sir. 23, 24, 24, 25, 25, 26. 3 years data given. So 1 lakh, sir. 1 lakh, 1 lakh, 1 lakh. This is what they have given. Net profit before tax of A Limited 23, 24, 24, 25, 25, 26. And this company purchased a machinery. Okay. When on 1st April 23, they purchased a machinery worth of 30,000. Machinery they purchased. Suppose this machinery they purchased for scientific research. Scientific research. Scientific research. And you know, as per the income tax act, whenever an asset is purchased for scientific research, as per section 35, 100% is deduction will be allowed in the first year itself. Okay. But as far as the Companies Act is concerned, so this will be depreciated over the life of the asset, SLM, straight line basis. Suppose the life is 3 years. Imagine the life is 3 years. Now this is the case. So there is a company called A Limited, sir, and there is a net profit before depreciation and tax for the year 23, 24, 24, 25, 25, 26. Imagine same profit 1 lakh, 1 lakh, 1 lakh. There is a machinery we purchased 1/4/2023 for 30,000 for scientific research. And as per the Income Tax Act, 100% deduction is allowed in the first year itself as per section 35. And Companies Act 2000 SLM 3 years we need to do. Now, in this situation, what happens? I will tell you. Now, first one by one I will do to get complete understanding. Sir, first what I will do is I will compute taxable income and tax liability. So, tax computation. I will go for tax computation for 3 years. 23, 24, 24, 25, 25, 26. Okay, 3 years. Tell me what is my net profit before tax. How much is the net profit before tax in all 3 years? Sorry, net profit before depreciation and tax. Given 1 lakh, 1 lakh, 1 lakh. Sir, in the first year we purchased a machinery, right, for scientific research. When you purchase the machinery for scientific research, total deduction is allowed in the first year itself. So therefore, can I say less depreciation? So since the asset is purchased for scientific research, as per section 35, total 100%. So section 35, 100% deduction will be allowed. 100% deduction will be allowed in the first year itself. So can I say that this 30,000, the cost of the asset, will be completely allowed in the first year itself as per the Income Tax Act? Correct. Because as per section 35, whenever you purchased any machinery for scientific research, 100% deduction is allowed in the first year itself. So we allowed it. Now that means, tell me what is my taxable income? Taxable income. Suppose imagine there is no other item. Taxable income, total income, nothing but total income, taxable income, 70,000 K, right? On this 70,000, I need to pay tax. So my tax liability. So how much is the provision for tax I will create? Tell me. Provision for tax. Suppose imagine the tax liability is 30%. 30% is the tax liability. Now tell me 70,000 into 30%. So it will be 21,000. This is my what? This is my first year tax liability. As per the Income Tax Act, my first year tax liability. I think you understood. Because by this time you already have some idea about Income Tax Act. So how to calculate total income as per the Income Tax Act? By taking all heads of income, gross total income minus deductions, you will get taxable income. On the taxable income, you apply tax rate, then you will get total tax. Okay, this is what I done. So simple net profit before tax I have taken. Depreciation I deducted completely. Entire cost of the asset I deducted because this is section 35 scientific research deduction. Okay. Now come to second year. Any depreciation will be allowed in the second year? Answer is no, because entire 30,000 is allowed in the first year itself. So therefore, second year your taxable income is 1 lakh and your tax liability is 30,000. Now come to third year. Same. Entire cost of the asset allowed in the first year itself. And your tax liability will be this much. So this is as per the Income Tax Act. Simple example I have taken. Now as per the Income Tax Act, this is what we have done. We have to do. Okay. Now this is the tax liability we determined. Now come to the P&L account. The most important part is profit and loss account. Now come to the P&L accounts. Okay. Now P&L account statement if I prepare, I need to prepare P&L account also for 3 years. I mean 23, 24, 24, 25, 25, 26. Tell me now, what is my net profit before depreciation and tax? Net profit before depreciation and tax. Same, 1 lakh, 1 lakh, 1 lakh. Now you tell me how much is the depreciation allowed? Less depreciation. Sir, when you prepare P&L account, will you follow Income Tax Act, sir? No, you follow the Companies Act. As per the Companies Act, so SLM we need to follow straight line method. 3 years life, so 30,000 divided by 3. So 10,000 is the depreciation. 10,000 is the depreciation. 10,000 is the depreciation. Now observe the difference. As far as the income tax is concerned, total cost of the asset allowed in the first year itself. But as far as the Companies Act is concerned, depreciation is allowed over a period of 3 years. Okay. Now you tell me what will be my net profit before tax. This is 90,000. This is also 90,000. And this is also 90,000. So 90,000, 90,000, 90,000 is my net profit before tax. Net profit before tax. Now I need to provide the tax expenses. Okay. So suppose what is my tax expense here? Provision for tax. Computed above. We computed above. See, first year what is my tax liability? 21,000. See, first year tax liability 21,000. First year tax liability 21. So provision for tax 21,000. Important. Please concentrate here. 21,000. Okay. Now you see, 90,000 is the net profit before tax. But what about your taxable income in the first year? First year taxable income is 70 only. But accounting income 90. So there is a difference of 20,000. Okay. There is a difference of 20,000. Now ideally speaking, see, suppose if I apply 30% on this 90,000, can you tell me what is the tax liability? It will be 27,000. But I am taking 21,000 liability. So that means these two are not matching. These two are not matching. Because in the current year, you have a profit of 90,000, but entire 90,000 should be taxed in the current year itself. That is matching concept. When a profit earned in the current year, the tax expenses relating to it must also belongs to current year. We need to match with the profit and the tax expenses. See here, this 21,000 you are paying, right? 21,000 your tax liability. See, this 21,000 is for what? How much? This is only for 70,000. But 90,000 you are showing in the P&L account. That means your current year profit earned by you is 90,000. It must be taxed in the same year, but you are taxing only 70,000. So if 90,000 is the profit as per the P&L account, you should tax entire 90,000 now. Because matching concept. When any revenues minus expenses, you got a profit. If the profit belongs to 23-24, the tax expenses must be belongs to 23-24 also. That means whatever the profit you earned in the current year must be taxed in the current year itself. So there should be a matching of incomes and the related tax expense. But here they are not matching now, because you are showing tax liability of 21,000, but you earn 90,000. That means 20,000 not taxed this year. Why, sir? Why it is not taxing this year? Because we are following Income Tax Act. As per the Income Tax Act, only 70,000 is taxable. But in P&L account, we got 90,000. That means 20,000 not taxed this year. Why it is not taxed this year? What is the reason, sir? The difference between taxable income and accounting income is 20,000. Sir, what is this difference, sir? Depreciation. Sir, you see, as per the Income Tax Act, total 30,000 is allowed in the first year. But as far as the P&L account, only 10,000 is allowed. That means 20,000 cost of the asset allowed as per the Income Tax Act in the first year itself. But this 20,000 is allowed in the P&L account next year 10,000, next year 10,000. But see, now you identify the difference. You identify the difference. Learn the concept. Identify the difference between these two. 20,000 is the difference. Now you have to identify the reason for this difference. Accounting Standard 22 says the reason could be two. They classified the differences into two types between accounting income and taxable income. They say the reason could be timing difference. So timing difference means which originates, which is going to reverse. You need not worry. It is only the difference of time. Overall, it is same. Permanent difference, which originates, which is not going to reverse. It will be forever. Ignore. Deferred tax is always created on timing differences. Okay. Now in this case, what is timing difference? We'll say depreciation is the timing difference. Sir, how it is a timing difference? Tell me what is the cost of the asset? 30,000. You see, this 30,000 is already allowed in the first year as per the Income Tax Act. Same 30,000 is allowed over a period of 3 years. The overall amount is same, 30. But the difference is only the time. As far as the P&L account is concerned, we allowed this 30,000, 10,000 first year, second year 10,000, third year 10,000. But as far as the income tax is concerned, total 30,000 is allowed in the first year itself. So the difference is only time. The difference is only time. Overall, the amount of depreciation allowed is the cost of the asset. Whether you do it in the P&L account or you follow, Income Tax Act, the total cost of the asset will be allowed as depreciation mostly. So therefore, overall depreciation allowed 30. But in income tax, total 30,000 allowed in the first year. But as far as the P&L account is concerned, this 30,000, first year 10,000, second year 10,000, third year 10,000. That means first year there is a difference between accounting income and taxable income by 20,000. This 20,000 is going to be reversed by 10,000 in the second year, 10,000 by third year. Now standard says this timing difference is the reason why your accounting income and taxes are not matching this timing difference. The difference could be timing difference. Now you see this timing difference, on this timing difference, you anticipate on the effect of timing difference, you recognize the tax. So that means this 20,000, it is a timing difference. Definitely this is going to reverse. How it is going to reverse? See, first year what is your taxable income? 70. Accounting income 90. How much is the difference? See, I will write here. First year taxable income, accounting income. Taxable income 70, accounting income 90. So what is the difference? 20. Okay, this is 23, 24, right? You see 24, 25, what happened? Your accounting income same 90,000. Taxable income is only 1 lakh. You see this difference? 1 lakh. Third year also same. 10,000. 25, 26. Same here. 1 lakh. 90,000. 10,000. So first year what happened, Anna? First year your taxable income is less than accounting income. Second year you see taxable income is greater than accounting income. Third year you see taxable income is greater than accounting income. First year taxable income less than accounting income by 20,000. Second year taxable income is more than accounting income by 10,000. That means 10,000 reversed. Third year, another 10,000. So whatever the timing difference which originates in the first year, what is the timing difference? 20,000. Is reversing in the next 2 years. So this 20,000 is the difference. And this is reversing in the next 2 years. How? In the next 2 years, your taxable income is more than accounting income by 10,000. First year, your taxable income is less than accounting income by 20,000. Sir, what it indicates? See, simple funda I will tell. See, entire this standard, remember the simple rule. Save now, pay later. If you are saving now, you will pay later. That means there will be liability in future. If you pay now, there will be savings in future. Save in future. Pay now, save later. So if it is save now, pay later, we call it as deferred tax liability. Because today you saved, tomorrow you have to pay. So when tomorrow you have to pay means it's a liability. Pay now, save later. That means you paid now, there will be savings later. That will be deferred tax asset. Now you see, in the first year, tell me, taxable income 70,000. That means you paid tax on 70. You paid tax on 70, but your accounting income 90. That means on 20,000 there will be savings of tax. You saved now. On 20,000 you have not paid. So therefore definitely there will be liability in future. This 20,000 is going to reverse. That means in the future years this 20,000 increases your taxable income. Therefore there will be tax liability. Therefore you recognize now deferred tax liability. So therefore DTL will be recognized. How much? 20,000 into 30%. So this timing difference into 30%, there will be 6,000 deferred tax liability will be recognized in the first year. Sir, out of this 20,000, 10,000 is reversed in the next year. You also reverse 10,000 into 30%. 3,000 you reverse. The balance will be 3,000. Next year another 3,000 you reverse because 10,000 it will be nil. So therefore, can you tell me what is your first year deferred tax liability? 6,000. Second year 3,000. Third year nil. First year 6,000. Second year 3,000. Balance. Third year nil. That means first year 6,000. Second year 3,000 reverse. Third year 3,000 reverse. I think, are you understanding the concept, sir? Sir, in this case, save now, pay later. In the first year, your taxable income is 70 pa. Your accounting income 90. That means your taxable income is less than accounting income. Whenever your taxable income is less than accounting income and the difference is because of timing difference, understand there will be liability in future. Therefore, you need to recognize deferred tax liability. So that means in the first year, we need to recognize deferred tax liability. Sir, you mean to say on this timing difference, we need to recognize deferred tax liability? You need to recognize. Because the standard says, whenever you know there will be liability in the future, by following the concept of prudence, you anticipate it. You know, today you saved 20,000 because of the provisions of the Income Tax Act, but the same will be going to reverse now. You claimed 30,000 depreciation in the first year. Of course, as per the P&L, only 10,000 is allowed, but you know, second and third year, you are not going to get any depreciation. But as for the P&L account, you will get. That means second and third year, your taxable income is more than accounting income by 10,000, 10,000. But first year, your taxable income is less than accounting income by 20,000. And second and third year, your taxable income is more than accounting income by 10,000, 10,000. Therefore, there is a difference which originates in the first year and which is going to reverse in the future. This is called timing difference. On timing difference, whatever the tax effect will be there, that is called deferred tax. So therefore, what company will do here is they will recognize deferred tax. Deferred tax. Sir, what is this deferred tax? Simple. What will be the timing difference? 20,000. On this 30%. How much? 6,000. Sir, is this deferred tax asset a liability or asset? Here, liability. How liability? How it is liability? Simple. Liability means something you need to pay. You have to pay this 6,000 in future. How? Because this year I am paying tax on 70,000, but my accounting income is 90. Second year, my taxable income is 1 lakh. My accounting income is 90. That means 10,000. So whatever the timing difference arises, whatever saving now, pay later. So therefore, this 6,000 is my deferred tax liability. So what is the entry? Simple. Deferred tax account data to deferred tax liability. Liability will be created. So deferred tax liability will be created. Deferred tax expenses account will be debit. So deferred tax expense account data to deferred tax liability. 6,000, 6,000, and this deferred tax expenses will be debited to P&L. P&L account data to deferred tax expenses. 6,000, 6,000. So ultimately, what is the entry? P&L account data to deferred tax liability. P&L account data to deferred tax liability. Deferred tax liability. So that's why deferred tax liability will be shown in balance sheet, non-current liabilities. Deferred tax liability. Now you see 21,6. So 21,6, it will be 27,000 minus total. Now it is matching. See, 90,000 into 30%, exactly 20,000, 27,000. Now you are matching. You are matching the accounting income with its tax expenses during the year. Previously, suppose if I don't recognize this deferred tax, my tax expenses will only 21. My accounting income is 90. That means both are not matching. On 90,000, if you apply 30%, it should be 27,000. But it's only 21,000 came. So the difference 6,000 is deferred tax. And it is a liability. Save now, pay later. I am saving now, but I need to pay later because this is only timing difference which originates and going to reverse in future. Okay. Now you tell me what is the profit after tax? 90 minus 27. So it will be 63,000. This is how you prepare P&L. This is P&L account. This is profit and loss account. Now I am going to do the second year. Come to second year. Second year, what is the provision for tax? I mean tax provision already calculated 30,000. 30,000. Okay. Now see, first year you recognized a deferred tax liability of 6,000 on timing difference of 20,000. Out of 20,000, second year 10,000 is reversed. How? See, 10,000. See, in the second year you see the difference. See, first year difference between accounting income and taxable income 70, 90. 20,000. Taxable income is less than accounting income. Now second year you see taxable income is more than accounting income by 10,000. That means out of this 20,000, 10,000 is reversed. Third year you see another 10,000 reversed. So therefore the difference arises in the first year. First year taxable income is less than accounting income by 20. Second year onwards taxable income is more than accounting income by 10,000, 10,000. So the timing difference which originates is going to reverse in the future. Therefore, whenever the timing difference is reversed, you also need to reverse whatever the liability you recognized, whatever the asset you recognize. In this case, liability we recognize, so we reverse it. How much? To the extent of timing difference reverse. How much reverse? 10,000. So 10,000 into 30%. So it will be 3,000. We need to reverse. So you need to reverse 3,000. So 30,000 is already a negative plus 3,000. Sir, why plus, sir? See, when you create a deferred tax liability, what is the entry? Deferred tax expenses to deferred tax liability. Reverse it. Deferred tax liability to deferred tax. Deferred tax liability to deferred tax expenses. That means deferred tax liability to P&L account. So it is kind of a credit to P&L accounts. So therefore, this is deferred tax liability to P&L. So it will be 27,000. So whatever the difference arises in the first year, that is reversed. So this is minus. Third year also same. 30,000 plus 3,000. So it will be 27,000. So it will be 90 minus 27, 63,000. 63,000. That means, Nana, if I could pass the entries, I will pass the entries also for you. See, listen. Year 1, that is 23, 24. In this year, at the end of the year, we have recognized deferred tax. Here, 6,000 we recognize deferred tax liability. So what is the entry? Simple. Deferred tax expense or deferred tax account debtor to deferred tax liability account. deferred tax liability, deferred tax account debtor to deferred tax liability. How much? 6,000, 6,000. Now this deferred tax will go to P&L account. So P&L account debtor to deferred tax. How much? 6,000, 6,000. That means in the first year end, we recognized the deferred tax expenses and which is debited to P&L account 6,000, and this deferred tax liability will be shown in the balance sheet because this is going to be paid. This is the liability for future. So therefore we anticipated by following the prudence concept, we recognized it because we saved now. So there will be obligation in future. Now coming to the second year, 31st March 2025. Out of timing difference of 20,000, 10,000 is reversed. Therefore, we need to reverse it. Deferred tax liability. So simple. This entry, deferred tax liability will be reduced na? To the extent of timing difference reverses. So deferred tax liability account debit to deferred tax account. Deferred tax account. How much? 6,000, 6,000. Sorry, not 6,000. How much reverses, sir? 10,000. On 10,000, 30%. So 3,000, 3,000. And that means deferred tax to P&L account. To P&L account. That means first year deferred tax expenses 6,000. Out of that, 3,000 is now reversed. So that means at the end of the second year, what is my deferred tax liability? 3,000. How much is deferred tax expenses credited to P&L account? 3,000. Now coming to the last year, 31st March 2026. Same. Third year also we need to reverse it now. So deferred tax liability. Deferred tax liability account debit to deferred tax account. 3,000, 3,000. And this deferred tax will be credited to P&L account. To P&L account. 3,000, 3,000. Now see, this is the concept of deferred tax. So when you follow this concept, what happens is, see, look at the P&L account. P&L account now justifying the matching concept. Whatever the profit you have, the tax, it is matching with the tax. It is matching with the tax. Now because of the concept of deferred tax. So basically in AS22, what we are doing is, first of all, we try to identify the differences between accounting income and taxable income. And these differences are classified into two types: timing, permanent. Timing difference is the difference which originate and which is going to reverse, like depreciation. Overall depreciation is same if you follow Companies Act or if you follow Income Tax Act. But of course, the difference is only in timing. So therefore, these differences you identify, and on these differences you calculate deferred tax to match the accounting income with the tax expenses. So if in the current year, if I earn a 90,000 to 30%, it will be 27,000. But my tax liability is only 21,000 because my taxable income is only 70,000. That means the 20,000, it is not subject to tax. Now, why it is not subject to tax? Because of Income Tax Act. Now, this 20,000 anyway is going to reverse in future. Of course, you are saving now. It is only a temporary saving. In the next second year, your income is ready. Your taxable income is more than accounting income, because second year, third year, no depreciation is allowed. Entire depreciation is allowed in the first year itself. So first year there will be savings, but this savings is going to give you tax liability in future. That's why I'm anticipating and I'm recognizing deferred tax liability. So through this deferred tax concept, I'm trying to match my accounting income with tax expenses. That will be the concept of deferred tax. Will be the concept of deferred tax. And these are the entries we need to pass. Similarly, there could be a situation of deferred tax asset also. Could be situation of deferred tax asset also. See, this is deferred tax liability, Nana. I can explain you deferred tax asset also. Explain you deferred tax asset also. So I will explain deferred tax asset also. See, one example I will take and I will explain deferred tax asset. See, this depreciation example I taken, this is deferred tax liability. You understood, I think. Now deferred tax asset I am taking. Okay, listen to me. Suppose Nana, our net profit before tax and interest also I am taking. Net profit before interest and tax. Suppose 1 lakh, your net profit before interest and tax 1 lakh. As per the P&L account, I am preparing P&L account. And there is interest expenses. Interest on loan, for example, interest on loan 10,000. So tell me, what is my net profit after tax? After tax 90,000. Net profit after tax 90,000. So can I calculate tax liability exact on this 90,000? No, I need to calculate taxable income. Now I am calculating taxable income. I mean tax computation. I'm doing. So first my net profit before interest I am taking and tax. Suppose it is 1 lakh. Now see, tell me, as per the Income Tax Act, interest on loan allowed on which basis? I think section 43B. Section 43B says income tax, as per the income tax provisions, section 43B, interest on loan will be allowed on payment basis, not on due basis. When you pay, deduction will be allowed. Suppose imagine a situation, sir, this interest on loan not paid within the due date of filing return of income. Suppose if it is not paid within the due date of filing return of income, then if you have not paid it, even though it is allowed as per the income tax, as per the P&L account, because in P&L account we follow the concept of accrual concept. Whatever the income expenses earned, occurred during there, we will allow deduction. But as far as the Income Tax Act, is concerned, we will allow interest expenses only on payment basis. That means this interest on loan, for example, here I am taking profit, net profit from P&L account I am taking after tax. Suppose 90,000. Tell me, this 90,000 is after deducting this interest expenses. Now this interest of 10,000, is it allowed as per the Income Tax Act? Answer is no, not allowed. So therefore interest should be add back 10,000. Why it is not add back? Section 43B. As per section 43B, it is allowed only when it is paid on or before filing due date of return. Suppose this 10,000 is not paid, not yet paid. Even before due date of return also it is not paid. So therefore it is not allowed. Therefore, tell me, your taxable income is 1 lakh only. Your taxable income 1 lakh, your accounting income 90,000. See, this is very, very interesting now. So your taxable income 1 lakh. Sir, why 1 lakh, sir? 10,000 interest not allowed as per the Income Tax Act. Why? 43B. Suppose next year paid, it is allowed in the next year. That means this is only a timing difference. So what is the difference between accounting income and taxable income? 10,000. That means here your taxable income is greater than accounting income. Why? 10,000 difference. What is the 10,000? Interest. Because as per the Income Tax Act, interest is not allowed this year. But it is allowed in whichever year you paid it. Suppose next year you paid, it is allowed in the next year. That means there is a difference between accounting income and taxable income this year, but this difference is going to reverse in future. Therefore, it's a timing difference. See, this year your taxable income is greater than accounting income. Suppose next year 10,000 is allowed as per the Income Tax Act, then definitely your taxable income is less than accounting income by this 10,000 in the year in which it is allowed. Therefore, this taxable income 1 lakh and accounting income 90,000. So there is a difference of 10,000 and the taxable income is greater than accounting income. See, tell me, taxable income is greater than accounting income. You apply the concept now. Save now, pay later. Are you following this? Or pay now, save later? This is the one you are following. pay now, you are paying tax on that 10,000. Save later, it will be save your tax in future, because in the year of payment it is allowed as deduction. That means this year you need to recognize deferred tax asset. Sir, why asset, sir? Simple. This year you are paying tax on this 10,000. Second year, suppose if you pay this 10,000 will reduce your taxable income because it is allowed as deduction. That means 10,000 to 30%, 3,000 your tax liability will be saved. So therefore there will be economic benefits in the form of tax savings in future. Therefore you recognize deferred tax. So your current year tax liability, how much current year tax liability? 1 lakh into 30%, right? 30,000. See here, 30,000. Now this 30,000 I will show here less current year tax 30,000, but it is not matching. See here, 90,000 into 30%, it will be 27,000 only. It is 27,000 only. It is not matching with this 30,000. So the accounting income and tax expenses are not matching. That means you are taxing 1 lakh, but as per the accounts your income is 90,000. That means you are taxing more than what you have earned. So the 10,000 on which you are levying tax now is going to give you benefits in future, because it's a timing difference which is going to reverse in future. So therefore what you need to do is you need to recognize deferred tax 3,000. Sir, what is this 3,000? Sir, simple, 10,000 into 30%. This 10,000, whatever you are paying tax now, your pay now, save later, is going to give you savings in future. So this year there will be accounting income. Taxable income is more than accounting income. Second year your taxable income is less than accounting income. So whatever the timing difference arises this year, reverses this year. So therefore this timing difference is going to give you what? If it's the deferred tax liability, it is going to give you liability. Therefore I recognized as a liability by following the concept of prudence. So if this deferred tax, this timing difference is going to give me some savings in tax, that means it's a deferred tax asset. So what is the entry? When it is an asset, entry is deferred tax asset account debtor to deferred tax expenses. Deferred tax expenses to P&L. That means the net entry is deferred tax asset account debtor to P&L account. So this is the entry. So therefore this year we will write deferred tax asset account debtor to P&L account. That means it will be 27,000. Now it is matching. 90,000 with 27,000. Matching. So this is deferred tax asset. So the conclusion is very, very simple. Identify the difference. The difference is timing difference. Sir, what is timing difference? You see, for that you should have little bit of income tax knowledge. Which items the difference will be there as far as the P&L account and taxable income is concerned, but it is going to reverse. It's only a timing difference, matter of time. There will be permanent differences which is not going to reverse. For example, as far as the income tax is concerned, any penalties you paid, any income tax interest you paid, these are not allowed as per the income tax act. Therefore, they are not timing differences. I think I have some examples also. I will try to show it. So therefore, identify the timing difference, and because of this timing difference, there may be liability, there may be tax savings. If there is a liability, recognize deferred tax liability. If there is a tax saving, recognize deferred tax asset. That's it. This is the concept. Hope you understood the concept of deferred tax. So this is the background, sir. I explained. So I try to revise it in a brief manner. Now we need to move to the original standard. So now you understand the purpose of this standard. Why this standard came, what they are going to achieve with this standard. You see, the object of this standard is to prescribe accounting treatment for taxes on income. I told you now, the object is to prescribe the accounting for taxes on income. In accordance with the matching concept, taxes on income are accrued in the same period as the revenue and expenses to which they relate. See, in accordance with matching concept, what they're saying, taxes on income, the tax expenses are accrued in the same period as the revenue and expenses to which they relate. See, you are paying tax on the profit. Profit is derived by revenue minus expenses. If revenue and expenses are belongs to 23-24, the tax must also belongs to 23-24. Therefore, always you should match it. Suppose if you are earning 90,000 profit, tax expense should also be 90,000. Suppose if you are earning profit of 70,000, tax expenses should also be 70,000. So your tax expenses should not be more than what you are earning as per the P&L account. Therefore, always the matching concept has to be satisfied. But so why matching concept is not satisfied here? Simple. Taxable income may be significantly different from accounting income, because the accounting income that is you are arriving by preparing P&L account, whatever the net profit you are arriving, and whatever the taxable income you are calculating as per the Income Tax Act for tax determination, both are different, because income tax provisions are entirely different when compared with Companies Act. Obviously there will be differences. Now they are saying because of these differences, so yeah, there is no matching of accounting income and its tax expenses. So now the standard came to, bridge that gap. So this standard basically trying to matching the accounting income with its corresponding tax expenses by introducing the concept of deferred tax. By introducing the concept of deferred tax. And what is the scope of this standard, sir? See, this standard should be applied in accounting for taxes on income. Same point. What we learned in objective, this standard came to deal with the accounting of taxes on income. See, I told you taxes on income means two things: current tax plus deferred tax. What is current tax? This year tax liability, this year provision for tax based on taxable income, whatever we decided, that is. What is deferred tax? Deferred tax is the tax effect on timing differences between accounting income and taxable income. Both together are dealt by accounting standard 22. Okay. Now, for this purpose of this standard, taxes on income includes all domestic as well as foreign taxes are also covered. So this is the objective and then scope. See some key terms. First, accounting income. I told you what is accounting income. Accounting income is the net profit or loss before tax, as far as the P&L account is concerned. From P&L account, this net profit will be arrived. That is accounting income in the language of AS 22. Taxable income. Income as computed under tax laws. So on which tax has to be paid? Tax expenses, current tax plus deferred tax. Tax expenses, standard says both current plus deferred. What is current tax? This year tax liability you determine based on tax provisions. Current tax is the amount of tax payable on the taxable income for the period. What is deferred tax? This is important. Deferred tax is the tax effect of which difference? Only timing differences. Timing differences. So timing differences. When DTL will come, tell me, deferred tax liability will come when your taxable income is less than accounting income. I told you, na, save now. When we say you are saving now, your taxable income is less. When you are paying, when your taxable income is less than accounting income, obviously you are saving some tax. Pay later. So definitely you should pay later. So then we call it as deferred tax liability. Pay now. Suppose when you are paying more, when your taxable income is more than accounting income, save later. Definitely, to the extent you suffered now, you paid now, there will be savings. That is deferred tax asset. So these are all simple important words. And timing difference, very very important. Timing differences are the differences between taxable income and accounting income. Taxable income you arrived as per the Income Tax Act provisions. Accounting income you arrived as per the P&L account, net profit or loss. Accounting income is nothing but net profit or loss. That most important, the difference between taxable and accounting income that originate in one period, they will arise in one period, capable of reversal in one or more subsequent periods. They will arise and they will reverse. For example, depreciation is the classic example. There is a difference between accounting income and taxable income because of depreciation. Because in the Income Tax Act, entire depreciation may be allowed in the first year itself. But in P&L account, generally we follow straight line method. Overall, you see depreciation is same. So in our example also, that 30,000 asset allowed in the first year itself in the Income Tax Act while calculating taxable income. But as far as the P&L account is concerned, it is allowed over a period of 3 years. So overall, the allowed is 30,000 only. But there in P&L account, it is allowed for 3 years. But in income tax, we allowed it for 1 year. So therefore, there is a timing difference. So the difference arises in the first year, 20,000, and it is reverses in the next 2 years. That is called timing difference. Similarly, preliminary expenses. You see, any preliminary expenses we incurred, definitely we debited to P&L account. But as far as the income tax is concerned, preliminary expenses will be allowed over a period of 5 years. You know, I think section 35D. Like that, there are so many examples I have given also. See, we'll see it. Permanent differences means, permanent differences are the differences between taxable income and accounting income that originate in one period, do not reverse. They will not reverse in the subsequent periods. Example, depreciation, timing difference. Section 40A3 payment. You know, in income tax, section 40A3 payments, any cash payment in excess of 10,000. Is it allowed, sir? No. That means this is a permanent difference. See, in accounts, when you are preparing P&L account, whatever be the expenses, whether it is paid in cash or everything, we will debit to P&L account if it is an expense. But in income tax, if you pay anything in excess of 10,000, it is not allowed. So therefore, there is a difference between accounting income and taxable income. In income tax, about 10,000 is not allowed, but in P&L it is allowed. So there is a difference. But is this difference is going to reverse? No. So it's a permanent difference. So no need to recognize any deferred tax. No deferred tax. If it is a permanent difference, ignore. Any share issue, preliminary expenses under section 35D. So as far as the section 35D is concerned, preliminary expenses are allowed over a period of 5 years as per the income tax is concerned. But in P&L, it is allowed in the first year itself. However, overall amount allowed is same. But in P&L, it is allowed in the first year. But in income tax, it is allowed in the 5 years. So this is a timing difference. Goodwill written off, permanent difference. Because it is not allowed as per the income tax is concerned. Provision for doubtful debts, provision for warranty, provision for reference, repairs, provision for gratuity. So these are all what? These are all timing differences. When you create provision immediately, it is allowed in P&L account. In P&L account, see, provision means allowed, but in Income Tax Act, no, not allowed. When you create a provision, it is not allowed as per the Income Tax Act. I think we have ICDS also. So always remember, in income tax, provision is not allowed, but provision is allowed only when it is actual, when it is turned into actual loss, it is allowed. So therefore, definitely it's a timing difference. So timing difference we can create. Donation to private trust, contribution to unapproved gratuity fund by employer. Tell me. Donation to private trust, permanent difference, because in income tax it is not allowed. No way it is going to be allowed. Section 43B payments, definitely. See, section 43B payments, timing differences. If you pay on or before due date of filing of return of income, there is no difference, because anyway, suppose interest expenses you debit to P&L account on accrual basis. But in income tax, it is allowed only if you pay on or before due date of filing of return of income. Suppose if you pay on or before due date of return of income, then as far as the accounts and as far as the taxable income, both are same only. There is no difference. Suppose if you are paying after due date of filing of return of income, in income tax it is not allowed. But if it's P&L account, we don't see that. Whether you paid or not, on accrual basis, we allow it. So this is timing difference. Unabsorbed depreciation and carry forward of losses, very, very important. Sir, in income tax, we have unabsorbed depreciation and carry forward of losses. Any depreciation which is not absorbed can be carried forward for unlimited period of time. That means in income tax, if any depreciation is not absorbed in the current year, we will carry forward it to the future years, right? In future years, whenever there is a taxable income, we will adjust it. That means this unabsorbed depreciation has the capability to reduce my taxable income in future. Therefore, it is going to give me some savings in tax because it is reducing my taxable income. Therefore, I need to recognize deferred tax asset whenever there is a unabsorbed depreciation. Once again, I am telling, sir, unabsorbed depreciation and carry forward of losses. In income tax, we have the luxury to carry forward unabsorbed depreciation any number of years. So therefore, when you carry forward unabsorbed depreciation, you know that in future this unabsorbed depreciation is going to reduce my taxable income. Therefore, it is going to give me some savings in tax. Therefore, I need to recognize deferred tax asset. Similarly, whenever there is a carry forward of losses also, I need to recognize deferred tax. Okay. So these are the some examples of timing differences and permanent differences. So okay. Now recognition. Sir, this standard says very simple, sir. Whenever every company, when they are determining their current year profits, they need to take into account the tax expenses. That means current tax plus deferred tax. That's the basic idea. See, whenever a company is calculating, see, tax on income is to be considered as an expense for the period. Tax expenses means current tax plus deferred tax. It should be included in the determination of net profit or loss for the period. So when you are calculating net profit or loss for the period, definitely you need to consider this tax expenses. That means current tax, deferred tax. That's why you see in schedule 3, if you want, you can remember in schedule 3 P&L accounts, sir, tax expenses, A, current tax, B, deferred tax because of AS 22. I told you So whenever I discussed the schedule 3, so there I told tax expenses, A, current tax, B, deferred tax. This will reference with AS 22, because AS 22 says whenever you are determining current year income, current year profit, so definitely tax expenses should be included as a part of current year net profit or loss. And this tax expense is nothing but current tax plus deferred tax. Okay. And whenever there is a deferred tax you anticipated, either it could be an asset or it could be a liabilities, they will come in balance sheet. But see, one important thing, Nana, if it is a deferred tax asset, remember, see, I will tell you, if it is a deferred tax liability, no problem, because as far as the prudence concerned, we should anticipate all liabilities. But if it is a deferred tax asset, when deferred tax asset will come? When I say my taxable income is more than accounting income, that means pay now, save later. When I'm paying now and there will be savings in future, that we call it as deferred tax asset, right? Now the standard says whenever you want to recognize any deferred tax asset, there should be reasonable certainty. Why there should be reasonable certainty? Suppose you are saying 100 rupees is my asset. Now, can you recognize it in the books? What is the recognition criteria to recognize an asset? Framework chapter says asset will be recognized. Two conditions must be satisfied. First of all, there will be probable future economic benefits, and the second of all, the cost is measured reliably. Now tell me, is this probable? Is it probable that definitely there will be tax savings in future? You are saying this is your asset, deferred tax asset. Deferred tax asset means savings in tax expenses, savings in future. Definitely there will be savings in future. Huh? In order to get savings in future, there should be taxable income first. So how much guaranteely you are saying that there will be reasonable certainty that sufficient future taxable income will be available against which this deferred tax asset can be realized? You are saying deferred tax asset, right? What is the meaning of deferred tax asset? Meaning is in future there will be savings, tax savings. When there will be savings? Only when you earn sufficiently in future, this timing difference is going to reverse. That means there should be a taxable income in future. Na? Suppose if there is no taxable income, suppose if you are a loss making company, how can I say that, sir, this in future there won't be any profits for me, so my taxable income is nil, so there won't be any tax liability. Suppose if there is no tax liability in future, how can you save tax? Who can save tax? Only the person who have tax liability. Suppose in future if you don't have tax liability at all, there won't be any deferred tax asset. That's why whenever you want to create deferred tax asset, whenever a taxable income is more than accounting income, you should make sure that in future also you have sufficient taxable income against which this deferred tax asset will be realized. Reasonable certainty and virtual certainty. Sir, what is this virtual certainty? See, virtual certainty will apply in case of deferred tax asset you create because of two reasons. One is that is unabsorbed depreciation and carry forward of losses. See, whenever there is an unabsorbed depreciation and carry forward of losses, standard says very dangerous situation, because you have unabsorbed depreciation. That means you don't have the profits at least to absorb your depreciation. And this unabsorbed depreciation and carry forward losses is going to give you savings in future. Definitely, because they can be carry forward and they can be adjusted against taxable income. But first of all, in order to carry forward and adjust against taxable income, there should be taxable income in future. On what basis you are saying there should be taxable income to you? Because already you are a loss-making company. Unabsorbed depreciation indicates that you don't have sufficient profits. But you are saying this unabsorbed depreciation I will carry forward it, sir. I will adjust against my taxable income, sir. First of all, there should be taxable income now. On what basis you are saying that I will recognize deferred tax asset because I have a deferred tax, I have unabsorbed depreciation and carry forward of losses? They say there should be virtual certainty. Sir, you said reasonable certainty. Reasonable certainty is for reasons other than unabsorbed depreciation and carry forward of losses. If you are recognizing deferred tax asset for reasons other than those two, unabsorbed depreciation and carry forward of losses, then there should be reasonable certainty. What is for reasonable certainty? That there will be sufficient taxable income in the future. But if you are creating deferred tax asset for unabsorbed depreciation and carry forward of losses, there should be virtual certainty. What is the difference between reasonable certainty and virtual certainty? The reasonable certainty means based on past experience, based on the past information, I can predict that in future definitely we will have some taxable income, and against this taxable income this deferred tax asset will be realized. But virtual certainty means there should not be any past trending, past thing. prediction. No, you should have pakka 100% concrete evidence to say that there will be taxable income in the future, and against this income, this deferred tax asset will be realized. So see here, the reasonable level of certainty could be normally achieved by examining the past records of the enterprise and by making realistic estimates of the profits of the future. Based on past, if you can able to predict that there will be incomes in future, profits in future, we say there is a reasonable certainty. But virtual certainty is not merely based on forecast of performance. So virtual certainty is not a matter of perception. What you are perceived is not the matter, and it is to be supported by convincing evidence. For example, a profit binding export order, cancellation of which will result in payment of heavy damages by the defaulting party. Suppose there is a contract, export order in our hand. That means definitely this export order, I can say that it's an evidence for me that there will be sufficient taxable income in future. So therefore I can recognize deferred tax asset. So what you are telling? Simple. I'm telling one simple funda. When you are recognizing deferred tax liability, no problem. Aram se follow prudence. You are following prudence, you recognize it. But when you are recognizing deferred tax asset, standard says wait. You see, you are saying asset na. What is this asset? Asset means savings in tax. Savings in tax. When there will be savings in tax, in future there will be first of all taxable income. First of all there will be income. Then you can say there will be savings. First of, suppose if you don't have taxable income in future, how can there will be savings in tax? Or who can pay income tax? The person who earned, right? Suppose you are thinking that, sir, you are worrying about payment of tax to the government, sir. Next year tax rates are increasing so much. I am worried, sir. Why you are worried here? Because you are not earning anything, na? You are a student. You are not earned anything. When you are not earning anything, what is the reason for you to bother about the tax? Similarly, they are saying deferred tax asset. Hey, you want deferred tax asset, you want to recognize that? What is this deferred tax asset? Sir, this year my taxable income is greater than accounting income, sir. I paid more tax, sir. But this difference is only timing difference, sir. In future, it is going to reverse, sir. So therefore, whatever excess I paid now, sir, I will save it in the future, sir. Okay. First of all, in order to save, there will be tax liability. There will be taxable income in future. That you have to see. That's why they say when you are creating deferred tax asset, two possibilities. Why you are creating deferred tax asset? If you are creating deferred tax asset because of unabsorbed depreciation and carry forward of losses, in these two situations definitely deferred tax asset will create, because see, these losses will be carried forward and set off against taxable income in future. For that you should have a taxable income in future. That's why they say reasonable certainty sufficient. Yeah, if you believe based on past, definitely we are going to achieve some profits. Okay, go ahead, go and recognize deferred tax asset. But if it is other reasons, if you want to create deferred tax asset, and other reasons means this is wrong thing. Unabsorbed depreciation and carry forward of losses, not reasonable certainty, virtual certainty. Other reasons, reasonable certainty. Reasonable certainty means go past and check, and based on that you forecast your future. Okay, but virtual certainty means pakka evidence you should have. Suppose example, on your hand you should have a export order. Example I'm saying. That's it. Now come to the special cases. Sir, this standard I'm teaching only keeping examination in my mind. So generally AS22, sir, regular classroom, it will take approximately 10 hours. So, but since you are all in your preparation and I want to help you genuinely for your examination purpose, so that's why I'm quickly brushing up all the concepts, and to what extent it is necessary now, only to that extent I'm touching the points. So I think definitely this video helps you to understand this deferred tax concept pretty quickly, and it will cover you everything what is necessary for examinations. Now come to the special cases. There are two special cases here. One is tax holiday concept. Sir, what is this tax holiday? See, in income tax, we have some provisions. For example, 10A, 10B, 80IA. Suppose, for example, government has given a tax holiday for 10 years. See, for example, if you are a company who is engaged in manufacturing of software, or you are an exporter of software, I think you will be given 10 years exemption. Like that you assume 10 years exemption is given. That means 10 years you are not required to pay any tax. That is called tax holiday. Now they say, suppose for example, see here, tax holiday concept I will tell. Suppose you are one entity, sir. For 10 years, first year, second, third, fourth, fifth, sixth, ninth. Like this, there are 10 years. Now, this 10 years, you are not required to pay anything. Tax holiday concept. You are not required to pay anything. 10 years, no tax liability, no tax. That is tax holiday. Okay, sir. Now, age 22 says, any timing difference which originates and reverses within the tax holiday period, ignore. Sir, first of all, first year timing difference 100, second year 200. Suppose first year timing difference. Suppose depreciation timing difference 500. Second year onwards reverses 50, 50, 50, 50. Like that it reverses. Okay. Now the standard says, okay, timing difference originates and reverses. How much reversed? 450. How much originates? 500. Any timing difference which originates and reverses within the tax holiday period, ignore. Why, pa? Because see, whenever you, till now what we discussed, any timing difference, you recognize deferred tax and you reverse it in the future. But here, for first 10 years, no liability at all. Then why we need to anticipate either a liability or an asset? There is no deferred tax asset, there is no liability, because first 10 years, no need to pay anything. Your liability itself is zero. Then why you bothered, yeah? So they say any timing difference which originates and reverses. Suppose 500 originates, 450 reversed, ignore. And timing difference which originates and reverses after tax holiday period. See, after tax holiday period, you need to pay tax. So for that timing difference, you anticipate deferred tax asset or liability. That means out of this 500, 450 reverses within the tax holiday period, ignore. How much is the difference? 50, balance. This 50 is going to reverse after tax holiday period. See, there is a difference between depreciation, accounting depreciation, income tax depreciation, 500. Now this is a timing difference. Timing difference means what? Difference originates and it is going to cancel in the future years. So it's a timing difference, right? Now this timing difference which originates and cancels, which originates and reverses, ignore, because there is no tax liability. But the timing difference which originates and which will reverses after tax holiday period, you create deferred tax. If it is an asset, asset, liability, liability. If it is, you are saving now, pay later, deferred tax liability. You paid now, save later, deferred tax asset. So this is how the concept of tax holiday you need to follow. Pretty simple concept. So no need to worry at all. Remember these 2 points. See, deferred tax is not to be created for those timing differences which originate in tax holiday period and which will reverse within the tax holiday period. Originates, reverses within the tax holiday period, ignore. What is the difference which is reversing after tax holiday period? Deferred tax is created only for those timing differences which originate in tax holiday period and which will reverse after tax holiday period. So only 2 points I think you remember now. And here you follow one method here, FIFO method you follow. What is FIFO, sir? Timing difference which originates first will be reversed first. Whatever the timing difference which originates first, suppose there may be multiple reasons the timing differences will arise. Whatever the timing difference which originates first is assumed to be reversed first. Timing difference which originates first is assumed to be reversed first. So tell me tax holiday concept. As far as the income tax act is concerned, for some period there will be no tax liability. Okay. So when there is no tax liability, no need to recognize deferred tax asset or liability. That's why any timing difference which originates and reverses, arises and cancels within the tax holiday period, ignore. Any timing differences which originates and reverses after tax holiday period, for that you anticipate deferred tax asset or liability. If it's an asset, asset, liability, liability. And remember, deferred tax always difference which arises first will reverses first. Okay, that is the assumption. Timing difference which originates first are considered to be reversed first. For example, in a see here, there will be timing difference of 500. Out of this, because of depreciation 300, because of other reasons 200. See, because of accounting income and taxable income, because of depreciation 300 timing difference, because of other reasons 200. Now see, within the period 450 reversed now. Out of this 450, first we need to reverse this because FIFO, first in first out, like that first timing difference 300, we assume this is reversed first. Suppose for example, in this 9 years only 250 reversed, so 300 minus 250, that means only 50 balance, and this is 200 balance. On this 50 and 200 we need to create deferred tax because they are going to reverse after tax holiday period. Okay. Next, there is one more concept called MAT concept, minimum alternate tax or alternate minimum tax. This is very simple. I will tell you. See, in Income Tax Act, we have some provisions called minimum alternate tax for the companies and alternate minimum tax for other than companies. For example, an individual, partnership firms. So AOP, BOI, AMT, alternate minimum tax. Sir, what is this alternate minimum tax? See, in income tax, we calculate as per the regular provisions. We will determine the total income as per the normal provisions of the Income Tax Act, and you determine the tax liability. Along with that, you need to check alternate minimum tax. So there is a separate section for alternate minimum tax and minimum alternate tax. There you need to arrive book profit. On that book profit, you need to apply one fixed rate. I think 15%, 18.5%, like that. Some rates are there. So you calculate tax liability as per the normal provisions, and you calculate tax liability as per the MAT or AMT. Whichever is higher, you need to pay to the government. Suppose as per the normal provisions, your tax liability is 10 lakhs. As per the MAT or AMT, it is 12 lakhs. How much you pay? 12 lakhs to the government. So this concept of MAT or AMT is there in Income Tax Act. So government wants to collect minimum tax. So that's why they introduced this concept of minimum alternate tax. There will be a prescribed format. According to that format, first you need to take the net profit. Further, some items will be added, some items will be less. Then you will get book profit. On that book profit, you need to apply tax rate. You will get tax liability. That tax liability you compare with normal provisions. When you calculate tax liability under the normal provisions, whichever is higher, you need to pay. Now the important point, sir. Why this is connected with AS22, sir? Simple. Whichever is higher you are paying now. Suppose in a particular year, your tax liability as per the MAT or AMT provisions is more. That means MAT and AMT rate is different. But for calculation of deferred tax, will you follow MAT rate, AMT rate, or will you follow the normal tax rates? See, you understanding what I am saying? See, suppose for example, MAT, minimum alternate tax, 15% of book profit. AMT, alternate minimum tax, 18.5% of book profit. These are examples like I'm saying, sir. I have not remembered exactly. Maybe 15% of book profit, 18.5 correct only. And as for the normal provisions, in case of a company, you know 25% or 30% tax rate. Right? So these are the tax rates. Now see, you calculate here book profit. On this book profit, you apply these rates. Here you calculate taxable income. On that you apply 25%, 30%, and you get the tax liability, right? This is as per the normal provisions. This is as per the AMT or MAT. Now suppose in a particular year, as per the MAT, the tax liability is 12 lakhs. But as per the normal provisions, tax liability is 10 lakhs. Which one you need to pay? 12 lakhs. Now, when in a particular year, if you are paying tax as per the MAT, if the MAT came, will you calculate deferred tax by following MAT rates or normal rates? Always normal rate. Even though in a particular year, the income tax is required to be paid as per the MAT, you need to calculate deferred tax only by following normal rates. First thing. Second thing, suppose you are recognizing a deferred tax asset or liability, but in future it is going to reverse now. It's a timing difference. That's why you recognize deferred tax asset or liability. Now whatever is going to reverse in future, in that year, in future, suppose you are expecting that in that year your company is required to pay or your business is required to pay as per the MAT provisions. Then in such a situation, in that year, in the reversal year, can I follow MAT rates? No. Always regular tax rates. Okay. So deferred tax assets and liabilities should be measured using regular tax rates, not tax rate under section 115JB. That means MAT rate. So always deferred tax is always calculated on normal. And presentation and disclosure, sir. this is one small concept. Can you, I mean, set off both assets and liabilities relating to taxes? For example, advance tax, provision for tax. Can you, I mean, set off? See, and there are deferred tax asset and liability. Can you set off deferred tax asset and liability? First, I will tell this. See, deferred tax assets and liabilities can be set off both. See, suppose there is a deferred tax asset of 10 lakhs. There is a deferred tax liability of 5 lakhs. Can I say my deferred tax asset net is 5 lakhs? Can I say this? The income, I mean, AS22 says they can be set off if enterprises has legally enforceable right to set off assets against liability and deferred tax assets and liability relating to tax on income levied by same governing tax laws. This is very, very important MCQ possible. See, they should arise from same law. For example, there is a loss of subsidiary. Our subsidiary is there in US. Now that loss you should not set off against. Suppose, for example, there is a deferred tax asset from foreign subsidiary. Now the deferred tax asset arises because of the income tax act of the foreign country. Now you should not set off with the deferred tax liability, deferred tax asset of the Indian, which a deferred tax liability which arises as per the Indian provisions. So same governing laws, and there should be legal enforceable right. That means the company should be the legal owner, legal right to owner for this asset as well as liability. So two conditions you remember. In order to set off deferred tax asset and liability, they should legally enforceable. The entity should have the legal enforceable right to set off, and this deferred tax asset and liability should arises from same governing laws. Same points is applicable for to adjust the assets and liabilities representing tax, that is advance tax and provision for tax. Advance payment of tax for a fiscal year should be set off against provision for current tax. So can provision and advance tax and provision for tax can be set off? Yes. There should be a legal enforceable right. Sir, what is this legal enforceable right? See, you should be the owner. Suppose, for example, asset belongs to you, another company came to you. No, it should not be like that. Asset and liability both are belongs to your entity only. Then you have the legal enforceable right to set off. Another one company's liability, your asset, we cannot set off. Suppose, sir, I acquired that company, sir. No, we are not allowing you to set off. And intend to settle the asset and liability on net basis. Definitely, we pay advance tax and we create provision for tax. After setting off this advance tax, we pay the amount, right? So this is AS22 Nana. So I think 1.5 hours it has took me to revise this standard. So this is only for examination purpose I explained. Okay. So to the best of my abilities I discussed. So if you don't understand any point, so please ask me in the comment section your queries. Thank you so much. We'll meet in the next class, next video. Rama Limited has provided the following info. Depreciation as per accounting records 2 lakhs. Depreciation as per income tax records 5 lakhs. Unamortized preliminary expenses as per tax records 30. So 3 items they have given: depreciation as per accounts, depreciation as per income tax. One by one I am going to discuss. First I am talking about depreciation. Everybody please concentrate. What they are asking, see, how much deferred tax asset liability should be recognized in the transition adjustment, tax rate 50%. Okay, they are asking how much is the deferred tax asset or liability. First you think, you see the depreciation as per accounts, how much depreciation? 2 lakhs. As per income tax 5 lakhs. So you tell me what is the difference here? 3 lakhs. Now is this difference a timing difference or permanent difference? You tell me. What is timing difference? 3 lakhs arises now, it is going to reverse in future. That is timing difference. Is it going to reverse in future? Yes. Why? Because see, either you follow accounts or income tax, the total depreciation is same. But the difference is only the methods. That's why every year depreciation amount will change. But overall, if you add the total depreciation, it will be cost of the asset. Either you follow SLM method or WDU method. Either you follow Companies Act or tax method, tax laws. Whatever be the cost of the asset only depreciated. Na? Most of the, suppose if the cost of the asset is 100 lakhs, will you provide depreciation 1000 lakhs? Or will you provide depreciation 50 lakhs? No. Total cost of the asset will be depreciated. That means the overall depreciation under any method, same. Either it is income tax or accounts, both are same. But the difference now arises is only a timing difference, which is going to reverse in future. Because overall the depreciation is same. So therefore, see, this 3 lakhs difference is which difference? Identify first. Timing difference. So on timing difference, what we need to recognize? Deferred tax we need to recognize. What is deferred tax? Tax effect of timing difference. Tax effect of timing difference. What is timing difference here? 3 lakhs. Now, see. Sir, you said we need to recognize deferred tax. Okay. Asset liability, simple. See, how much your depreciation you are taking in income tax? 5 lakhs. How much depreciation you are claiming in accounts? 2 lakhs. You tell me, in income tax you are taking higher depreciation, accounts you are taking higher depreciation, income tax. That means today you are enjoying, save now, pay later. You are taking 5 lakhs depreciation. Whereas in accounts it is only 2 lakhs. That means 3 lakhs excess depreciation you are taking. Because of that your taxable income is reduced by 3 lakhs. Therefore you pay less tax. And you know this 3 lakhs, whatever you have taken excess this year is going to reverse in coming years. That means in coming years your taxable income is more than accounting income by 3 lakhs. Therefore this 3 lakhs is going to give you tax liability in future. Therefore you book deferred tax liability. So 3 lakhs into, what is the liability here? 50%. Therefore 1,50,000 is the deferred tax liability. Deferred tax liability. Once again I am saying, sir. Simple. As per accounts, 2 lakhs. As per income tax, 5 lakhs. What is the difference? 3. First in exams, see the difference. 3. Now, identify whether it is timing difference or permanent difference. Timing difference. Depreciation is always a timing difference. Okay, timing difference. So we need to recognize DTL or DTA, deferred tax to be recognized. Yes. Now come to the thing that whether it is DTL or DTA, asset liability, deferred tax asset liability. Simple logic. Today you are bearing the burden or you are saving some tax. See that. Today you are saving some tax. How? You are claiming excess depreciation when compared with accounts. 3 lakhs. This 3 lakhs you are saying you are taking in income tax. See, this is as per income tax. That means when you take in income tax 5 lakhs depreciation, but as per accounts it is only 2 lakhs. 3 lakhs excess depreciation you are taking now. That means this 3 lakhs today you are taking the tax benefit. Save now to the extent of 3 lakhs. 3 lakhs into 50%. 1,50,000 tax today you saved. But in future you need to pay. How, sir? Because in future it is going to reverse. That's what the timing difference means. Because overall depreciation is same. The difference is only in years. Depreciation amount is only in years in accounts and income tax. In income tax maybe depreciation in the initial years is high. But in accounts every year depreciation may be constantly same. So when you see overall depreciation it will be same. Hello. Important sir. Please think it, sir. So this 3 lakhs, whatever the difference is there, this is originated in this year. And I know that total depreciation overall it is same. For example, sir, I am going little bit deep. Suppose for example, here, let us imagine like this. The total depreciation is 5 lakhs. Either as per income tax or accounts. 5 lakhs only. But the difference is, see here. In income tax, suppose the first year is itself total 5 lakhs is allowed. In our problem, first year itself total depreciation allowed. Now in accounts, suppose first year 2 lakhs, second year 2 lakhs, third year 1 lakh. Now you see this is how it happens. This is called timing difference. Why? That's why. See, because overall depreciation you see same. Either you follow accounts or income tax. But you see year wise there is a difference. Year wise you see there is a difference. See, first year your accounting depreciation is only 2 lakhs, but your income tax depreciation 5 lakhs. That means you 3 lakhs difference, right? 3 lakhs. That means first year your taxable income is less than accounting income by 3 lakhs. Now it is going to give you what? Deferred tax liability. Why liability? Because save now. You are taking excess depreciation. Your taxable income is less than accounting income. Detail. Now next year you see. Next year your accounting income, your accounting depreciation 2 lakhs, but your taxable depreciation 0. That means your taxable income is more than accounting income. So whatever the depreciation first year timing difference, it is reversed by 2 lakhs. Third year 1 lakh. Nil. See, this is called timing difference. First year 3 lakhs. Out of this 3 lakhs, second year 2 lakhs reversed. Third year 1 lakh reversed. So total nil. Net effect is nil. That means the difference is only in years. That's why it is called timing. First year difference 3 lakhs here. Your taxable income is greater than accounting income. Less than accounting income. Second year you see, your taxable income is greater than accounting income. How? How you are saying? Because taxable income 0 depreciation, accounting income 2 lakhs depreciation. Obviously your taxable income is more than accounting income by 2 lakhs. So first year 3 lakhs, 2 lakhs reversed. Next year another 1 lakh is reversed. So therefore what they are saying is this DTL you need to recognize because it is going to give you some tax liability in future. So in this case you simply remember what is the timing difference? 3 lakhs. Now think like me. So whether I am taking excess depreciation in income tax? Yes. That means there will be tax liability. Save now, pay later. So liability. Now come to the second adjustment. So first one is over, DTL. Unamortized preliminary expenses as per tax records. See, as per income tax records, unamortized preliminary expenses. See, preliminary expenses as per income tax will be allowed over a period of 5 years. But in income tax, in accounts, we allow totally every year. Okay. Now see, that means this is also timing difference. Overall, suppose for example, 1,50,000 is the preliminary expenses, sir. This will be allowed over a period of 5 years in income tax. That means 30,000 every year. But same 1,50,000 is allowed in the income tax accounts. Directly we will debit. That means first year itself 1,50,000 allowed in accounts. But in income tax, first year 30, second year 30, third year 30, fourth year 30, fifth year 30. That means first year you see the difference 1,20,000. Second year 30,000 reversed. Third year 30,000 reversed. Fourth year 30,000 reversed. Fifth year 30,000 reverse. This is called timing difference. So whatever the difference originates in the first year, it is going to reverse in the coming years. So therefore, this 30,000, simple, think like this, unamortized preliminary expenses as per tax records. That means this 30,000 is going to allow in future as per tax. That means it is going to save some tax. So DTA 15,000, that's it. Because unamortized preliminary expenses, when it is allowed next year. So it is going to give me what? Deferred tax asset, savings of my tax. Because see here, these unamortized preliminary expenses will be allowed in future as per income tax. Therefore, my taxable income is less. This year not allowed, but it is allowed in the coming years. So when it is allowed in the coming years, it is going to reduce my taxable income. So it is going to give me some tax savings. So that's why 15,000 is my DTA. This is DTL 1,50,000. DTA 15,000. So therefore net DTL. Sir, can I net off? Yes. DTL 1,50,000, DTA 15,000. So net DTL 1,35,000. This is the answer. Okay. Next. Now see question number 5 also, sir. This is also very good sum. Will make you understand the concept. Omega Limited is working on different projects which are likely to be completed within 3 years period. It recognizes revenue from these contract on percentage of completion method for financial statements. That means in accounts. During 2021, 21-22, 22-23 for 11 lakhs, 16 lakhs, 21 lakhs respectively. However, for income tax purpose, it has adopted the complete contracted method. See, in accounts we followed project percentage of completion method, but in income tax we followed completed contract method, under which it recognized the revenue of 7 lakhs, 18 lakhs, 23 lakhs for the year 2021, 21, 22, 22, 23 respectively. Income tax rate is how much? 35%. Compute the amount of deferred tax asset and liability for the year 2021, 21, 22, 22, 23. Say I will solve this sum. Very good sum actually. Problem number 5. First of all, as per accounts, so first year, as per accounts, as per income tax, and the difference. Now see the first year 2010 11, 2011 12, 2012 13. These are the 3 years, right? Now you tell me, as per accounts, which we are following percentage of completion method, what will be our revenue? First year 11 lakhs. Second year we recognize how much? 16 lakhs. Third year we recognize 21 lakhs. So what will be the total? So 11 lakhs, 16 lakhs, 21 lakhs. So it will be total of 48 lakhs. So as per accounts, we are our total revenue is 48 lakhs, sir. Now see the income tax act, sir. Actually in income tax act we are following which method? In income tax we are following percentage of completion method. Percentage of completion method in accounts. But income tax we following completed contract method. So what is the revenue? First year 7 lakhs. Second year 18 lakhs. Third year 23 lakhs. And I will make a total. Sir. So 7 plus 18 plus 23. So it will be 48 lakhs. You see? See, that means overall revenue is same. Whether you are following as per accounts or as per income tax, overall revenue is same. 48, 48. The difference is only the timing difference. The difference is only the timing. See the first year, for example, 10, 11. As per accounts, 11 lakhs. As per income tax, 7 lakhs. That means what is the difference here? 4 lakhs. Second year you see, as per account 16 lakhs, as per income tax 18 lakhs. That means 2 lakhs is the difference, reversal of 2 lakhs. Third year you see 21 lakhs, 23 lakhs. Another 2 lakhs will be reversed. That means it will be nil. So as per accounts, as per income tax, the difference. As per accounts 11 lakhs, first year 7 lakhs. That means as per income tax, your taxable income is less than accounting income. First year there is a difference of 4 lakhs. Now next coming years this difference has been reversed by 2 lakhs and 2 lakhs. 2 lakhs and 2 lakhs. Now see, on this whether deferred tax asset will come or deferred tax liability will come, we need to recognize. Now the first one is, for example, see here, what is the difference? 4 lakhs. Now as per and see, this is the classic example of the concept of deferred tax. Because see, overall revenue is same. The difference is only in years. The difference is only in years. So first year you see the difference of how much? 4 lakhs. The first year the difference is only 4 lakhs. Now in income tax you are saying that your revenue is 7. But as per accounts your revenue is 11 lakhs. Right? So there will be difference of how much? 4 lakhs. That means is it going to give you deferred tax liability, etc.? Liability. Because you are saying your taxable income is less than accounting income. That means save now, pay later. You are saving now. So there will be payment later. So therefore on this 4 lakhs, there will be asset. How much? 35%. So 4 lakhs into 35%. So it will be 1,40,000. Now out of this how much is reversed? Second year 2 lakhs, third year 2 lakhs. So first year your income tax income revenue is 7 lakhs, but as per accounts it is 11 lakhs. That means your taxable income is less than accounting income. That means you are paying less tax. So save now, pay later. So you are denying the obligation. But anyway, you know this difference is going to reverse. So the tax effect is now you are going to face some liability in future. So that's why I recognize DTL. See, this is DTL. I am recognizing deferred tax liability. Now next year, how much of timing difference is reversed? See, first year what happened? Your taxable income is less than accounting income by 4 lakhs. Next year you see your taxable income is less than accounting income. Your taxable income is more than accounting income. See, next year. That means how much reversed? 2 lakhs. So you also reverse 2 lakhs into timing difference of 35%. How much reversed, sir? 70,000 reversed. And next year another 2 lakhs. Reversal 70,000. So second year and third year 70,000 there is a reversal of deferred tax liability. So here we have recognized what? DTL, not DTA. Why DTL? Because your taxable income is less than accounting income. That means you are paying less tax in the first year. So save now. In the first year itself you saved some tax. Save now, pay later. See, this savings of 4 lakhs, this 4 lakhs you are claiming less. Definitely it is going to reverse in the coming years. Therefore this 4 lakhs is give you liability in future. That's why 4 lakhs into 35, 1 lakh 40 deferred tax liability. And next year when reverse, you reverse the deferred tax liability. So what is the first year first entry? I mean the entry for the first year. Simple, deferred tax asset account, deferred tax account debtor to deferred tax liability. And this deferred tax will be transferred to P&L account. And how much appear in the deferred tax liability balance sheet? 1 lakh 40. Second year 70,000 reversed. 70,000 will be appearing in the balance sheet. Third year 0, because third year 70,000 reversed. So therefore see, in balance sheet if you see 10 11, for example 31st March 2011, what is your DTL balance? 1 lakh 40. Next year 31st March 2012, what is your DTL balance? 1 lakh 40 minus 70, so only 70,000 will be appearing. Next year 31st March 2013, it will be 0 because 70,000 totally reversed. So this is the classic example. See, the overall impact revenue is same. Either you follow as per accounts or as per income tax. But the difference is only years. That's why we anticipated and we recognized deferred tax. First year our taxable income is less than accounting income by 4 lakhs. Now second year our taxable income is more than accounting income by 2 lakhs. That means out of these 4 lakhs, 2 lakhs reversed. So first year you need to recognize deferred tax liability. Second year you need to reverse it to the extent of 70. Third year remaining, you need to reverse it. So this is one more question relating to deferred tax question. Y Limited is a tax-free enterprise, tax holiday, for first 10 years of its existence. See, tax-free enterprise means no tax for the first 10 years. And is in the second year of its operations. Now in the second year. Depreciation timing difference resulting in deferred tax liability in year 1 and year 2 is 200 lakhs and 400 lakhs respectively. So first year timing difference 200 lakhs. Second year timing difference 400 lakhs. From third year it is expected that the timing difference would reverse each year by 10 lakhs. Assuming tax rate 40%, find out the deferred tax liability at the end of second year and any charge to P&L. So very simple concept, sir. Tell me how many years actually? 10 years, right? So first, second, third, okay. So year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Like this 10 years, sir. You tell me, sir. They are saying that depreciation timing difference resulting in tax liability in year 1 and year 2 is 200 lakhs, 400 lakhs respectively. So what is the timing difference? Depreciation timing difference. First year 200 lakhs. depreciation timing difference, first year 200 lakhs, second year 400 lakhs. And from third year onwards, it is expected that the timing difference could reverse each year by 10 lakhs. See, from third year onwards, how much is going to reverse? 10. Now you are at the end of the second year. You see, now, first year 200, second year 400. From third year onwards, there is a reversal. That means, from third year to 10th year, 8 years. 8 years. So how much reversed? 80 lakhs. Correct? 80 lakhs reversed. So standard says, see, now you are at the end of the second year. The standard says, whatever the timing difference year originates in the first year. How much is the timing difference originates first year? 200 lakhs. Right? So out of this 200 lakhs, whatever the reversal happened, so FIFO method, first in first out, timing difference originates and reversed. How much? 80 lakhs. You reduce 80 lakhs from this. That means what is the timing difference remaining? 120 lakhs. When this is going to reverse? After tax holiday period. Therefore, on this 120 lakhs, you recognize deferred tax liability. Because the timing difference which originates and reverses within tax holiday period, ignore. The timing difference originates 200 lakhs first year. And from third year onwards, it start reversing. Up to 80 lakhs it is reversed. So 200 minus 80, so 120 lakhs. Into, what is the liability, deferred tax liability? The tax rate, sir, 40%. So 120 lakhs into 40%. So 120 lakhs into 40%. So it will be 48 lakhs. This is deferred tax liability for the first year. Deferred tax liability for the first year. So first year you need to recognize deferred tax liability. But in the question they are asking second year. Now come to second year. How much is the timing difference? 400. Now how much reversal happened? 80. Can you reduce this 80 from this? No. Already 80 which originates first has been reversed. So second year there is a timing difference of 400 lakhs on this 40% tax. So that means 400 into 40. So it will be 160. We need to recognize 160 lakhs. So at the end of the second year, can you tell me what is your deferred tax liability? First year balance 48 lakhs plus second year 160 lakhs. So total 208 lakhs. Total 208 lakhs. This is the total deferred tax liability of the enterprise at the end of the second year. And exclusively second year, how much you recognized? 160 lakhs. Opening balance 48 lakhs. So total 208 lakhs. So this concept is called what? Tax holiday concept. So the timing difference which originates first will be reversed first. So first year, how much is the timing difference? 200. From third year onwards, whatever the reversal happened, minus it. The balance you recognize deferred tax asset or liability. In the question itself, they said it's a deferred tax liability. Now the second year, whatever the timing difference is there, 400 lakhs. So that we need to apply 40% directly. So this is the concept. So what is the very simple concept, sir? This concept of deferred tax. Now one more question, MAT concept I will cover, sir, so that all concepts will be over. This is tax holiday concept.